What are going to be the big factors today? Definitely inflation easing, good news for India, but even global markets is going to be a big factor to watch out for. So let me start off with that. Of course, Neeraj Alex with me this morning. Folks, Trump is on a deal spree.
Yeah.
A deal a day keeps the recession blues away. I don't know.
We'll have to work on that rhyme.
We'll have to work on it, yeah.
But imagine the kind of impetus that it has given to chip stocks worldwide and the kind of deals cracks that has happened in the Middle East because of that Trump visit, part one. But yeah, I think the big story today has to be inflation. India, yes. US inflation, US CPI also coming much lower, although people say that it might perk up ahead. Who knows, per se.
And also the outlook for the economy, global economy going up. Watch out for crude prices because 4 sessions are up 10%.
Yeah, so that, lastly, something that has gone unnoticed and slipped under, and we need to figure out the ramifications of this. The Japanese yields, they're shooting through the roof, and this will have some implications for monetary flows. We'll talk about it in detail, but I think that's a very important point that needs to be kept in mind.
Yeah, so much to unpack for you today. And luckily and thankfully, we're business as usual. We're looking at the usual factors that impact markets, geopolitical, regional conflict on the back burner, at least for now. All right, so here's what's happening with US markets. US markets have continued their winning streak on trade tensions easing largely. So you saw, key indices doing well. Dow is looking down there because of one key stock which was down. That's United Health. That's what's pulling the Dow down. But otherwise, an up move. Nasdaq is what's shining because the Nvidia stock has soared 5% after a deal to send AI chips, 18,000 AI chips precisely, to Saudi Arabia as part of that meeting with Donald Trump and MBS. April CPI data is up 2.3% year on year. I wouldn't say it's dramatically lower. I would say it's slightly lower than expected. The expectation penciled in was 2.4%. Core inflation for April is at 2.8%. Bond yields have risen a tad to 4.48%. So that's the 10-year mark. Crude continues to climb on signs of the trade war easing. Brent is nearing the $66 mark. Asian markets have had a bit of a mixed opening. So not half bad there. The Hang Seng up in the green. Nikkei seeing a bit of pain, could be because of the Japanese bond yield factor that Neeraj was talking about. But meanwhile, let's also take you through what the implied open is for India. And I just want to pull that up for you for a second before we get to Alex for the trade recap this morning. 90 points in the green. I think a bit of relief, Alex, after yesterday's profit booking, which was not a major stress considering what we'd seen on Monday.
No doubt. And some bit of that had to do with foreign institutions turning net seller once again. And of course, quite a bit that is playing out on the world stage. But let's talk about those flows at the start. Foreign institutions selling after buying the day before that, 476 crore rupees or thereabouts on a net basis, 4,273 odd crore being bought on a net basis by domestic institutions. Profit taking in evidence in large cap names. This is really the message from yesterday. Benchmark Nifty 50 fell close to 350 points or about 1.4%. But do remember that in the previous session, the session before that, the gain was about 900 points or thereabouts. So this was par for the course. IT erased some of the gains from Monday's bumper rally. The losses were led, of course, by the frontline IT companies in that IT index as well. So take a look at some of the big drags, and these are also common for the Nifty 50. The Infi, HCL Tech both losing over 3%, TCS close to 3%, and Wipro down about 2.2% or thereabouts. In fact, 37 Nifty 50 constituents lost ground yesterday, and the heavyweights contributed to most of the declines. Take a look at the list. HDFC Bank, Infosys, Reliance Industries, Bharti Airtel ahead of its numbers, and ICICI Bank contributed to close to half of the declines. The broader markets remained resilient though and outperformed the benchmarks. The Nifty Mid-Cap Index gained about 0.2% and ended there. The Small Cap Index ending as much as 0.8% higher, and the market breadth was very positive, in fact, with two gainers for every decline in trade yesterday. Of course, that gap closed a little bit towards the end of the session. The defense pack continued its romping rally with the index up as much as 4.1%. Some of the stocks that you should watch out for, and there were some very big gainers in trade in that defense pack. Bharat Dynamics, for one, gaining about 11.5%, as well as Idea Forge, Garden Reach Shipbuilders ahead of its numbers, and we'll talk about that. It's on my list, was up as much as 5% as well, something like a BEL up 4%. Wonder if that rally continues today, Neeraj.
Yeah, I mean, interesting. I mean, I think it's becoming difficult to call it on a daily basis, right? Yeah. But yesterday's trade as well, you would argue that the momentum looked good because the broader market was doing extremely well, right? I mean, you might argue that IT pulled the index down, the Nifty was lower. Look at the small caps, excellent performance out there. So one, that the small cap performance was looking solid in trade yesterday, small cap 250 in particular, and which is why the market breadth looked decent. So that is one thing to note as well. In fact, the CPI data across, thank you for that chart. The CPI data across the world and in India in particular would probably ensure that people will believe that the Indian rate cut trajectory would continue even if the US CPI in the months ahead was to be higher. So that is one thing to keep in mind, and which is why I think banks and NBFCs would be pockets to watch out for in the session today. And like just the point that independent of what happened to the index today, it was maybe a day of consolidation. The kind of buying that we saw in some of the stocks, even if the percentage gains weren't necessarily the best, was actually very, very strong. Look at the data, for example. I've only chosen the Nifty 500. I'm not, ignore the percentage gains, but look at the percentages marked for delivery, and these are fairly liquid, well-traded names. Hyundai, 75%. ICICI GI, 73%. Mankind Pharma, 72%, Westlife, 70%, extremely strong delivery markers for a lot of these stocks. And you saw that happening. I mean, day before yesterday, the markets went up substantially. We didn't have that great delivery. Yesterday, the delivery percentages were very good, which is actually pretty, pretty heartening. So, yep, I think that is something that people keep an eye out for. Individual levels here and there, any given day remains to be seen. But the momentum is not too bad for now.
Yeah, I think all things looking up. If you look at it, major issues are behind us, right? Q4, even though it's not the best and brightest, it's okay. It's been digested, and in parts not half bad. I mean, we have some big results today as well, which we will cover. Regional conflict on the pause button right now. I think the biggest overhang, which was what's going to happen with tariffs, trade and everything, now we're seeing signs that Trump will eventually come back to the table and to the drawing board. I mean, there will be a bit of a reset in terms of what the base tariff prices are, but it's not going to be as bad as was expected initially. So those are some of the factors to watch, as well as when it comes to key indices. Of course, Nifty has given up some gains as profit, but profit booking has taken hold. Despite the dip, I would say near-term sentiment remains positive. No need to really worry because profit booking is healthy in a bull run. So expect the Nifty to move towards the 24,700 to 24,800 level, but amidst consolidation, unlikely to be an easy one-way ride. The next target will be of 25,000, remains a key hurdle. Key support is expected at 24,380, which was Monday's low. Key resistance levels for the Nifty at 24,863. Nifty continues to trade above the short-term moving averages. Nifty Bank remains above all key moving averages and is in consolidation mode. Key support levels at 54,876. That's for the Bank Nifty, and key resistance at 55,343. So that's sort of a bit of the setup, but on the derivative side, Puneet taking us forward with more details.
Well, thank you for that. So definitely a very interesting session. We did end about 24,500 yesterday, which was one of the key levels to watch out for. We are expecting an 82-point open in implied open. So it'll be interesting to see where we go with the Nifty 50 because we had roughly four key earnings of Tata Motors, Cipla, Hero MotoCorp and Bharti Airtel yesterday. Most results largely in line. So we should see some in terms of gains at least in the Nifty, and for that to sustain at least on the fundamental side. We mentioned about the levels on the Bank Nifty as well. So let's look at the open interest data now, both on the calls as well as the put side. We have seen 25,000 seeing very increased interest in terms of the open interest call options. In terms of puts, that has largely been driven down slightly, but maintaining the 24,500 and 24,600 level as well. We've also made an inch up into 24,200 levels. And that's largely because of the up move that we've seen in the Nifty over the last 2 to 3 days. So a new level essentially being formed, and that has subsequently impacted the volumes of puts on the 24,000 levels. In terms of key stocks, both on the open interest distribution gainers as well as on the losers side, we have seen some short build-ups in stocks like Paytm, UPL as well as Shree Cement. UPL also did come out with its earnings largely in line, but seeing some short build-up there. When you look at the open interest losers side though, we have seen some short covering actually in some key stocks. It's also backed by fundamental reasons like Escorts we mentioned yesterday as well, that the Q4 earnings were largely in line. BHEL is the other one that's seen some short covering, while some long unwindings have been seen in stocks like GAIL as well as Cyient. So overall, expecting to have a positive implied open today, and backed by fundamental reasons, it should be a very interesting session to watch out for.
It should be an interesting session to watch out for, no doubt. Implied showing about 90 points up. All right, let's come to the big numbers. We are just, I think, a few days away from wrapping up this results season. And this is one results season which has been overshadowed by so many other factors. But nevertheless, important set of numbers to report on today as well. Here's my watch list. I'm starting with the Tata Motors. Numbers are largely in line, but we're still giving it a thumbs down simply because of factors perhaps beyond the control of the company itself. There was no guidance for FY26 for JLR due to tariffs, and that's what the pain point has been. Production from European Union will be hit by tariffs is what they have said. Investor Day scheduled for 9th and 16th June, and the guidance awaited then for the consolidated business. So here are the core numbers for Tata Motors in the fourth quarter. That's year on year, revenue up 0.4% at 1.2 lakh crores versus 1.19 lakh crores. EBITDA up 0.6% at 16,644 crores. This is slightly better than estimates actually. Margins also have stayed steady. Margins at 14% versus 13.9%, also better than estimates. Net profits are down. You're seeing that figure very sharply down. But if you put that in context, profits are down because of a one-time positive in the base year profit. So there was a one-time on account of a deferred tax write-back of over 9,400, nearly 9,500 crores in Q4 of FY24, which is why that base effect has sort of skewed the number. So keep that in mind when you look at the core profit number. As far as JLR is concerned, as a segment revenue was down 1.7% year on year. Passenger vehicle revenue was down 13%. Year on year at 12,500 crores for Tata Motors, and commercial vehicle revenue was down 0.5% at 21,500 crores. Here's what key brokerages are saying. Jefferies has maintained an underperform. They've hiked the target price to 630 from 625. They see there's a slight EBITDA dip in Q4, but strong FCF, that's free cash flow. A tough year ahead, says Jefferies for Tamo. India truck demand is soft, rising competition in EVs. They've cut the FY26-27 estimated EBITDA by 8%, but have raised earning per share in that space or in that time frame by 3 to 4%. Macquarie, meanwhile, has maintained an outperform for Tata Motors with a target price of 826. They say passenger vehicle segment is a beat. CV and JLR are in line. They await margin mitigation strategy for JLR in the near term. They expect some slowdown in JLR volumes. They see an upside risk to working capital and say they will watch for trends. Now, we heard from the Tata Motors management yesterday and a whole host of things they've said, but the point they're making on JLR that even after the US-UK deal, they might see some pressure on input costs. So listen in to some of those comments.
Defender into US is concerned, definitely it has been impacted by the tariffs there. And since it's manufactured out of Europe, it's at a 25% tariff rate even today. And therefore, we will treat it as a full portfolio and find ways to see how we can offset the tariff increases that are there. At the same time, we remain optimistic that there will be a deal done between EU and US as well, just like what has happened between UK and US. But we'll have to wait for that to happen. We are hopeful that that will happen sooner rather than later. As far as JLR is concerned, I think, as I said earlier in the tariff one, there are just too many moving parts and too many unclear. We need a lot of clarifications, let me put it that way, in terms of how it is going to get treated. So therefore, let's just wait for the investor day on 16th of June where we'll be able to give you a better update. Otherwise, I'm completely shooting in the dark, which is never our intention. We'll never do that. And growth-wise, as I explained earlier, I would expect to see growth this year. given that it has been a weak year last year.
Okay. So that was the word from Tata Motors. You will hear from the management on NDTV Profit as well, and we'll ask them some of those questions, especially what the outlook looks like. Bharti Airtel, second stock on my list. It's a thumbs up. Numbers were largely in line with estimates. Net profit better than estimates owing to a tax reversal figure. Revenues up 6% at 45,129 crores. So tad below Bloomberg estimates. EBITDA up 10% at 24,597 crores and margins at 54.5 versus 56.4. So slight margin erosion as well. Net profit was down 25% at 14,781 versus 11,022 crores. ARPU, that's average revenue per user, that's the most important metric that you see for a telecom company, was at 245 rupees. And they've announced a dividend of 16 rupees per share, which, by the way, is the highest since 2009. Morgan Stanley maintains equal weight with a target price of 1,870 for the stock. They say Q4 is a slight beat on India EBITDA. India business is led by better than expected performance in Airtel business segment. India capex came in much higher, but FY25 showed a 9% drop year on year. But that was in line with the management outlook. So that's important to remember. The final dividends of 16 rupees per share is showing a 100% year-on-year increase ahead of estimates. So that's Morgan Stanley's stake. Consolidated net debt increased due to redemption of $1 billion perpetual bond. So that's the second thumbs up on my list. So is GlaxoSmithKline Pharma, actually. So that stock also a thumbs up from my side. Net profit has beaten estimates. Growth is led by respiratory and vaccine portfolios. EBITDA margin expansion has been led by softening of raw material prices. There's improved productivity and cost efficiencies. Here are the core numbers. Revenue up 4.8% for the quarter at 974.4 crores. EBITDA up 29.5%. Margins at 34.2% versus 27.7%. So hefty increase in margins and with good reason. Net profit up 35% at 262.9 crores. So that's going to be one stock to watch out for on my list.
And interesting ones. You'll see the reaction right up front with the Nifty 50. Let's see how it moves, right? So quite a few, 4 Nifty 50 companies to account for, some of them, couple of them during market hours yesterday. But let's talk about Dalmia Bharat, because this stood out as a good set of numbers. It's a thumbs up from where I'm sitting. The key highlights first, before we get into some of the numbers. The sugar sales in the quarter stood at 1.5 lakh metric tons, and exports accounted for 9% of the total volume. This is an interesting mix. They've also said that the favorable market environment pushed net sales realization up as much as 5%. This is what the company earns when it sells sugar. Net sales realization stood at 38.9 rupees per kg. Ethanol production via B-heavy molasses and juice route remained unrestricted through the quarter, as a result of which that ethanol blending and the production was higher than the internal targets, and ethanol production was 31% higher year on year. That has resulted in an improved performance on the operating side. The revenue is up as much as 36%, but the real improvement has come through the bottom line. And the EBITDA, which is at 63% higher, very substantial improvement in EBITDA margin. It's up as much as 320 basis points at 19.07%. 19.07%. And the PAT number is more than doubled, 126% higher at 206 crore rupees. Just caution when you're coming and talking about sugar company, there is seasonality associated with it. One quarter that has been incredibly good does not necessarily mean that that trajectory will follow through. So watch the trends very closely, particularly sugar production and ethanol production information. The second stock, I must admit that there's not too much information on it, but the numbers look particularly good. Garden Reach Shipbuilders, this is a stock that has gained very substantially in the recent past for obvious reasons. The revenue has gone up by as much as 62% and stood at 1,642 crore rupees. I do understand that Garden Reach Shipbuilders themselves and the management has said repeatedly that they have an S-curve revenue recognition pattern, which essentially means that there will be quarters in which there is a little bit of lumpiness in the recognition of revenue, and this could be one of them. We'll have to find out when we speak to the management. EBITDA is up as much as 144.5% or thereabouts, and the margins have improved as well, coming at 13.5%, as a result of which the bottom line is substantially higher. It's another doubler. It's gained 118.6%, coming at 244 crore rupees. The last stock is Metropolis, and I was not sure whether to tag it lower or higher, so I have. And it's not a cop-out, I promise you, it's a neutral rating. And the reason why is that on the face of it, the revenue is up about 4.3% or thereabouts, 345 crore rupees. The issue is when you look at the print on the bottom line, and you look at the operating profit, it's down about 22% and 62.3 crore rupees compared with consensus estimates of about 83.4 crore rupees. The margins have come in lower as well, 18% compared with estimates that it pegged it at 23.6%. The net profit is down 20%, coming at 29 crore rupees. But when you look at the investor presentation, they are saying that there is a one-time cost, and that cost is about 21 crore rupees. The PAT is impacted, of course, by that. And that relates to 3 acquisitions that the company did during the quarter and costs related to legal and professional fees that were paid. They've stated that the adjusted EBITDA was 5% higher. The adjusted EBITDA margin was at 24.3%, which is better than the consensus estimates. So take that with a pinch of salt. That's what I'm saying.
Okay. Well, I have a result, a brokerage note, and an announcement from a company. So the result, and pretty similar to, I think, if you can argue maybe what Glaxo did, in that the top line numbers weren't the best for Sharma SGS. In fact, the revenue miss, which you could argue, was due to the 64% decline in consumer revenue business, which is a high volume business for them. But the point is they're guided to this. So the key standout for Sharma SGS is that the favorable mix of products has driven the margin expansion, while the revenue miss was due to this 64% decline in consumer revenue. But the operating profit margins up 505 basis points owing to this lower margin consumer business. When do you see the Dixon and the Ambers kind of a business that, those businesses show such a sharp margin expansion? So Sharma SGS has managed to do that. The adjusted profit after tax beat was driven by the lower interest cost and higher other income as well. But exceptional performance on the bottom line and the EBITDA, as a result of which Sharma SGS could actually do well despite the revenue miss. So bear that in mind. Then Siemens. The BOFA note on Siemens kind of encapsulates the numbers and the outlook, so I thought I'll bring that one up. They've maintained an underperform with the target price of 2450. I must say, when the energy business demerger happened, Bank of America came out with a note with this target price, the stock didn't react at all. So keep that in mind. But there is an execution miss which has weighed in on the earnings. The order inflow has been strong. The short cycle segment has been hit by the weak private capex, so that is something to keep an eye out for. BOFA believes that execution will disappoint further, and they see earnings downgrades even as the valuations are rich for Siemens. So that is something to be kept in mind as well. Maybe it reacts negatively today, keep that in mind. And a very small company, but Standard Glass Lining Tech. The reason I bring this up is because they have launched heat exchangers, glass line shell and tube heat exchangers. Now we know what happened to KRN heat exchangers when it's come out with its IPO. The stock stays at 4.5 times its issue price because it's a very small nascent industry per se. Now, what Standard Glass Lining Tech has done is that they have done this in collaboration with AGI Group for the product, and just laying it out that the estimated market for glass line heat exchangers is 2,000 crores and about $2 billion globally. The revenues for this stock business as of now is just 600 crores. So the market size is pretty high. You might see this stock reacting positively today. So keep an eye out for this one. 3,000 crores market cap, small cap, but keep an eye out for this one. So top 3 on my radar. And then, guys, between us, I mean, we'll talk about some of these stocks in detail, yes. But GAIL, after the numbers yesterday, a clutch of brokerage notes, insurance businesses, a very tepid month of April, and some other numbers. So it's a reaction-packed morning today.
Certainly.
A lot to unpack. I think you won't have any specific reaction to the CPI numbers except for a positive sentiment, but important to talk about.
Yeah, on banks and NBFCs.
Rate sensitives, yeah, the rate sensitives perhaps. So watch out for banks, NBFCs, and perhaps real estate as well. But the consumer price index-based inflation for April is at 3.16%, lower than the estimated 3.20% For India, it is declining from 3.34% in March and now reaching its lowest level since July 2019, staying below the central bank's target of 4%. Pallavi is joining in with more details of what really cooled off and led to this inflation figure.
Right, India's retail inflation has come in at 3.16%. That's compared to a print of 3.34% we had seen in March. So this means that India's retail inflation is at almost a 6-year low. It is also broadly in line with what was expected. A Bloomberg poll of economists had pegged the median inflation rate estimate at 3.2% for the month of April. Now, what's continuing to cause the de-acceleration here continues to be food and beverage inflation led by vegetable inflation. Food and beverage inflation eased to 2.14% for the month of April. That's compared to about 2.88% we had seen in March, and vegetable inflation contracted by nearly 11% after contracting by about 7% in March. Core inflation, that excludes the volatile food and fuel components, remains broadly steady, rising modestly by 4.22% in April compared to 4.2% in March. That's according to data from Bloomberg. Now, the fact that IMD's projection of an above normal monsoon along with what we're making of the current agricultural production trends does appear to indicate that inflation is likely to remain below the RBI's target of 4% in at least the next few months. What this means is that on the monetary policy front, a rate cut of 25 basis points appears to be almost a given the next time the RBI MPC meets in June.
All right, Radhika Rao joining in just a bit. She's senior economist and executive director at DBS Bank, and we'll get her in to speak about, what this means for the RBI. I thought that point was interesting, Alex, that Pallavi also made, that now a rate cut of 25 basis point is pretty much a given. There is no reason. There is no reason not to cut rates, and that's something that the world is going to cheer. I find that interesting when at a time when President Trump has made it almost a daily point to berate who he calls too slow Powell. No, too late, sorry.
Too late Powell.
Too late Powell. So I think we're going to be on the ball with that. But what is the implication? And this is led by softness in food inflation. So
certainly, it's a negative number. In fact, 10.98% vegetable inflation negative. So basically, prices have fallen by that much. And seasonality, I would think that's going to come into play for sure, because that often spoils the party. Before you celebrate too quickly, watch out for that food inflation number.
So rains usually bring some of that coming in. We'll take a very short break. On the other side, we will be joined by Radhika Rao of DBS Bank. Stay tuned for that and more.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
All right, welcome back. You're watching India Market Open. And we were speaking about the inflation print, which has come in quite low. In fact, it's come in at 3.16% in the month of April, and that's the headline number. And that is the lowest reading since July of 2019. It was in line with expectations, which had pegged it at 3.2%. Now, what you need to bear in mind is the implication of this, of course, is the next policy meeting for the Monetary Policy Committee of the Reserve Bank of India is in June, that is next month, and you could well see another rate cut. This is good news for all of you that have loans, and it is also good for banks because they have a very substantial portion of their net demand and time liabilities in the form of government bonds, and when yields fall, they have a benefit in terms of treasury improvement. They earn more from treasury operations. The other aspect is if you're holding hybrid mutual fund schemes, then you will also benefit because you will also see the yields in your portfolios drop, and that is beneficial for you in the form of capital gains as well. By the way, one quick mention of the rupee. It moved up very substantially at the start of trade yesterday, but it gave up those gains over the course of the session, and it ended just about 4 paise or thereabouts higher at 85.33. Watch out for it at the start today. We've been seeing substantial inflows, and that has had a positive bearing on the rupee in terms of strength for the rupee against the dollar. Do remember, of course, that the dollar has been moving higher against a raft of currencies. Let's talk about earnings now. And we have gone through a bulk of the earnings season. It is, in fact, drawing to a close, and 34 Nifty 50 companies have reported their fourth quarter numbers so far. To tell you how these companies have fared overall, we're joined by Mahima. Mahima, it's interesting because we've been having debates about the fact that earnings not as bad maybe as some had predicted. How does the scorecard look?
Right. So overall, let's take a look at how many companies have come out with their earnings in terms of Nifty 50. Around 36 companies have reported their earnings so far, and in terms of how they fared, almost 9 companies' earnings were above street estimates, so they were better than what the street was estimating. 6 companies were disappointing in terms of what the street was estimating, and around 21 companies came in line with what the estimates were. In terms of the overall sectoral trend, outperforming sectors included your BFSI and healthcare. In terms of sectors that underperformed was your IT, FMCG as well as consumption, and sectors that were largely in line include cement, oil and gas as well as retail and jewelry. Now in terms of stock specific actions, top performers included Adani Ports. The stock has been up 8% since its earnings. L&T is up 3% since its earnings. ICICI Bank and M&M both up 1% since their earnings. In terms of what worked for these companies, Adani Ports complete beat in terms of FY25 revenue and a strong FY26 guidance as well. Next, L&T order inflows were up 18%, exceeding the guidance overall of 10%, and revenue growth did beat the overall guidance as well. For ICICI Bank, net interest income and provisions were better than estimated, and sharp asset quality improvement was also seen. Lastly, in M&M, farm margins were a surprise overall for the counter, and a positive start to EV was something that was seen something that was penciled in well by the street. Now, in terms of top losers, Asian Paints was amongst the top losers. The stock has been up 1% since then. Infosys and Zomato has been down around 1.15% since its earnings. Now, what's not worked for these companies? Asian Paints, the overall net profit was down 45%, and the commentary coming in on demand was also not positive. Q1 FY26 still will remain subdued in terms of demand. In terms of Bajaj Finance, negative bias overall on the numbers, and FY26 guidance was also trimmed. In terms of Infosys, FY26 guidance was lowered, and there was a miss in terms of FY26 guidance as well. And lastly, in terms of Zomato, food delivery growth has been slowing for the counter, and high competition with the management also acknowledged will be putting profitability overall under pressure. So this is the overall view as to how Nifty earnings have fared so far.
Okay, all right. Thanks so much, Mahima, for breaking that down for us, and we'll get the full picture not too far from now. We're winding down, as we mentioned. We're joined this morning by Bhavin Mehta of Dolat Capital, as well as Avinash Gorakshakar of Profit Mart Securities. Thank you so much, gentlemen, for taking the time, and good morning to you. Bhavin, I'll start with you. Yesterday was the cool-off that a lot of people had anticipated, but the broader markets looked very resilient. What is your feeling, or what is your reading of the trends as things stand this morning? First, let's start with the benchmark view, and then we'll go into individual stocks.
Sure. Thank you. Good morning, everyone. So what we have seen in markets yesterday precisely was once again HNI retail got very aggressive on the long side. So we have seen somewhere around more than 1 lakh contract getting added to the single stock futures. This has actually led to some amount of cool off from the large cap space. FIs were kind of booking profits into the large cap and some amount of softness at broader market level. So once again, what we have seen is that Nifty continues to trade in that band of 24,000 to 24,800. That band still continues. We are looking at a supply at higher level of 24,800 to 25,000 kind of a range. Though anticipation is that at lower level, 20-day EMA has actually moved closer to 24,200. So not anticipating much drawdown below that level for the timing. However, till the time we don't cross that high that was registered in December 24, I think that upside will also remain kept for the index. We will be trading in a tight range. It will be a very stock specific move that we are likely to see. Big amount of underperformance from broader market indices. So somewhere that has to reverse going forward if HNI retail once again get aggressive, specifically on single stock futures and the cash front.
Bhavin, very good morning and good to have you on the show. What are your top picks for the day?
Yeah, so we are looking at two stocks. First one is Exide. We have seen very good amount of base formation in this particular counter. On post earning, we have seen it moving in a very tight range between level of 360 to 375, 380. So recommending buy on this particular counter in the range of 375, 370 where it is currently trading. With the stop loss of 350 for a possible target of 425 to 440. Notably, this range is a 200-day SMA for the stock. Second one on our radar is Bharat Forge. Now, after a long time, that is post September 24, we have finally looking at a positive crossover between 20 and 50-day exponential moving average. Stock is also trying to close above the highs that were registered in month of March. High probability if the aggression continues, the stock should be making a strong move on the upside. So look to buy in the range of 1205 to 1180 with the possible stop loss of 1150 and the price objective of 1285 to 1300 on upside.
Avinash, good morning to you as well. You know, since having talked about Bharat Forge, I'm just going to stick with the larger space and ask your view on, defense today as well. Do you see another upside coming in? Some good numbers have come in, today from Garden Reach. Have you looked at those?
Yeah, good morning, Tamanna. My sense is that, defense companies will continue to be in limelight. I think yesterday's star performer was Bharat Dynamics. We saw a kind of a good bump up on the stock yesterday. But I think if you look at all the stocks, specifically today, I believe Hindustan Aeronautics will be declaring its quarterly numbers. So, a lot of action could be expected there. My sense is that, despite the fact that there has been a pause in the Indo-Pakistan war currently, I think there's no doubt that defense is going to be very much in the action in the coming few quarters. A lot of companies have been told that they should ramp up their production volumes, be ready for more consignments. So I think this all boils down to the fact that despite valuations being fair to expensive, I think these companies, the biggest advantage, Tamanna, is that earnings visibility is extremely strong for the next 2 years, and that is what makes the market confident on them. So I think it might be maybe a quarterly tepid growth, but overall on an annual basis, I think most of these companies are sitting on very healthy order books. So I think this space will continue to see some action. I think within that, I think direct plays like Hindustan Aeronautics, Bharat Dynamics, Bharat Electronics, or even something like a Bharat Forge, which obviously is a large defense player also, should also benefit. So I think net one should look at some market declines to actually accumulate these stocks. I think the next 12 to 15 months should be quite a good one for all these companies.
Okay. Okay, well, so, we'll first continue with GRSE as well, but keep your eyes out on this NDTV Profit exclusive, and then we'll try and address that. But since we're on the topic of Garden Reach Shipbuilders, Anushi, Alex pointed out that the numbers were strong. Avinash has given the verdict on defense names, but let's go one layer below on Garden Reach Shipbuilders. Are there some details that they've given on the order inflow and the outlook ahead? Have they spoken about anything else which is noteworthy? What are the valuations relative to some of the other peers? Give us some details there.
Right, Neeraj. So if you see for these shipbuilding companies which are there, they usually follow a shaped kind of earnings pattern which is there. So revenue recognition, if we see on a quarter-to-quarter basis, may vary, which if we see would have an impact on the margins. Also, this time we are looking at overall a strong set of numbers with about a 62% of a revenue growth, margins at the range of 14% as compared to 9%, and even net profit seeing about more than 100% of a jump. It's the order book positioning which is important to keep a track of for this company. Now, if you look at the present order book, that stands at the size of 23,880 crore, and major projects are to be executed in the next 3 to 4 year period as well. So that is something we should be watching out on, how the execution would be for these companies. So that would give us a certainty about where the revenues are positioned at. Currently, they have about 10 projects, including 4 export projects which are there. So if we are looking at what is the expectation forward? Antique had a report on this just yesterday, wherein they have been bullish on the overall shipbuilding space. They are seeing the company is favorably positioned for 2 large orders which are expected. Order pipeline for the company is at 1.06 lakh crore in the next 2 years. So if you take the order book positioning in the size, it's about a 5x time of a multiple that we are looking at. So focus on the non-defense side also, if we see, will remain on shipbuilding side and green energy platforms, which could boost the revenue visibility going forward for the business. So it's the order book positioning for majority of these shipbuilding players which are important. We did see in the budget that there was also an announcement of an initial maritime fund of 25,000 crore. On how that could benefit for some of these key players is something that we should be watching out for. So next generation corvettes is the expectation, repeat orders from there. So that is another area that we should be focusing on, whether this would flow in FY26. So that's the overall picture that we are seeing for Garden Reach.
All right. Thanks so much, Anushi, for breaking that down for us. And Bhavin, I'm wondering what you think about this entire defense pack. Yesterday as well, the index was up about 4%, and a few of those counters moving up in double digits. One at least did. What do you make of that? Do you call a bit of an end to the rally, or do you bet on the momentum to continue?
So if you look at defense space, we have seen a very strong momentum post this geopolitical escalation that we have seen between India and Pakistan. What we are looking at, so something that on the derivative side of the market, Hindustan Aeronautics since last series has been witnessing very good amount of call buying. Even in trade yesterday, this counter has seen good amount of call buyers aggression at various strike price. So overall view for this particular counter, or even if you look at something like Bharat Electronics, we have seen a very good momentum. So my sense is keep a trailing stop loss. Look to accumulate on the dips with strict stop loss in place. Momentum continues to remain strong, and few of this counter, like we have spoke about Bharat Forge or Garden Reach Shipyard, this stock has witnessed a decent correction from the higher levels, and they have been consolidating on the lower band. So sense is that downside for the time being would remain restricted. On the upside, if the breakout of various level happen, the momentum could be very strong on the upside over next 1 to 2 months.
Okay, important story coming in, being broken by my colleague Subhana Sheikh. RBI may consider tighter norms for unsecured loans by banks. Subhana, why? We just saw a bit of loosening from the Reserve Bank of India. What exactly is the source of concern?
Hi, good morning. So actually the RBI is preparing to introduce tighter norms for unsecured loans. Now this is because, it still is concerned about, the expected rise in delinquencies in this segment. And RBI also believes that, there is potential vulnerability in this segment. So what sources are telling us that RBI is actually nudging select banks to strengthen their internal policies urging them to set stricter thresholds for granting unsecured loans. Sources have also told us that RBI is asking banks to cap loan amounts for borrowers based on their credit score and their ratings. So, as I said, this is largely because, of the concerns that they have and that still remain. Now, we have to remember that back in November 2023, the RBI had already hiked, risk weights on consumer credit that is given out by banks, to 125% from 100%. Now, this had brought down the pace of unsecured loan growth significantly. So with this, while many banks already have their internal limits, what RBI believes that, these policies should be clearly documented and closely monitored because it could ensure, robust risk management. And when the RBI goes for inspection, it could be easier for regulatory inspection for the central bank. So likely the RBI is also formalizing a draft notification around it, and sources have told us that it could come out within the next fortnight or so.
Okay. Shubhana, just help us understand this in the context of the announcement that was made towards the end of February, where the RBI reduced the risk weight requirement for banks on consumer microfinance. That's of a sub-segment or a separate segment, is it?
That's a separate segment, Alex, altogether. They had they had rolled back the risk weight for microfinance loans and NBFCs. But the higher risk weights for unsecured personal loans still continue to remain.
Okay.
So this is the difference.
Okay, all right. Thanks so much for that clarification as well. So, important update coming through. Avinash, the question is, how do banks react? And we've seen overall, over the course of last month and a half, banks have been favored and they've moved up quite substantially. And a lot of people looking at PSU banks also very closely. What's your reading of this if it does come through?
No, I think, Alex, if it does come through, smaller banks like RBL Bank or typically the smaller private sector banks, typically even the small finance banks, I think there could be a little bit of volatility today. The larger banks, specifically if you talk about State Bank of India or maybe an ICICI Bank, Axis Bank, I don't think, this could be a major impediment for them. I think clearly the smaller banks like RBL Bank could be watched very closely. And if it does come about, then I think a certain amount of restrictions could come in, and that could actually, slower the demand, because unsecured loans have been a large part of smaller private sector banks. In fact, for the PSU banks like SBI, Bank of Baroda, Canara Bank, I don't think it's going to be any major negative. But for the smaller private sector banks, it could possibly be an impediment, and the markets could possibly react accordingly. So I think it's better to wait and watch for the full policy to come out, from RBI.
Okay. It sounds a bit confounding. Now, let's see. I mean, obviously, we've gotten these details after due checks and all, because that's something that we follow at a basic at NDTV Profit. But it'll be interesting to see if and when this happens. And before it happens as well, does actions preluding this lead to some bit of a capping of gains for NBFCs in particular? Though RBI in this case has said that they'll tell banks to do so, but NBFCs become the first port of call for almost anything negative in terms of regulatory action from the Reserve Bank of India in terms of loan forwarding.
But
So,
to that point, my sense is it's never going to be a tap fully open or fully shut.
Yeah.
It's going to be a halfway house with
100%.
a bit of tweaking, and that's always one concern, that if you open the tap completely on unsecured loans, what happens? So I don't think those issues went away entirely. Perhaps there was signaling that the RBI governor was putting through once he took charge.
Yeah, but sorry, the idea was that because private capex was not coming, lending was not happening, you needed this to happen in order for all of that to come in and liquidity to be eased. Now, is it the RBI saying that now we believe that the liquidity is enough and therefore liquidity measures don't need to be done at the way we did in, let's say, Feb, March, April? I mean, that's the key question.
I feel that there could also be a nuance to this, because they're talking about your risk score, right? Your credit score ultimately. So basically, you don't want to go to the bottom of the pyramid. You can continue unsecured in the top of the pyramid if those norms do suggest that.
Don't loosen it up too much. Okay, Bhavin and Avinash with us. Bhavin, I'm wondering what you're thinking about auto today and Tata Motors. Let's talk about the big one that we will be seeing responding. I mean, numbers are decent, in line, but the lack of guidance on JLR is a bit of a mixed bag. So we might see some downtick on it. If there are, is there a buy on dip strategy on Tata Motors? How are you feeling about the stock?
Yes, so if you look at formation in Tata Motors, we have seen good amount of aggression from a level of somewhere around 600. The stock has already passed 700 mark on upside, looking at strong supply zone around level of 725 to 730, from where it is showcasing a rejection. On downside, I am not anticipating much below level of 670, 675. So in case stock falls to somewhere around level of 680, 690 range, one can look to accumulate, one can look to buy the stock with a strict stop loss of 670 for possible move towards level of 720 to 25 on upside once again.
Okay, so Tata Motors in focus, so is GAIL truly, and we'll just play out a slice of this conversation. My colleague Aishwarya spoke to GAIL Chairman and Managing Director Sandeep Kumar Gupta. He talked about the company's transmission business, among other things. Listen in.
I think it's a time to celebrate. This is a record year in the history of GAIL. We have earned the highest ever EBITDA, highest ever PBT and highest ever PAT for this year is 11,312 crores. So this is a record year. But yes, if you are asking about misses, I must tell that we would have been glad had the natural gas demand in the country been more robust. So there we see a lot of scope in increasing supplies to power, to refineries, petrochemicals, and definitely to CGD sector also, which is a very growing sector.
So as far as the transmission business is concerned, if you could speak about the volume growth that you're expecting in FY26.
We expect that there should be a growth of about 6 to 8% in this vertical. And why I am giving this range? Because it depends upon the prices which are there. So if the prices are softer, perhaps the growth can be robust. But if not, then this will be constrained by a lower number. So we believe that on an average, 6 to 8% growth will be there in the transmission volumes.
All right. So as far as the gas trading business is concerned, that has been the key driver as far as the earnings have been seeing an uptick of late. How much of your US contracted volumes are you has that tied up?
No, in our total portfolio of 14.5 million ton, which is operative as of now, some volumes we contracted of late will start from 26. So out of 14.5, we have 5.8 million ton coming from US. Yeah, so and you also mentioned that our trading income is the main source of our income in total income. I would tell that the stable line of income is the transmission revenue from natural gas as well as the LPG transmission. And there is some variability in marketing income. But that also we have seen that of late there is a great predictability, and as we have been giving guidance to our investors also, we are earning in the range of 4,000 to 4,500 crores per annum in that area also, which includes domestic margins, international margins, everything.
Okay, so that was our exclusive conversation with the GAIL chairman. Now, stock is going to be in focus. And look at what a couple of brokerage notes are also saying. Morgan Stanley is maintaining an overweight on GAIL with a target price of 284 rupees, saying that the narrative is changing. Volume is down 2% despite high global natural gas prices. India's gas demand is more inelastic to higher prices. They see a 10% upside to FY26 estimates with 4 new pipelines, and petrochem investments should outperform expectations. This should help improve multiples. EBIT volatility should increase in 2026. Investec on GAIL is also pretty positive. They've maintained a buy with a target price of 270 rupees. They say that gas marketing and LPG have driven the fourth quarter beat. So good set of numbers. Transmission, petchem soft. Petrochem EBIT was hit by lower plant utilization and weak product spreads. There's also a Macquarie take which says outperform on GAIL, target price of 200 rupees. They say the fourth quarter has seen higher marketing margins, softer volumes. Transmission volumes are below and should correct going forward. Gas marketing has offset losses for Petchem. They see mean reversion here as the gas marketing margins moderate and Petchem profitability improve. So quite a bit of excitement on GAIL. Bhavin, on the charts, are you liking GAIL?
So GAIL has been more or less in a trading range.
I think
Too close to about 190, 195 on the upside. So unless it does not break out of this trading pattern, I think we will be looking at a range trade in GAIL, potentially between these levels. If it breaks out above level of 195 on a closing basis, my sense is that it will move closer to 225, 230 on upside. And that is where the momentum should be stronger side. So we'll look to buy only on breakouts for this particular stock.
Okay, look to buy on breakouts. You may see one. Bhavin, thank you so much for joining us on this leg of the show. Avinash Gorakshakar stays on with us. We'll take a very short break and we'll be right back. Stay tuned for pre-open rates and top ideas this morning, including the big brokerage call of the day.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with.
All right, back with India Market Open. In conversation of Avinash Gorakshakar, and now joining in on the show is Chandan Taparia, Head of Technical and Derivative Research at Motilal Oswal. You know, we're getting these second names conversations these days going. Chandan, did I pronounce it correctly? Taparia?
Yeah, I think that's right, but I think the market view matters the most rather than...
Of course it does. So give us the market view.
You know, I think you'll be offended. I think you've spoken to Chandan at least 100 times.
Yeah. Just getting old, so don't matter. But Chandan, okay. So good morning to you. How are you viewing the markets today? Down a bit of consolidation yesterday, now up today. I mean, do you trade this morning on the upsides?
Good morning. Thanks for having me. So, like, we were having the clear view that every meaningful decline will be bought in the market given the price structure. The good part which happened is that market took support at 23,850, which earlier used to act as a key hurdle for the index. It managed to reclaim 24,555 marks, which is 61.8% retracement of the entire down leg from its top of 26,277 to 21,743 marks. It rallied by more than 900 points on Monday, led by ease out in geopolitical concerns. But yesterday it witnessed some profit booking decline. I believe the short term trend is positive and buy on decline could continue till Nifty holds above 24,444. I believe the immediate trend and structure will be positive for an up move towards 24,750 to 25,000. Those who are looking for positional point of view, I believe 24,000 could act as a major support to drive this rally towards 25,200 to 25,500. So looking for buy on decline stance in the market even after the yesterday's profit booking decline from higher levels.
Declines. Okay, so not necessarily buying today at that 100%, 100-point uptick, but buy on declines. Okay, Chandan, so in light of that, what are the stocks that you're recommending for this morning? Let's get that out of the way first.
Yeah, so I believe that stock specific action is likely to be better in this market scenario. We have noticed that yesterday when Nifty was falling from higher levels by around 200, 300 points, but selective sectors and stocks were really doing well. First is buy on BL. We have noticed that most of the defense name has seen the strong momentum, and BL is one of the strongest counter which has been making higher tops, higher bottom on the weekly chart. In fact, we have positive stance on counter like HL, BL, Paras, Mazgaon Dog, BDL. But here, as a conviction trade from defense, I would like to suggest to buy on BL. The stock is given a breakout, making higher tops, higher bottom. Momentum could continue led by short covering trigger. So one can buy with support of 328. And this stock has potential to rally to us 350, 352 marks. Second trading idea, that is buy on escorts. And I believe that most of the geopolitical concerns, Trump tariff, and other things are getting stable. And now the trigger will be monsoon and weather forecast. And I believe that could change the path for the rural economy and the sentiment from the rural agri income. So escorts will be on top radar. In fact, selective auto counter also started to witness buying interest. Escort has seen the decent run up, managed to hold the key support zone, negated is lower top, lower bottom on the weekly chart, formed the rounding pattern. So recommending to buy with support of 34.25, and escort has potential to rally towards 36.50 levels.
Okay, all right. So those are the buy calls that Chandan has. Avinash, quick view on Bharti Airtel. We haven't asked you what you thought of the numbers. The net profit better than expected, but there were some tax reversals there. The ARPU number coming in at 245 or thereabouts. What do you make of it?
No, I think largely inline numbers. I think obviously, there were some tax write-backs, but I think if you look at the operational performance, Alex, I think numbers have been much better than what the street expected. And our sense is that, this ARPU number could possibly get a little bit enhancement going forward. Overall, I think the 5G rollout for them has been pretty good. I think they've been talking about further geographical rollouts. So I think my sense is that typically this performance in this kind of market clearly undermines the fact that they've actually enhanced their operating profitability in a big way. So I think definitely not a bad performance, but yes, I think probably we'd like to hear further some sort of management commentary from the management today in the conference call, and that can give a better kind of visibility to the numbers going forward.
Surely, Bharti Airtel in focus was Bharti Hexacom. I'm just going to pull that, pre-open session has begun, couple of minutes, and of course, these will settle, but 4.5% up on Bharti Hexacom. Numbers came out post-markets yesterday. Net profit up nearly 80%, 79.4% at 468 crores. Revenues were up 2% odd, EBITDA up 2% odd, and margins were about steady. So we have to look at what's really boosting that net profit number and whether those numbers are really looking that great. Settled in right now as well. What else is moving this morning? I want to look at a Garden Reach. I want to look at a Cochin shipyard and see what's happening there. Are you going to see continuing interest in it? Garden Reach firing on those numbers, and Avinash discussed it earlier as well. Let's pull up Cochin shipyard too and see what's happening there. Cochin shipyard also looking interesting. Avinash, just to take that conversation forward, and you said you're very, quite bullish on defense. You think that up move and that focus is going to continue for some time for defense stocks. What would be your favorites here?
I think clearly Garden Reach and typically even a Mazgaon Dock, Tamanna, I think numbers have been pretty solid. And today we'll be getting numbers from Hindustan Aeronautics. I think numbers are going to be pretty strong, and the management commentary is also good. As I mentioned to you earlier, the earnings visibility is very strong, and that is what is keeping the excitement alive here. markets are very confident that at least for the next 2 years, earnings growth are going to be pretty healthy. And as and when the government announces new orders, and they want to make more and more defense production in India, that itself is going to give a significant boost to most of these defense players. So I think, given the geopolitical factors, defense stocks will be in flavor. But I think even on a fundamental basis, if one takes the next 12 to 18 months, I think earnings visibility being intact, I think there could be a good amount of value buying, maybe at slightly lower levels, because these stocks are not very cheap. They're fair to expensive. But the growth trajectory for almost all the defense companies looks promising. And in that, I think HAL, Moscow Dock, typically, these are companies which you should watch out.
Avinash, quick view on Adani Ports as well. Asking because the last 1 month it's up close to 20%, 19% or thereabouts. And after its results, I think among the Nifty 50 companies, it's the best performer post results. What do you make of the numbers, one? And would you buy at this juncture as well?
Alex, I think numbers have been very strong, not only the quarterly numbers, but the monthly updates, in terms of the volume kind of growth. And I think, hopefully the coming year should be another good year, considering the fact that hopefully if the GDP growth grows at a fairly positive kind of traction, then I think, Adani Ports is purely an infra play and one of the best companies within the Adani group. We have been advising our clients to buy, at lower levels. Even at the current level, if one were to take the next 2 years in focus, I think it's a great opportunity to participate in the India growth story. But yes, I think an ideal strategy would be to buy it, in pieces. Maybe current levels you can buy a little, and maybe if the market corrects, you could possibly dip and buy more.
Chandan, are you looking at a Nykaa favorably? Of course, there's going to be some excitement in it because it's included in the MSCI list and there'll be more flows coming in. But this is not a stock that has performed fabulously in the last several weeks. How do you see a Nykaa?
Yeah, I see it very closely. Being the household name, and you can understand well. So looking at the chart setup, the stock has formed the rounding pattern on the weekly chart, has been making high top, high bottom. However, as per price, it has not performed much, but setup and sentiment has bottomed out. I believe that multiple support has took place at 155 marks, and after that slow and steady, the stock is moving upwards. The immediate support goes at 188, 190 marks, and with that support, it is potential to rebound towards 215 to 220 levels.
Chandan, please go to all of these online stores. A lot of products, grooming products for males as well. I think that's a big part of its boost too. But in terms of, just going to take that defense question to you on the charts too, Chandan, because still in focus, Garden Reach, Cochin Shipyard. Would you look at an HAL before the numbers, or what's the street's favorite right now, which is BEL?
So, in fact, I have positive stance on most of these defense names. In fact, I have recommended to buy on BL in the morning trade. But again, I would go for most of the name. If I start with BDL, that is Bharat Dynamic Limited, the stock has really rallied by more than 14-15% in this month and up by almost 55% in YTD basis. Stock has entered into the new lifetime high territory, completed a rounding formation of 45 long weeks. And I think this offers a fresh breakout, which could lead a rally of 15 to 25% from current zone. So I believe that BDL has given a classical textbook breakout. With this breakout, I believe with support of 1650, it has potential to rally towards 1900 to 2000 mark. So one should closely look at the counter like Bharat Dynamics. Apart from that, Pars Defense has seen a positive price pattern. It has been forming a bullish pole and flag pattern, which indicate the positivity in the counter. With support of 1385, it can head towards 1500 to 1550 marks. Apart from that, GRSC also looks good, and HAL can head towards 4800 to 4850. So positive on most of these defense names in this market scenario.
All right. So that's a comprehensive view on the defense stocks that are buzzing in trade today as well. Let's talk about the big brokerage call of the day. It's on SRF, and there are a couple to talk about, and Puneet joining in to tell you about that. Puneet, what stands out here?
Thank you for that. So definitely companies buzzing after its Q4 earnings, and most brokerages, while maintaining their views, they have high target prices. So cities actually maintain the sell view, and that's largely because of valuation concerns. They've hiked the target price to 2,375 from 2,000 earlier, and they mentioned a couple of key points. They mentioned that Q4 was ahead of estimates. It was very strong, and mentioned that the specialty chemical exports was something to talk about. They've also said that better refrigerant gas pricing, as well as domestic demand, has helped the company outperform in this particular quarter. They have also, the management has also guided for a 20% growth in FY26 for chemicals revenue, and that will be something to watch out for. In terms of Jeffries as well, they have also hiked their target price to 2,336 from 2,060 earlier. They also expect that the improvement in specialty chemical and refrigerant gases should be a key positive for the company, and largely because of valuation concerns, because the stock is up almost 32% on a YTD basis, and that's largely because of what's happened with the refrigerant gas pricing in the US. I think that's one of the key positives and only concern in terms of valuation. But business fundamentals seem to be getting back after a lean FY25. So hence, both brokerages, while maintaining their ratings, have high target price on SRF today.
Interesting. Thanks for that, Puneet. No big reactions, by the way, in the first 10 minutes on SRF at least. But, let's try and see if there are reactions on individual names in the session today on Nifty 500. I would suspect that Garden Reach Shipbuilders would be one of the ones which would have a reaction. We've spoken about that stock enough, but just wanted to mark 13% up for this one. This is a big move for GRSC. I wonder if the likes of HAL and some of the others also have moved, but Garden Reach, of course, has results to itself. Then Dalmia Bharat Sugar is the other one that we should try and point out and see if there is a reaction there. Dalmia Bharat is up 10%, very strong moves there. Bharti Hexacom is 5%. By the way, Cochin Shipyard is taking off from Garden Reach as well, so bear that in mind. Mazagon Dock, 3% higher. So, these are the ones which have really stood out in trade. Chandan, did we ask you about these names? And even if we have, now that the rates are known, would you buy a Garden Reach or a Cochin Ship or a Mazagon at the pre-open rates? They are 3-4% higher apiece, and Garden Reach is up 14%.
Quite comfortable for most of the defense name. In fact, have conviction that most of these stocks can see a rally by 10 to 15%. However, GRSC is opening by more than 10%, then we need to wait. But I can focus on other name, including Cochin Shipyard or Mazagon. So let me comment on the Cochin Shipyard. Even if it opens positive by 2-3%, one can look for buying opportunity. It can head towards almost 1750 to 1800 marks. In fact, Mazagon also looks good, which can rally towards 3200 to 3400 level. So if GRSC open much higher, then one can focus on Cochin Shipyard, Mazagon, HAL and BL.
Okay. Now, Sarma SGS is the other one, wherein the margin expansion was strong. I wonder if the stock has reacted positively or negatively because there was a revenue miss. Okay, no big reactions. So that's the other factor to keep in mind. Vinash, maybe Dalmia Bharat Sugar. Not usually a very discussed pocket in the last few months, but strong numbers, margin expansion, etc. The stock is duly reacting. Any thoughts here?
No, I think, for a long time, earnings growth was poor, and I think this quarter they have bounced back very well. So my sense is, Neeraj, I think clearly within the geographical markets which Dalmia Bharat operates, I think definitely, we are positive that going forward in the next few quarters, just, after the monsoon, of course, because during monsoon time, you see a little letdown in the volume growth. But overall, I think they are well positioned because they have added capacity. I think in this quarter, they got the benefit of some pricing benefit. So I think net and overall good performance if you compare it with the other larger cement players. So I think we are positive on the stock, but I think clearly we'll have to wait and understand what is the kind of growth commentary the management speaks for FY26. I think overall second half of FY26 should be a lot better. Even the first quarter is going to be slightly better than the fourth quarter, but the real growth momentum could be seen in the second half.
Okay. Let's pull up some of the banking names and see where they're moving. Smaller banks, Yes Bank, let's pull up. Actually, HDFC Bank not doing too much. Remember, it was a bit of a drag yesterday. RBL, let's see what it's doing. Let's pull up IndusInd. I know we have not spoken about it in a while. RBL is up about 1/3% or so. IndusInd about 0.6%. Even the PSU banking pack, let's look at something like a BOI. It was in focus yesterday, up and about on the back of its numbers. Bank of India is up about 0.5% or so. State Bank of India, let's pull that up as well and see what it's doing at this point. Only in the context of the possibility of a change in the consumer loan treatment based on measures taken by the Reserve Bank of India. Any quick calls, Chandan, in the banking space or even in the broader NBFC space? Anything stands out to you?
I'll focus on City Union Bank, CUB, one of the strongest price pattern I have seen. And the good part is that multiple year breakout is visible on the weekly and the monthly chart. Technically, it has given a breakout from its pole and flag pattern above 185, has given a consolidation breakout of last 15-16 days. So with support of 185, I believe CUB has potential to head towards 200, 205.
City Union Bank. Okay, watch out for this one as amongst the top trades from Chandan Taparia, and of course a clutch of those defense names would be in focus. There isn't too much really happening at the broader end of the spectrum, at least on the Nifty 500 beyond defense. Zentech out there and then a few others, and then of course some of the smaller names would be in focus. Wonder what VIP would be doing today. I think those margins were a bit of a miss, so that stock also could be interesting. Bharti Hexacom is the other one that should be in mind. But here come the first trades, and about 0.25% higher, so slightly underwhelming than what the implied open might have suggested, but we'll take it because banks are doing okay, maybe courtesy the inflation data. Again, no runaway moves, just about a basic 0.33%. IT is flat. Mid cap and small cap indices should come up on your screen. Defense, okay, thank you for pulling that up, 1.67%, courtesy Garden Reach and some others, I would reckon. Mid cap and small cap indices, 0.25% for the mid caps, 0.5% for the small cap index, much like yesterday, outperformance, which is welcome. Let's get the heat map up on the screen and show you what's moving and what's not. Tata Steel, the Nuama upgrade probably working for this one, 1.9 now 2% higher for Tata Steel. Shriram Finance, Bharti, Airtel, Coal India, Jio, HDFC Life. The life insurers also don't seem to have reacted too negatively. But I mean, yes, more green than red, but nothing really meaningful but for maybe a Tata Steel, which is up a couple of percentage points. There is some bit of IT making its way out there with a tech Mahindra and Infosys in the top 10 gainers. Slowly the quantum of red is enveloping it. By the way, we are turning flat. What's not doing well? Tata Motors results reaction, Cipla, brokerage notes, not all of them very constructive, I reckon. Hero MotoCorp again, I think after the results yesterday, which were largely in line, I think one of the notes termed it as unexciting. Maybe that's the reason there. And then the likes of Asian Paints, Eicher, etc. So some result reactions in the bottom half, especially Tata Motors, and on Cipla, the brokerage notes, and Tata Steel, clearly that Nuama upgrade working on the stock.
The results is going to be key, and you're seeing with that we gave Tata Motors a thumbs down this morning. That's exactly what you're seeing. We gave Bharti Airtel a thumbs up, and numbers were largely in line, and so you're seeing a spot of green over there. But let's pull up what the broader markets are doing. A quiet kind of a morning, definitely not negative, but no fireworks there. As soon as we start, about 50 points up on the mid cap 150, the small cap doing slightly better than the rest of the indices, actually about 0.5% up nearly. India VIX down, which is a good sign. Here you're seeing some, relief coming in, and of course the volatility index down, always good for the markets technically as well. No clear breakout right now. I'm going to pull out the sectoral indices to just give you a sense of what's working and what's not this morning. India Defense, no stopping the rally in defense stocks. This is something that we've been saying the last several days, even on the day that you saw a pullback in defense stocks and a bit of profit booking, that India is going to buffer up, and the Make in India aspect of defense companies came out in full glory during Operation Sindoor. So that's what you're seeing there. Nifty Metal, yes, as worries ease for US, China, trade, war, recession on a global stage, you will see metal stocks picking up, and that's what we're seeing over here. IT doing okay once again, but largely mirroring what we saw in the Nasdaq overnight. On the downside, Nifty Pharma, Nifty Healthcare, both showing another down day. Remember, it's a bit of a seesaw over here because no clarity out there on what the extent of impact is going to be. I had a conversation yesterday with Biocon, Kiran Mazumdar-Shaw of Biocon, who says that biosimilars and generics will be left out completely, and this is going to impact big pharma in the US more than any Indian company, but that's not what the street is saying. Auto stands out for the weakness, and between Tata Motor and Hero, if there's a negative view on both, that's likely to pull the entire index down, and that's possibly what you're seeing as far as the auto pack is concerned. Let's talk about specific stocks, because that's where all the action is. It's all stock specific. It's all about results right now. And we'll pull up the first set. Can't not talk about Garden Reach. I mean, Garden Reach, great set of numbers. We had an analysis from Anushi. We'll get her back to look at it in more detail. We're hoping to speak to the management at some point. 11% up. And this is just core numbers. It's not only maybe a bit of boost coming in from that defense rally, but Garden Reach doing well. Bharti Hexacom also, I mean, a lower tax has aided their profit number. The rest has been pretty flat, but the street is liking Bharti Hexacom also, getting the benefit of what we're seeing in Bharti Airtel. Dalmia Bharat also looking good. Dalmia Bharat Sugar looking good because of the numbers. Some more numbers that we want to look at this morning. GSK Pharma, Sirma SGS, GSK Pharma on our watch list. Mentioned it this morning. A beat because of volume growth on all fronts. All metrics were looking good. ITD cementation as well. Sirma SGS, not so much. Stock about 5.5% down. Street's not liking those set of numbers. Let's pull up a Siemens, a Metropolis, a VIP. Siemens okay, actually the numbers weren't that great, but the street is not punishing too hard. Metropolis was a miss. VIP Industries, another quarter that's looking quite poor, frankly, for VIP Industries. So that's in the boondocks right now. But defense is the story this morning as well. I mean, I don't know, maybe we're talking too much about it, but then you have an opening like this every single day. So what are you going to do in the last 3 days? Cochin Shipyard 6% up, Zentech 5% up, Mazgadox also looking very robust this morning. I want to see what some insurers are doing. You had insurance numbers for the month out yesterday, so I'm going to pull up Go Digit, LIC Housing, flat actually, not too much pressure showing at this point, though the numbers weren't that great. So this is what I'm spotting in the first few minutes of trade, Alex.
And very interesting names at that. I also want to pull up Raymond because it trades ex demerger today, and of course don't be alarmed by the price. That's the reason why you're seeing the price at actually it is not reflected yet on that screen, so we'll have to pull the number up. What I can see on the screen is 980 or thereabouts. Sirma is not doing particularly well, down about 5.5%, reacting perhaps to that revenue miss. And you have Ather. I do want to point that one out as well. Ather Industries, not energy. And this, remember, is an OFS that is underway. Yesterday, the non-retail portion got oversubscribed, and the clearing price that was announced was 725 or thereabouts. And so you have a gravitation of the price towards that mark of 725 or thereabouts. It's down about 4%. Remember, today is the retail portion where 10% of that OFS or offer for sale is offered and can be bid for. Watch out for that as well. VIP Industries reacting negatively to numbers which were not very pretty, down about 4% or thereabouts. From the broader markets, not doing particularly well. Coromandel is something that was expected to be in focus on account of the MSCI update that came through. It's losing about 3% in trade today. So quite a few of the stocks that we're mentioning today were expected to move. Avinash, very quickly, let me come to you on Ather. There was expected to be that gravitation towards the number that was decided on the OFS, and that turns out to be a 725 rupee clearing price. If you do have the opportunity, would you look to participate in the OFS as a retail investor?
See, Alex, I think the empirical evidence is that whenever companies do OFS, the stock prices react negatively. So I think it's better for the OFS to get conclude and then take a call. I think Ather Industries is a very well-known, good specialty chemical company. Their earnings have also been pretty strong. But I think looking at the OFS as of now, I think it's better that investors should wait for a couple of days. I think we could see lower levels, and at that point of time, maybe one could make an entry. I think the OFS does not offer a very big incentive for investors, because the market price is around 735 and they're offering it around 725, 26. So I think there's not much, kind of arbitrage here. So I think to that extent, the OFS can be given a miss, but I think overall, if the stock corrects below 725, I think one could definitely accumulate it because we expect better numbers for FY26 going forward.
Okay, interesting. So watch out for 725. It's not too far away. In fact, it could move towards that over the course of today and tomorrow. I do want to take a check on Sirma and on the technicals as well. Chandan, if you will, is down about 5% or so, reacting to perhaps the revenue number, not as much as the profitable or the operating profit number, which we were pointing out earlier. What do you make of the move on the charts?
Yeah, so looking at Sirma, it witnessed a recovery in last 4-5 days from 445 to 550 marks or 573 in fact. But today it witnessed some profit booking decline. I believe let it fill a gap which it kept near 510. So I believe it can correct till 510 before starting the next move. So I think some more decline is required to get some stability in the counter.
5.5% lower. I'm looking forward to the conversation with the management because this is something that they had guided for as well. I wonder if the street is terribly disappointed with the extent of the revenue miss because that is probably something that explains this. I, for one, thought that the street will be happy with the margin expansion, but clearly that hasn't happened.
Generally work on wafer thin margins, don't they?
Yes, they do.
And 500 basis point expansion in margins is
for an EMS company is significant
because EMS companies operate on 5% margins.
Well, but clearly, I mean, market knows it best. So interesting, but yeah, this is something that has happened. Chandan, just one quick word from my end before we let you go. Some of the stocks which had some very high delivery percentages marked yesterday. I wonder if you looked at, or if any of these excite you. Hyundai, ICICI General Insurance, Mankind Pharma, or Westlife. Each of these had nearly 72% quantum mark for delivery yesterday.
Yeah, so I'll focus on two names. One is the ICICI GI. In fact, selective general insurance counter has seen the good recovery and the support-based buying, and I believe some strong accumulation is happening in this name because whenever the delivery percentage goes beyond 60-65%, we consider as some support-based buying or the accumulation in the counter. So those who are looking to buy it can accumulate with support of 1800, and it has potential to rally to us 2000 marks. Talking about Westlife, yes, here also the multiple supports are visible. In fact, the accumulation is happening from last 45 days. And in last almost 45 days, 4 to 5 times, we have seen better than average delivery volume, which also indicate the accumulation in the counter. It has taken multiple support at 650 marks and now holding above 700 zone opens the upside to a 770, 800. So both the counter looks positive for 10 to 15% momentum over the next 3 to 5 weeks.
Not a stock that we talk about very often, but kitchen appliances company Butterfly Gandhimati. It's only 1,400 odd crore company. I'm not sure, Avinash, if you track it actively, but it's up about 8% or actually 7% right now. Anything stands out to you that you've seen in the recent past?
No, I think they have a largely South Indian market for their products, Alex. And I think numbers have been much better than what the street expected. So my sense is, I think with the rate cuts announced, with rural demand, getting better likely because of a better monsoon, at least those are the broader expectations. I think you could see a better traction even in the April to June quarter. I think my sense is the second half is normally supposed to be much better than the first half. But overall, I think, looking at the kind of uptick in consumption, I think hopefully, this company should do well. If I'm not wrong, Alex, this was taken over by Crompton. So I think it's part of the Crompton group. So, the geographical reach, which, Crompton benefited was the deep penetration in the southern market. So I think net, it's a good company, but I think overall we'll have to see whether this kind of performance, obviously gets repeated and the growth momentum is sustained.
By the way, Raymond is X, that demerger, etc., which is why this downtick. Sirma is interesting. Man Industries, 5.5% lower as well. So that's interesting. Birla Corp, yesterday's key gainer, down about a couple of percentage points. By the way, Chandan, we'll let you go on that note, of course. Thank you so much for being with us and giving us your thoughts. Really appreciate your time on that. Avinash, some of these pipe companies, long forgotten, and after having some very strong promises like Man Industries, for example, very strong promises about FY26 and 27, at these prices, the valuations seem very, very reasonable. Any thoughts?
I think my guess is that companies which are catering to the oil and gas sector, I think, Neeraj should do well. I think most of them are sitting on reasonably good order books. I think apart from MAN, Maharashtra Seamless is also a very large player. So my guess is that you have been right. Valuations have also come off. Hopefully, if, commodity prices don't go up, and the volume pickup happens, then I think, companies like MAN, Maharashtra Seamless, I think would be good bets. I think definitely we'll have to see better numbers coming in from the April to June quarter. But looking at the kind of order books these companies are sitting on, my sense is at least FY26 should be a lot better compared to last year.
Okay. All right. Let's pull up what GAIL is doing. I wonder, because we discussed it at quite a bit of length and we looked at a few brokerage notes as well. Okay, up about 1% or so. Avinash, if I remember correctly, we haven't yet spoken to you about GAIL numbers. What do you make of it, and would you buy at this point?
Yeah, I think, Alex, numbers have been much better. And I think, the management commentary clearly indicated that if they are looking at a 7 to 8% growth in volume, hopefully if the prices come down, then I think the volume could be much better. I think clearly GAIL is in a very unique position in the transmission piping business. They had a little bit of letdown in the petchem business, but I think if you look at the overall growth trajectory, I think at around 180, 85, it's not a bad deal considering the fact that we expect a reasonable amount of volume growth in FY26 also. So I think it's a good bet if one were to take a reasonable risk reward. 18 to 20% upside in the next 12 to 15 months very much looks possible. And I think it's a reasonably well-managed company within the PSU pack.
Okay. All right. Avinash, thanks so much for joining us this morning. Pleasure having you on the show as always. And thanks so much for taking the time. All right, let's talk about the markets. By the way, we've moved up from the low point of the day, and it is about 0.6% higher for the Nifty 50. In fact, at the high point of the day, holding above 24,700. And as you saw yesterday, the broader markets are outperforming once again. The mid-cap index gaining about 0.8%, and the small-cap index up about 0.7%. Very quickly, if we can, let's pull up the advanced decline ratio. Half an hour gone for today's trading session. So that should give you enough time for the dust to have settled, and it is looking like a pretty picture. On the other side of this break, we'll be joined by Ravi Menon of Macquarie Capital, and we'll take you through what he has to say about the trends in the IT pack. We spoke about that earlier in the week. We'll remind you if you've forgotten to. Stay tuned.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest
Let's focus on IT for a bit. The sector has been in focus since the last 2 days, especially after the 6% recovery in day before yesterday. But there are other things to it. With the US-China overhang subsiding, the street maybe expects or doesn't expect too many sharp cutbacks in IT spending. We will speak to Macquarie Capital's Ravi Menon about this note that he's written. But before that, let's get in my colleague Puneet to give us some highlights of the report. Puneet.
Well, thank you for that. So while quarter four results was nothing home to write about for the IT sector as a whole, the US-China trade deal essentially and a pause essentially is something that the analyst Ravi Menon has mentioned in his report. He's seeing that there could be not likely any kind of sharp cutbacks in the IT spends in the wake of the current tariffs, and he's also mentioned that the US-China trade deal would actually give confidence to firms to embark on large IT programs going forward. The key monitorable, of course, because he's continuing to be optimistic over the medium term as well and seeing a multi-year technology refresh due to significant changes in hardware. And what's interesting is he's highlighted that there could be a super cycle essentially in spending of IT hardware that's similar to the 2000s. And that's not something that the other analysts are anticipating, because quarter four earnings, as I mentioned, is nothing much to write about. So I think more in terms of macro view, what is something to talk about? That's something I would like to know from the analysts, as well as some key top picks, because we're seeing some niche mid-cap IT companies reporting decent results in terms of deal wins. So is that the way forward, or is valuations for large-cap IT more favorable? These are the two key questions like I would be really interested in to know from this particular chat.
Okay, Puneet, thanks for that. And the idea of calling, Puneet, thanks for that, of course. The idea of calling Ravi Menon was, amongst all the things in the note that he's written, in the what now section, Ravi mentions that they expect enterprise technology architecture changes. The drive for that would mean that we are in a multi-year super cycle of spending, the first since the 2000s when we saw the adoption of web technologies. Ravi, great having you as always, of course. Thanks for joining in. Neeraj here, good morning. But, usually we start with the beginning of the report. I'm starting with what you wrote at the end of the note because it really caught my eye. What do you mean when you say this?
I believe that this is a long cycle industry, right? And so the cycles are like, it might take 20, 30 years. And we might have like a 10-year upcycle and then like a 10 or 15-year kind of moderation. And that happens because for large changes in technology, I mean, like right now, for example, all this excitement about AI, we would not have been able to have that excitement if it hadn't been for solid state, storage prices dropping over the last decade, or network latency dropping over the last 10, 15 years. So if it weren't for all that, we wouldn't be able to use the cloud. We wouldn't be able to have real-time data processing capability. All this has emerged so that now when, the computing power for AI has emerged, it can actually, it's at the right place. Everything is coming together. So that's why we are really excited about this. I haven't seen, I think, something like this since, the web browser really opened up, I'd say, the interaction, for data outside the enterprise firewall.
Okay. So, Ravi, by the way, this is Neeraj here. Puneet was my colleague who just spoke earlier about your note. But yeah, just trying to understand. So what is the implications of something like this? I mean, it sounds great to hear about a multi-year super cycle. I mean, how do, for example, Indian IT services companies participate in it? Or would it largely be product companies? Or would IT services also have a part to play? And when it's a multi-year thing, is it a large portion of the revenue share of some of the Indian IT firms, be it ER&D product or services?
It will be this will be a large and growing part of it. I would think that, think of this as an extension of the digital transformation wave that we started seeing in 2019, right? So this is, I'm not saying that we will have, the industry is so large that the large cap companies are so big. We are not talking about, 20% growth for a TCS, right? I mean, that's not what we're saying. But we think the overall industry can actually be in like a 10 to 12% sort of growth range. That's the possibility for 3 to 5 years or even more. And I think that itself, and with the mid caps, of course, growing much faster than that, and select large caps within that, like a smaller one, like an HCL Tech, probably even delivering 12-15% growth, quite possible. And that's what we think. And it's and software services firms, I think that, rather than product firms, this is, I think, going to be a lot more services driven, because AI, I think, is what each enterprise wants to do with AI. It's going to be unique to that particular company, and what will be the priorities will also be unique. So I don't think that we will see really product companies do as well as services companies here. I think it'll be a lot of custom builds, in AI.
In some sense, then that's a bit of a vault face, right, Ravi? Because hitherto the last maybe 10 years, and correct me if I'm wrong, but product companies have actually outpaced service companies' growth. You reckon that the ushering in of AI plus this enterprise hardware, etc., change could all mean that IT services have the field set for them? Who captures how much is anybody's guess, but the set is stage for IT services companies which can capture the growth wave to actually do better.
Absolutely, Neeraj. I mean, that's what we think, that SaaS was actually expected to make everything redundant, right? I mean, people are thinking that first SaaS and then the whole idea of low code, no code like ServiceNow. People were actually thinking that'll mean the death of services companies. With low code, no code like ServiceNow, people said that, this will all be done by business users. There is no need for developers anymore. Even with AI, we actually have kept hearing that, right? That we won't need developers anymore. I actually think it's exact opposite. We will see a lot more use. Yes, there will be productivity benefits, but I actually think that a lot of AI use will also be opening up a new market that we've been hearing of for the last 30 years, but was always I think people didn't want to sign off on it. That is the legacy modernization bit. Now, why would you want to replace a perfectly well running system at great cost and great risk? So no one wanted to do that. Now, I think with AI, the risk is lowered, the cost is lowered, and legacy modernization is another very good opportunity. And I think that part of it is really something that I would say works better for the larger firms. They already are incumbents there. They have the knowledge about the customer system too. So I would think, someone like a TCS, I think, should be in a good position for that. TCS are top pick among the large caps because of that, as well as margin expansion possibilities. HCL Tech is our number 2 pick. If we take a medium-term view, we actually prefer HCL to TCS. TCS more from a short-term perspective. Among the mid caps, we also like Persistent Systems, because we see them as a very good challenger vendor in this system. And then we also see their AI investment, where they help software product companies develop products that actually they've extended. They're also looking at helping enterprises with AI adoption and to roll out releases faster using their trademark AI platform, I would say, called Sasva.
Ravi, hi, good morning. Tamanna here, and great to speak with you again as well. I'm just wondering, the theory that we're looking at and which you're working with, the premise you're working with, that there will be a long-standing refresh and the worst may be over for Indian IT as well. Do you think that that's pretty much been priced in? And while you've given us your 4 topics, do you see the sector now clawing back from the pain point over the last several months?
Yeah, no, absolutely. I think that the large caps are at very attractive dividend yields. So I think that this is really where the bottom is. We've been saying that at 4% to 5% dividend yields, the large caps are very attractive. And this is, I would think of it as a growing and dollar index sort of dividend yield. So pretty attractive. And even for retail investors, I would say a large part of that is tax free. If I understand correctly, our tax rules maybe stake on that. But that's why I think this is really attractive. The mid caps, I would think one is looking at higher growth prospects, and it's not so much of the dividend yield, but the growth that we're looking at. So we prefer firms that are fast growing with the mid caps, and within the large caps, we're looking at both growth and dividend yield as the reasons for it. And that's why we picked HCL Tech over the medium term, because they're paying out 95%, and their cash flow generation is a little higher than TCS. So HCL actually has a potential to pay out a bit more and even some dividends. And being a smaller firm, we also think faster growth is possible for them medium term.
Now, so what is the potential risk to this move going forward? And I'm asking from the point of view that US and China have hit pause for 90 days. We are in an era where anything can happen, and which is, you're seeing that uncertainty in the, I mean, to be fair, this is a here and now kind of situation, right? And you're seeing that uncertainty that I'm talking about reflecting in management commentary as well. So while as things stand now, yes, perhaps one would concur that the key risks are over and there will not be such demand destruction. But what would be the potential risk to this?
Well, the biggest risk is that the uncertainty just continues, right? But I think people know that at least with this dialing back of the tariffs, that there is a limit to how much damage I think the US is willing to do to itself and to the world, right? So there is, I think that gives people, I think, a bit more confidence that things are not going to get out of hand. We are not definitely going into a situation where there is a deep recession or significantly high inflation or anything of that sort. There is a push to realign global supply chains, and that will take time, and that's something that I think the US now has acknowledged, in the way that they're renegotiating. So I would think people will, and we had seen in April, that companies came out and most of them were saying that clients have actually not cut back on programs. People have some, even paused some, but even that, not really seen a lot of that either, right? You had large programs, decisions were being postponed, but otherwise no real cutbacks to spending. And that's exactly because of uncertainty, right? You didn't know, and some of those could be dialed back quite quickly, and that's actually what we've seen. So if anyone had cancelled large transformation programs, especially ones where I think there is some urgency, like an SAP HANA upgrade, where the sunset is now 2027. If you're a large enterprise and you didn't start this year because you were afraid of the tariffs, well, that's actually now an opportunity missed, right? So that's why I think people will really get emboldened by this and say that the guys who stayed the course, they've actually won this round. So people will now, I think, start looking at larger transformation programs. It'll be cost takeout plus transformation mix, but I think that we will start seeing larger deals now.
Ravi, it sets the stage for some very interesting commentary monitoring in Q2 from our IT companies. And as you're speaking, of course, Nifty IT is up 1% today. So some recovery out there. But thank you so much. Lovely note, of course. So good that you wrote that. And thanks for talking about it with us.
Thanks so much, Neeraj and Tamanna. Thank you for having me.
All right. By the way, Nifty IT up 1%. The market breadth is very strong. Nifty small cap is up 0.89%. Look at the advanced decline ratio. The gap is widening in early trade. This is great for a day trader. Just look at that kind of move. Very, very strong. But what we do is we take a very quick break. Come back and talk to Prasad Patwardhan. He's the CFO ITD Cementation. We'll come out with the good numbers and some order wins. Stay tuned.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Welcome back. It's India Market Open and the party has started. It took a bit of time. We had a muted start, but there's nothing muted about the kind of up move we've seen on the markets right now. Right after that, very dip that we saw in the morning, you've seen markets roaring back. The Nifty at 162 points up above the 24,740 mark. Are we going to inch up further today? Well, it's going to be stock specific, sector specific as well. And let's put the focus on ITD Cementation. Q4 profits have jumped 27%. Margins have expanded as well. Good set of numbers. Stock is roaring this morning. Anushi is joining in with details on what has worked. Before we speak with the management, Anushi, very quickly, give us a recap.
Right, so what has happened is, as we've talked about the numbers, we've seen about a 10% of a jump. Margins have expanded majorly in line in their guidance of 9 to 10% is what we are looking at. It's the order book in focus now. Now they've clocked in order inflows of about 8,000 crores or 7,100 crores in FY25, which is lower than the guidance of 9,000 crores. A commentary on that is important to watch out for. The growth number also, if you see the revenue growth, the long-term projection is for a 22 to 25% growth. So how does that stack up for FY26 is something we should be watching out for. Order book stood at 20,044 crore, and this is about a 3.9 times of a book-to-bill ratio that we are looking at. In the client mix, we see private sector contributing to about 82% of the mix, while government and PSUs contribute about 13% and 8% respectively. So this is the overall setup that we are seeing for ITD cementation stock in focus on the back of its Q4 numbers.
A very strong set of numbers, and in fact, let's start that conversation with Prasad Patwardhan, the CFO of ITD Cementation India. Mr. Patwardhan, thank you for your time here on NDTV Profit, and it looks like a solid set. What has worked this year, very simply put, because you've seen a revenue growth of 10%, your guidance, revenue growth of 18% in FY25, long-term aim is 2025, so robust guidance as well. What has changed?
Good morning. Thank you for having me on your show. What has changed is basically we started with a very strong order book at the beginning of the year, and we were able to execute this project pretty well during the year. And that has contributed to the growth in top line of about 18% this year. And of course, the margins have also moved up accordingly. So it's basically the focus on execution and on the sectors where we have the strength and experience of execution from the past. So we are focusing on our business, and that is delivering the results for us.
Just let's drill down on that. What is there a change of strategy which will continue to yield such results? Because I'm seeing your margins going up to 10.5%. Is that the range you see persisting in this financial year as well?
Well, we have indicated in the past that gradually we'll see an improvement in our margins, and we are seeing that in the numbers that we are reporting as well. So while there may not be too much scope for the margins to improve, but yes, certainly our focus is on cost control and improvement of margins, and we'll see our margins inching up in the current year as well.
Mr. Prasad, what about order inflows? One that the flows are slightly lower than the guided one, but broadly, if I look at the order book trajectory and the book-to-bill ratio from March 23 to March 25 now, that number has come off a bit. I mean, is it that you are consciously bagging lower orders, or is it that the system is throwing up lower orders?
Well, we are not consciously reducing our focus on order booking, so that focus continues. But yes, our execution rate has improved significantly over the last couple of years. So, we were probably doing, 1,500 or 1,800 crores a quarter, which has now gone to, about 2,400 crores in the quarter gone by. So while the pace of execution has picked up, there have been fewer orders coming up for tendering. Last year, the first quarter was a washout because of the Lok Sabha elections. And then gradually the pace picked up at a much slower pace. Basically we saw new orders coming up for tendering at a slightly slower pace than earlier. But government continues to focus on infrastructure, and we are pretty sure that going forward, we'll see, order booking, the pace of order booking also improving in the current financial year.
So would you reckon that FY26 could be different? Is it possible to predict that? And what is the guidance that you are laying out for order bookings for FY26?
Well, order bookings is difficult to give a guidance, but we are pretty confident that the order book will improve significantly in the current year. And we should be able to maintain or improve upon the execution as well in the current year. So a 25-30% growth in top line is definitely possible in FY26.
Okay, just give us a sense of what is the outlook looking like, because private spends are, the private sector is a big part of your mix, Mr. Patwardhan. Are you seeing private capex picking up? Are you seeing green shoots there? What is the outlook in the conversations you're having right now?
Well, the capex in India typically is driven by the government, but in our order book today, we had a large road project that was under execution, and that is classified as a private order. There is one project that we are doing in Bangladesh, which is also getting classified as a private order. So because of that, the numbers look different in terms of the order book. The private sector contribution looks to be on the higher side. But by and large, the overseas orders may be from the private space, but the infrastructure development in India continues to be largely driven by government expenditure, and we are also seeing a pickup in orders, coming up, or tenders coming up from the private sector as well.
If I take these two orders into consideration, which you mentioned, which have been classified as private orders, if you look at it, optically correctly, what would be your private order book versus your government order book?
Well, historically, we used to have about, at least around 75% of the order book used to be government or PSU, 75 to 80, and 20% used to be the private sector order book.
So it's actually that right now as well. Do you see that continuing going forward?
Well, it could change a bit in the year. We need to see what sort of orders come our way. We are looking at, projects in the Middle East as well, and in some other geographies outside India. So it's difficult to predict which way it will go. But our focus is on orders in India as well as, some select orders overseas in some geographies as well.
And largely from central government and central PSUs, or state PSUs and state governments as well?
No, we have been focusing more on the central government and PSUs rather than state government.
Tell me a bit about your overseas book and how you see that panning out. Do you have any guidance in mind for the overseas order book?
Well, currently we are executing 2 overseas orders, one in Bangladesh and one in Sri Lanka. And we are looking at opportunities in other countries, closer to India, not only in Bangladesh and Sri Lanka, let's say in the Middle East or, some other countries as well. So difficult to project a number at this stage. It's a bit early right now, but we expect some orders to come our way, and we'll be able to speak more on it once we have more clarity on the timeline and the value of the orders that we are looking at.
Okay. Mr. Prasad, just one question. I know your private booking would be higher, but the feedback that we're getting, or rather when we do the research on companies that rely on state government capex, how receivables are ballooning there. Now, maybe where the industry hat, if not the ITD hat, or where both. And tell us for you as well, on the state receivables, are things really becoming a problem? And do you reckon that could be an issue that some of the other players might be facing as well? Because state government receivables are becoming an issue.
Well, it would be difficult for me to comment on state government projects and receivables because, we don't have too many orders from state government.
But in the ones that you have, you don't have an issue? Or
no,
do you?
We don't have an issue.
The receivables are coming on time?
Yes.
Okay, which is good to know. Fair call. Okay, Mr. Prasad, all the best with order bookings. More importantly, your execution seems okay. I think the order bookings, hopefully they improve. So all the best for that, and thank you for talking to us today.
Thank you so much.
That's Candid ITD Cementation talking about the numbers and the outlook ahead. The stock is up 10 or 11%. One large order win as well, by the way, 539 crores in Rajasthan. But exceptional showing on the bourses today. Tamanna, look at that volume picture too. 2.5 million shares traded in the first 1 hour for ITD Cementation.
Yeah, ITD Cementation in focus. I just want to pull up KPI Green very quickly because numbers have just come out. And here's what it's looking like. Net profit is looking robust, but we'll have to see what the internals are. You're seeing a bit of a spike there in the stock price as well as we're speaking, even as numbers are looking good. Perhaps, revenues at up 96.8% at 569 crores versus 289 crores. So good set of numbers there on the face of it. EBITDA is up 73.5% at 161 crores versus 92.9 crores. Is of course consolidated year on year. Margins have seen a bit of a dip though at 28.3% versus 32.1% for KPI Green. Nevertheless, the stock seems to be received well. Profit, as I mentioned, at 99 crores with quite a jump up. You're seeing that spike there. We'll take a very short break, but we're keeping it with markets, all of the action, and of course we have a fabulous conversation up ahead on the other side when we come back with Trin Nguyen, senior economist covering emerging Asia markets at Natixis.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
All right, back with India Market Open. Now let's focus on some results and then a conversation with Trin Nugent as well. But first, Cipla's Q4 con call highlights point to a strong growth trajectory with respiratory and neurology segments outpacing the market and consumer health segments. Sajid has details here. Sajid.
That's right. The Q4 numbers were pretty much slightly below expectation, with EBITDA getting hit because of the higher R&D expense and the net profit boosted by other income. But during the con call, the management gave a guidance of 23.5% to 24.5% for EBITDA guidance for FY26. They also gave a Q1 sales, US sales guidance of $220 million. But the street is pretty much looking at a flat growth for FY26 and FY27 with respect to US sales growth. The management didn't expect much because of the India-US tariff, which is at this point in time, and didn't give much of that. But there is no revenue guidance that's coming from the government, and that's primarily because of the tariff situation that the management is talking about. Now, there are certain growth areas which the management spoke about, which is respiratory, neurology, which has outpaced market growth, and they expect to do that. There is a lot of there's a pipeline of products in the respiratory, especially inhaler segments, but the management did not give out any timeline for that launch there. Macquarie basically has an outperform on Cipla with a target price of 1,875, and they're saying that operationally it is in line the Q4 numbers. Nomura on Cipla has a buy rating with a target price of 1780 rupees, and they're saying that the Q4 EBITDA was a miss, but outlook in line with estimates.
Interesting. Okay, Sajid, thanks for that. Now, Tata Motors in focus after their quarterly results were largely in line with estimates, but the counter is slightly wobbly today, 1.5%. Puneet Johnson with the details of the con call. Puneet, is anything in the con call that, or the results that has not really spooked, but brought the stock a little bit lower today?
So definitely it's the results that were largely in line with what the estimates were. Estimates were, of course, paved down in this particular quarter. But I think one of the key disappointments for this year has been that the company has not given any guidance for FY26 for Jaguar and Land Rover. Now, just one pivot, that the company is holding an investor day on the 16th of June as well as the 9th of June. The 16th of June will be in London for JLR specifically, and they've said they might give some qualitative highlights at that time. So there's not any confirmation if the guidance will come at that time as well. But overall, it's a very uncertain environment for something like a Jaguar and Land Rover, which is more than 70% of total revenues for Tata Motors. In the con call as well, they mentioned that they will be funding the capex for JLR, which is roughly between almost 24,000 to 30,000 crores for this year of FY26 via internal accruals only. So that's a positive. But they have mentioned that from UK to US, that will be a 10% tariff essentially for the Range Rover lineup. That was earlier 2.5%. So that should have some impact in terms of margins. But they've said that demand could, stay because it's an ultra premium luxury segment. But the key, I think, will be for the Defender segment. Now, the reason is that Defender is not manufactured in the UK. It is manufactured in Slovakia, which comes into the EU. And there the tariff is 25% versus 2.5% earlier. So it's a 1,000% increase in tariff for the EU market. And hence, I think that's the key reason why the management has highlighted for no guidance. So some more clarity there, because the Defender is a huge model in US. Apart from that, they've also said that in the PV segment, it's been a disappointing year. They've lost 70 basis points of market share to 13.2%. But they have 6 new models coming in, which includes refreshes. So that will be a key monitorable. And for commercial vehicles, even though the volumes fell 5%, the margins were intact and have actually grown in this particular quarter by 100 basis points. And for the year as well, it's up 100 basis points. So that's positive. And they'll be looking to gain some market share in the small commercial vehicles. But largely, it's a story of Jaguar and Land Rover. And I think investors will be looking out for that guidance coming in somewhere in mid-June during the Investor Day.
Okay. Thanks, Puneet, for that. Now, one is Tata Motors, the other one is Hero MotoCorp, of course, and there are a touch of brokerage notes today on Hero. The stock being mildly volatile in its own sweet way. But Puneet, what do these MNC brokerages have to say?
Well, thank you for that. So, brokerages have largely said that the numbers are largely in line for something like a Hero MotoCorp as well. But again, the estimates were very paved down. It was just a 2% growth in terms of revenue. And we discussed this in closing yesterday, that the margins also at 14.2% were just similar to last year. But, we've seen that, the target price of 4,260 on something like a Hero, they're expecting margins to be in line and expecting to be, somewhat higher than expected for JP Morgan. But the key will be the con call. The con call is scheduled at 10:30 today. So some more commentary there, because do note that they have had a CEO change there. So Niranjan Gupta had resigned after being at Hero MotoCorp for almost 8 years. And they have an acting CEO currently. So if there is any update there, that would be one. And the second thing from also the con call that I will be looking at is the domestic motorcycle segment. It's continued to fall for 5 straight months now. And I think that will be one of the other things, because for FY25, there was nothing home to write about for Hero. It was a 4% fall in terms of sales. So what lends to that? Because we've seen Bajaj also have 6 consecutive months of fall in domestic motorcycle segment. So those will be a couple of things, but brokerage is largely estimating that the smaller segment of EVs will be positive in the near term. But these 2 things will be something to watch out for in con call today.
Okay. Puneet, I have a follow-up for you. I know you've spoken a bit about some of these auto names, but Honeywell, actually, can we pull up that stock first? Honeywell Auto. We've spoken about Hero MotoCorp. Now, let's just pull up Honeywell Automation, because the stock, one of the reasons why the stock is seeing some gains is because while the numbers might have been, okay, and the margins might have been lower, but I think the numbers were above estimates, as a result of which some uptick here. Now, Puneet, lay it out for us. What did you make of the numbers versus estimates? And what is it that they've said in the call or the presentation, or how have you, which might have a bearing on what the stock could do ahead?
Well, definitely, it's the revenue growth was definitely something which was higher than estimates. It came in at roughly about 17% growth in this particular quarter, coming at 1114 crores specifically. Brokerages had anticipated, and while the brokerage coverage is a little limited for Honeywell Automation, they were anticipating a 10% growth for the company. In terms of EBITDA as well, as you rightly mentioned, it's down 6%, and that was because of higher commodity cost, among other things that impacted the EBITDA. And because of that, the profit is also down 5.6%. But the gross margin has improved significantly from the previous quarter. It's up 430 basis points on a quarter-on-quarter basis. But essentially for this year, it's been a tough year for Honeywell Automation, and going forward, I think the company will be looking to gain some of the share again, specifically in the global mandate. Now, Nuvama also had written a note on it. They have a target price of 33,400, and they've said that they see limited clarity on the global markets currently, and that could be a risk for global growth. They're also seeing how the global parent integrates Honeywell Automation in India, and if the share of business from Honeywell Automation can grow, something that's similar for all MNC companies like Siemens in India as well. But weakening exports has been something to watch out for over the next 3 to 4 quarters. That's what Nuvama is also anticipating. But overall, the share price in green could largely be because of higher than expected revenue growth, while EBITDA was expected to be down in this particular quarter.
Okay, Puneet, many thanks for that. Okay, now the other thing that has happened, viewers, is that Indians have stepped up and cancelled tours to Turkey and Azerbaijan. This is because Turkey and Azerbaijan supported Pakistan on the India-Pakistan clash, which has triggered hundreds of Indians to cancel these trips. Over 50% of the bookings to both the countries have been cancelled in the last 6 days. Ease My Trip reported 22% cancellations to Turkey and over 30% to Azerbaijan. The move follows the travel advisory issued on May 9th, of course, which advised against non-essential travel. But I don't think this is just that. This is the Indian Janata going out and saying that if there are countries which are not supporting India on the global stage, let's go ahead and hit them where it hurts the most. In fact, we spoke to Prashant Pitti of Ease My Trip about this. Listen into what he had to say.
In the need of the hour, where we see that there are certain countries where our travelers are traveling, and these countries have decided to be our adversaries and stand on the wrong side of the history, we have decided to issue the travel advisory to people who are traveling to Azerbaijan and Turkey. We did not boycott them or cancel their flights because for many people, Turkey is just a layover. So that would be too much inconvenient for people, because of which we have decided that we will issue travel advisory and ask people to travel only if they must, and otherwise not give our hard-earned money to the countries which are not in the favor of our nation and choose to be on the wrong side. The advisory, we were the first ones to issue this advisory. We welcome that many OTAs have taken the similar stance this time. In the Maldives, we were the only one who boycotted Maldives, but this time a few other OTAs have taken the similar stand as Ease My Trip. We welcome that. And since then, we have seen 22% cancellation on Turkey's side and more than 30% cancellation happening on Azerbaijan side. Now, if I must tell you, Indian tourism towards Turkey and Azerbaijan has been increasing rapidly since some time. Last year, around 2.5 lakh people visited Turkey and 2.3 lakh people visited Azerbaijan. And even if you take meager 60,000, 70,000 rupees spent per passenger, it equates to a very big sum of more than 3,000 crores put together for both the countries. And which we are advising to our travelers that these are not India-friendly countries. They should choose to use these monies in the neutral or India, pro-India countries. Neutral countries could be Thailand, could be Greece, could be Armenia. And our advisory is very well received by Indian public. After our advisory, we have started seeing boycott Turkey and boycott Azerbaijan campaigns also run on the social media, which I believe is the right thing to do.
Okay, you got the gist, viewers, and this is, to my mind, very welcome. In fact, I put out a post on X that we need to be, as Indians and having discretionary spend, we should exercise that right and make it count. And I am glad that some of this is happening. Let's see if it happens in the future as well. Now, one of the stock that has really reacted strongly is Garden Reach Shipbuilders. The net profit more than doubled in the fourth quarter. Anushi has spoken about it earlier, but now she joins in to talk about the reaction and the valuation comparison. Anushi, you did this in the morning, but the 14.5% reaction is very, very strong.
Right, Neeraj, what you're seeing is like not just today, Garden Reach Shipbuilders has been buzzing because of all the sentimental moves that have been taking place in the defense sector. Now, today's main peg was the Q4 results that we are looking at, the 62% of a jump, margins at 13.5% as compared to 18.9%, and net profit over 100% of an increase that we are looking at. Now, do note that, as said before, that Garden Reach Shipbuilders, they follow a S-shaped pattern in terms of where the revenue recognition is concerned. So, on a quarter-to-quarter basis, there is a lot of variation that we would see based on the kind of execution of orders that have taken place. So that is one factor to be considered as well, that what we are seeing for this quarter is not necessarily what would translate to other quarter, but it's the order book positioning which stands at an important juncture currently, as that would determine how the revenue visibility forward is going to shape up. Now, if you talk about the present order book, that stands roughly at 23,880 crore, and major projects which are there currently that are around the size of 10 projects, including 4 export projects, are to be executed in the next 3 to 4 year period that we are looking at. Antique on this has maintained a buy rating, their target price being 2024 that we are looking at. Now do note that they see company being in a favorable position for 2 large orders that are going to take place in FY26. So that would be one focus point. The order expectation is for next generation corvettes, so that is something that we should be watching out for. Order pipeline currently stands at the size of 1.06 lakh crore, which is 5 times of what the current order book is looking like. So that is another focus area that we have to keep in mind. On the non-defense side, the company is expected to increase their focus towards shipbuilding side and the green energy platform. So that is something that we should be watching out for as well. So overall, a pretty strong reaction that we've seen for Garden Reach in the quarter, especially considering the moves that we have looked at in the defense sector. Defense sector, as we said before, that currently the valuations is at the size of 50 times as compared to a 37 times if you take the last 3-4 years of average into consideration. So it is also the higher valuations are also because of the higher growth status that we have seen for majority of these defense plays. So that is something that again remains as a focal point for some of these key defense players that are there.
Okay. Anushi, thanks for that. So this is serious stuff, nearly 15% for Garden Reach shipbuilders. I wonder if some of the others have also reacted duly. I mean, there was some traction in HAL, I believe, and that's up about a couple of percentage points, but of course dwarfs the kind of gains that Garden Reach has done, and with reason. Now the other one to focus on is Lupin, and the reason why Lupin becomes important amongst all the other things is because it's got the lowest share of Revlimid. And now that the scares around pharma exports in the US are cooling off a little bit, it becomes important to know what the company will do in the results as well as the commentary that they would come in. And Hiral joins me right now in the studios, of course. Hiral, what is anticipated from Lupin in the quarter?
So, Neeraj, if you go to see, what's interesting with the Lupin is, in spite of all the concerns that we're talking about the trade war, the domestic market growth story is what is intact for the company, and that is what is going to drive the numbers this time around. If you quickly look at the overall numbers from a top line and bottom line perspective, a 12 to 13% growth in terms of the top line. Profit is an interesting one, 1.9 times is the kind of uptick that we're expecting in terms of profitability, and margins are also expected to improve substantially. Now, it's the recovery that they've seen in the domestic business as well as the new launches that they've done at the US markets. These are the two reasons that will drive their business this time around. Overall, the competition that they saw in terms of where albuterol goes, that is being partly offset as well. So interesting names coming in there. If you talk about the India business, a 13% year-on-year growth is what you're looking at. Overall, the other aspect that you need to consider over here is the launch of Tolvaptan tablets. This has just come in a couple of days ago. And they are going to be the only generic player for most part of 2026. And what Axis Capital had indicated is that this is a revenue opportunity for almost $150 to $200 million. And this drug itself will contribute 25% of Lupin's FY26 earnings. So that is going to be a strong point in terms of management commentary that we need to keep an eye on, because 25% of your revenues coming in from this drug is going to be crucial, and this will be a major driver for the company's performance from here on. The launch will also help them offset the revenue loss from Mirabegron in FY26. So again, a strong number that is expected. Commentary is also expected to be strong along with the new launches. So it's going to be an interesting one to watch out for.
Yeah, no Revlimid per se, right? The lowest share of Revlimid is...
Because you already mentioned that, I didn't refer to it. Right?
No, of course, but I'm just saying,
overall,
important.
Spectacular story with a Lupin. I think it is making a comeback somewhere.
Could be interesting to see. Looking forward to the commentary for sure. Okay, thanks for that, Hiral. Now, just continuing with pharma for a little bit longer. Cipla is the other one in focus, right? I mean, Sajid spoke about it a little bit, but here's the brokerage view on Cipla. So Nomura has come out with a view there, and they have maintained a buy with the target price of 1780. Now, if you follow Nomura's view, you would believe that this dip today gives you an opportunity to enter. Nomura says that the Q4 EBITDA is a miss, but the outlook is in line with estimates. And One India growth driven by acquisitions and growth recovery in trade generics and consumer healthcare. North America generics sales have declined quarter on quarter despite the ramp up of certain supplies, but the launch of differentiated low competition products are largely on track, and they are, well, sanguine on prospects of Cipla. So bear that in mind. Now that's the pharma roundup, but what about the earnings roundup? We're approaching the last leg, right, if you will, for earnings. 34 Nifty companies have already come in, so 2/3 is done. And so far, let's get in Mahima to tell us what is the overall rating of this earnings season. Mahima.
Right. So overall, if you see, around 36 companies have come out with their Nifty 50 earnings. And let's look at how these companies have overall performed. Now, in terms of out of 36 companies, 9 companies were beyond what the street was expecting. So they did better than the overall estimates. In terms of 6 companies, they were below what the street was expecting. So they were below than the estimated earnings. And 21 companies reported earnings in line. Now, in terms of overall sectoral performance, 2 sectors, that is your BFSI and healthcare, outperformed. In terms of the underperforming sectors, you had your IT as well as FMCG and consumption. And some sectors which were in line in terms of where their earnings stands, that includes your cement, your oil and gas, as well as your retail and jewelry space. Now, in terms of the outperformers and the underperformers, the top performers included Adani Ports. The stock has been up 8% since its earnings, followed by L&T, stock up 3% since its earnings. ICICI Bank and M&M both up around 1% since their earnings. In terms of what worked for these companies, Adani Ports, it did beat FY25 revenue and strong FY26 guidance the management has given. For L&T, order inflow was up 18%, exceeding the overall guidance of 10% and revenue growth did beat the overall guidance as well. For ICICI Bank, net interest income and provisions were better than estimated, and a sharp asset quality improvement was seen for this particular quarter. In terms of M&M, farm margins have surprised the street positively, and overall it is a positive start for EV, and brokerages have also penciled that in their ratings as well. In terms of top losers, Asian Paints was amongst the top loser. The stock has been hardly up 1% since then. Zomato down 1.15%, but Bajaj Finance and Infosys have seen a bounce back in terms of their stock reaction. But when earnings comes into picture, Asian Paints net profit was down 45%, weak demand to continue in Q1 FY26 as well. So the management commentary not looking very positive. For Bajaj Finance, negative bias was seen on the numbers, and overall FY26 guidance was also trimmed, which was seen negatively by the street. Infosys FY26 guidance was lowered and FY25 guidance was overall not met. And lastly, for Zomato, we've seen food delivery growth slowing down for this particular counter, and this time management did come out and acknowledge the fact that competition is playing its part and that it might put profitability under pressure. So this is the overall view as to how all of these 36 companies have performed so far from the Nifty 50 universe.
Thanks for that, Mahima. So that's the summation of the earnings. But what's the global view on let's say, India, for example, after 2 things have happened, that the US-China trade tariff war has de-escalated, and of course, we've now put geopolitics behind us in terms of the India-Pakistan thing, with India really coming out trumps. Trin Nugent, senior economist covering Asia at Natixis, Johnson right now on the show. Trin, always a pleasure talking to you. And yes, I saw your tweet wherein you've mentioned that you're going to be on my channel, on my show, to talk about the US-China trade relations and the de-escalation and the prospects on the India-US deal as well. Thank you for joining in. First, Trin, because you speak to possibly a lot of your clients and your peer sets around what is the view on India, given the fact that, one, the trade tensions across the world have de-escalated, and on India's case specifically, the geopolitical stress is also behind us?
Well, I think India positioning with investors has increased a lot, particularly in this Trump 2.0 versus Trump 1.0. It's emerging as potentially a big winner when the reciprocal tariffs came out with Southeast Asia, countries that are very linked to China being severely targeted. Of course, all of this is very paused now, but India is emerging at somewhere that is close enough to be linked with China for supply chains, but far enough geopolitically to gain from this. And you can see that already with Apple, with the ambition of supplying US market from India totally by end 2026. So India is emerging. The question is how India is going to make sure that it's going to gain more of that. I think the Modi government is very aggressive this time around versus the last time. If you look at India trade liberalization, for example, we have the UK-India trade deal, which is not really talked about given the fact that Pakistan-India conflicts became much more prominent, and also what's happening with US-China. But I think that's an important point to highlight the willingness of the Modi government to look outward for growth. And I think that certainly it needs, giving the job issue onshore and finding more trade partners is very important. I think the EU FTA is under negotiation, will get pushed forward as well, and it shows the willingness that it needs to find markets to make India much more attractive. And finally, the US-India deal. That's one is a much tougher one to negotiate in the UK, obviously, given that it has a trade surplus and so on and so forth. But the reality is that India has a lot to lose relative to Pakistan in this conflict. And I think what it has to lose is not just the progress it's gained so far, but the potential of being the center of supply chains. And if the global economy is going to be more dependent on China, on India, not just for domestic demand for growth, because in terms of demographics and the ability of India, if it leverages itself well to grow from this low positioning of the corporates in terms of leverage, then it needs to have a lot of stability, and it needs to also consistently brand itself as a stable place to build factories. Because India traditionally has been very, very good at attracting portfolio flows, which is basically foreign investors buying equities or buying bonds. That is something that you can easily enter and easily exit. In terms of FDI, it's much more long term because you enter, but you don't expect to exit 10 to 20 years. And so as a result, investors are looking at a longer horizon. From my point of view, that although the conflicts escalated more than before, it's very clear that both on the Pakistan and India side, it doesn't want to take it to totality of war more than a deterrence. But walking from that edge is very important. In terms of prospects for foreign investors to look at this as a long-term investment thesis. And I want to emphasize that not just from an equity and bond portfolio flows in the short term, but long terms in terms of building plans and planting roots, deep roots in India for supply chains.
Got it. Yeah, and that point is well noted. But now that this is behind us, is the stress around, I mean, was there stress when the geopolitics started, and is it behind? That is the first question that I have. And then I also want to talk to you about the US-China trade deal. But first, this one.
I'm not a geopolitical expert, but I do think that, of course, I think fundamental issues are not resolved, so which means you had something in 2019, we have something again in 2025. It's been 60 years since the last major conflict, so I do think that it is coming again. But at the very minimum, we looked the last time as a benchmark. At the very minimum, we have some peace for now. The issue here is I do think that we're in a very fragile environment globally and geopolitically, and it's important to be mindful of the costs. And I'm very happy that I don't have that difficult position. But at the same time, I think to look forward to leveraging this to gain, right? And if you look at many of these conflicts, the big winner, if there's a Pakistan and conflict escalated severely, that probably would be China, because it's able to sell more arms to Pakistan, is also able to basically not have to consider India as an alternative to China as a reshuffling of the supply chain, as well as an alternative in attracting investment. Because in this environment where everyone is considering their over positioning in China's supply chains, their over positioning in US financial markets, the big question mark is where else then, right? And when you don't have another where else, that's a big problem. And I think India can be that place for global investors, not just short-term plays, but long-term plays.
Got it. What's your view on, let's say, Asia and EM, now that there is a less tension or less conflict on tariffs and trade between the two major economies as well, but even generally, or at least optically, there is lower stress?
Right. I think the key here is that since reciprocal tariffs, as you are well aware, there was a huge shock because everyone got a big tariff, particularly the Southeast Asian countries. Now, and for India, it got a pretty high level of tariffs, but not the highest. And also it got a bunch of exemptions, right? Semiconductor, pharma, ICTs, and so on and so forth. These are the exemptions for reciprocal, which India is what India trades, right? So for the terms of tensions, I think what's very clear for markets there is a Trump put. What that means is that while the U.S. may be the biggest consumer of global goods, it does need others to maintain its supply chains because U.S. companies are very, very interwoven in regional and global supply chains. And so as a result, it will have a huge impact on the industrial sectors in the U.S. So as a result, I think the positioning of India, the positioning of many countries have risen a lot, particularly when Trump went really hard on China. The de-escalation of China shows that at a very minimum, there is time for the pause. We have a 10% pause on reciprocal tariffs down for the rest of the world, for everyone, including China. China has an additional 20% on fentanyl. But for India, I think there is time to negotiate, and there are even though tariffs for the U.S. are much higher, they're higher in terms of relative to before Trump 2.0, but they can be lower on a sectoral side, right? The UK-US tariff deal shows that there's room for steel, for example. The UK doesn't face steel exports, but the UK doesn't even have enough for its own consumption. But it managed to lower auto. So I do think from India, there is room for sectoral tariffs to be lowered. There's room for further liberalization, and for many countries. But the worst of tariffs are behind us, but it's not totally behind us because I do think that President Trump is very committed to making sure the U.S. is self-sufficient in strategic sectors, not all sectors. For lower labor intensive, they're not very interested in. But I do think for high-tech sectors, and that means that there will be quite a lot of tariffs. The second thing is that it's very likely that they want to bring some of that closer to shore. The USMCA is an example where Mexican qualified goods that are USMCA qualified are tariff-free. And that serves two birds and one stone. And that means that the positioning of Southeast Asia, although it's risen above reciprocal tariffs today, is actually being questioned on a longer horizon.
Got it. Okay, out of time completely on the short train. But thank you so much for joining in and giving us your perspective. Really appreciate your time.
Anytime. Thank you very much.
All right, with that, it's a wrap on this leg of India Markets Open, with the markets being in reasonably fine fettle. Up next is Ask Profit.
That's huge. That is a biggie. It's out of it.
गोल्ड ग्लास क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Hi, thanks so much for joining in. You're watching Ask Profit on NDTV Profit. My name is Alex Matthew and with me is Mahima Vajrajani, and we will take you through the next 1 hour of trade. It's looking like a pretty picture once again for the benchmark Nifty 50. Indeed, for the broader markets, let's quickly take you through what's happening with the equity markets. After that bit of a breather that you saw in trade yesterday for the benchmark Nifty 50 and for large caps as a whole, you're once again seeing buying in evidence, and we're holding out with gains of about 0.6%, holding above 24,700 as well. And that's a level that you should watch out for closely. The broader markets continue their outperformance, and in fact the mid-cap index is close to the high point of the day, up about 1% or so. The small-cap index up about a similar amount, about 0.9% or thereabouts. And there's quite a few stocks in the broader markets that are doing particularly well. Among them, Garden Reach Shipbuilders reacting to earnings, doing incredibly well, and the defense pack once again buzzing. Look at that, 17% up, and this is a stock that gained, by the way, 5% in trade yesterday as well. Very strong set of numbers. The PAT number increasing, doubling, more than doubling, and the margins also improving very substantially. Of course, the revenue recognition for a company like this is S-shaped in that there are periods of lumpiness in the recognition of revenue. Bear that in mind. Something like a Dalmia Bharat Sugar is also doing incredibly well on the back of earnings. We'll get to some of those names in more details in just a bit. But first, let's go to an exclusive story. And my colleague Shrimi Chaudhary is joining in. As a fallout of the China support for Pakistan during the recent military conflict, the Indian government will be conducting tighter scrutiny or having tighter scrutiny on all deals, foreign direct investment and joint ventures backed by China. Shrimi is on the phone line to tell you about the key details here. Shrimi, what has emerged?
Yes, Alex. So this is very important information, what we've been given to understand that, following the China open support for Pakistan in a, recent military standoff, as you mentioned, India is tightening its grip on the FDI from Chinese entities. And of course, that is signaling a tougher stance on, economic engagement, which, foreign investment is, larger part of those engagements. So sources also tells us that India is intensifying all kind of scrutiny as far as FDI proposals from China is concerned, which include, 7 to 8 proposal, which is ongoing deals. What the sources tells us that under Press Note 3, which was introduced in April 2020, during that China-India border conflict, under that they are scrutiny each proposal which is ongoing and on table at this point of time. Remember that Press Note 3 mandates all the approvals from countries sharing a land border, including China, aiming to curb hostile takeover. So government continues to, assess each proposal on a case-to-case basis involving China FDI. But with recent development, this could delay the whole process, that it may go through rigorous compliance process for China-backed deals. And sources also tells us that domestic joint ventures with China firms are also being subjected to tighter regulatory checks. But Alice, there's some interesting fact as well that despite the investment restriction, if you see, imports from China have surged since April 2020, which that when the curve was imposed. But FDI inflows from China have continued to decline. And in some occasion in past also, some of the government officials have been pushing to ease the restrictions. But now the way situation are, evolving, China FDI may clearly face intense scrutiny, and we could even see further tightening in the current regime which is there as we speak. But possibility of that is not completely ruled out, is what we have been given to understand.
All right, Shrimi, thank you for breaking that. Thank you for breaking that for us. So FDI from China, the rules to get tighter going ahead is the overall summary of what Shrimi has told us. All right, with that, let's also welcome in our guest for the day, Vaishali Parekh from Prabhudas Leeladhar and Neerav Ashar from Latin Manharraj Securities joining us now. Good morning to both of you. My first question is from Debrata Joshi. She's holding United Spirits 10 shares at 1,412 rupees, and from a 6 months perspective, she wants a view on this particular counter. Vaishali, I'll come quickly to you. What are the charts indicating for United Spirits?
Very good morning, all of you. So I think, yes, it's in a trend, little bit of consolidation going on. So I think 1450, 1430 should act as a near-term support, and the resistance lies at 1630. Once we see the stock moving above 1630, it can go towards 1700, 1750. So that's the range that one should follow.
That's a view on United Spirits. Our first call of the day, by the way, in case you missed it, we didn't mention it today, but then it's pretty obvious. It's on your screen. That is the number that you can send us a WhatsApp message on, and the number at the bottom of your screen is the number that Ramesh has called us on, and you can call us as well. Ramesh, hi, thanks so much for calling us. How can we help you today?
Sir, very good morning.
Good morning.
HEIL, I have HEIL share 100.
Okay.
4,772.
Right.
Right.
Okay. So you've just bought it recently, is it?
Yeah, 3 months, sir.
3 months. 3 months back. Okay. So, and what is the view that you're seeking? Are you looking for a long-term view or a short-term view?
Short term, sir, please.
Okay, short term. All right. By the way, in case you didn't already know, Ramesh, the results are out today, so do watch out for that, either on this channel or you can check out the results on your own as well. But Vaishali, I'll come to you on the charts. This is part of a pack that has been absolutely buzzing in the recent past, and it's done quite well for itself. What levels on the upside would you watch out for?
Since it's for a shorter term period, I would say the view continues to be positive. Overall, full defense sector is doing very well. So I'm looking at a target of 5,000. So continue holding for a target of 5,000. And yes, so near term perspective, you can book profit at those levels.
And the company is expected to post its earnings as well today, so keep an eye on that as well. All right, the next question is from Ramesh, who is writing in from Bengaluru. He's purchased 75 odd shares of Tejas Networks for 730 a piece and wants to know whether he should hold or sell out. Nirav, I'll quickly come to you on this one. What's the view like for Tejas Networks?
Well, good morning and thank you for the invite. And I think Tejas Networks, she should continue to hold with a medium to long-term horizon because the prospects look to be improving going forward.
Okay, can you give us some more color on that? If you've studied the numbers, can you tell us more about that, Nirav?
Yeah, basically, I think what we are expecting is that the margin trajectory is expected to improve going forward. And we are likely to see the operating leverage kick in going forward. So I think that could augur well for the prospects of the company.
All right, fair point. Let's take another question, and we'll then go to Priyesh on the question that he has. Praj Industries is the name of the stock, and Dharma from Andhra Pradesh is asking this question. He's wondering what to do with this because he's bought at levels of 610, slightly elevated levels. He's wondering whether there's going to be any impact on account of Trump tariffs. I'm not very certain about that. It is operating in a space that caters to ethanol blending, right? So it's basically constructing equipment that facilitates that, among other things. What would you say about this, Nirav? On the fundamentals, would you hold?
Yeah, but actually, Praj Industries has been through a lean patch in the recent past, and because of the whole ethanol-related situation, etc., the company has been going through a tough time in the recent past. So I think what he can do is probably he should shift out of Praj Industries and move to some better options like a Triveni turbine or an Helicon engineering.
That's the view with regards to where Praj Industries stands, and Nirav has given options to switch to as well. All right, the next caller, Priyesh, is calling in from Jharkhand. Priyesh, a very good morning to you. How can we help you?
Good morning, ma'am. I have a question. I have Polycab shares. I have 40 shares, but I have sold 20 shares yesterday.
Okay.
I want to ask, I hold 20 shares of it or for lifetime high or sell it?
Okay.
I have taken it on 3,800 price.
Okay. All right. 3,800 is quite an attractive price to enter into Polycab and sitting on profits of 43,000. So, Priyesh, congratulations on that. I'll quickly take this up with Vaishali. Vaishali, in terms of the earnings, it was a strong beat across, and the 5-year guidance given by the management, it was also very promising for Polycab. But in terms of where charts stand, should he wait for touching the life highs is his question.
Well, that only time will tell, but it needs to cross 6,400 for this confirmation that yes, the trend is intact and still ready to surge high. So for now, wait for 6,400 levels. If it sustains above that, then yes, in all likelihood, it can go towards a previous high and even higher.
Okay, but would you suggest taking money off the table? He did so yesterday. Vaishali, what would you suggest?
I would say that trend is quite intact, but all the same, keep a stop loss of 5,800.
5,800. All right. Siemens is the name of the counter that I want to talk about next. It's in focus on account of earnings as well. And so, Nirav, from what I saw, and I just saw the snapshot of it, if I'm not mistaken, order execution seems to be been a bit of an issue, and margin contraction is what I saw. I may be mistaken because I saw quite a few numbers this morning. What do you think about Siemens?
Well, I think I would be positive on the numbers because we studied the numbers, and Siemens basically there's been a demerger of the energy division. That is one part. One of the divisions, that is digital industries, has been under some sort of pressure, but mobility and smart infrastructure businesses have been doing quite well. So I think the orders are up around 44% on a year-on-year basis, and that's a very positive sign. So I think we continue to maintain a positive view on Siemens. The profitability has been impacted by certain extraordinary items. So optically, I think the results look weak as far as this quarter is concerned. But if one were to remove the extraordinary items, then I think it's a pretty decent set of numbers.
Interesting that you say that. I was just going to point out that the PAT number is down about 25%, and the margin has contracted to 10.1 versus 14.7. But as you pointed out, certain extraordinary items, and I think the street is looking through that as well. Quite a bit that is playing out with regard to Siemens in terms of corporate actions as well. We've got a next caller from Chennai. Aditya is calling us. Good morning, Aditya. How can we help you today?
Hi, morning. So I bought Ramakrishna Forgings at about 690 on the 24th of April to hold it for about a year or so. But the stock has plummeted down, so I was wondering whether there's a good time to swap my portfolio or continue holding it.
Okay, so you would you have a one-year?
The other thing I would like to tell you is one out of the two stocks which are pulling my portfolio down. Everything else is looking good.
Everything else, and congratulations. I'm glad to hear that. But RK Forgings, would you say from this point you would have a one-year time frame?
Yeah, that wouldn't be a problem.
Okay. All right. So, Vaishali, on the charts, RK Forging, if I'm not mistaken, again, company that posted its numbers not too long back. What would you say about the upside potential?
The stock is really oversold, and if he's making loss in this, no harm averaging out, keeping a stop loss of 550, because once you see signs of reversal coming in, this can go towards 700 and perhaps 750 to start with. So in my opinion, do average out.
Do average out is the view coming in on the counter. All right, the next question is on Sterlite Technologies. Narendra from Hyderabad has bought 300 odd shares at 100 a piece and wants to wait for the next 2 years and wants to know whether they should hold the counter at present or sell. Nirav, any view on Sterlite Technologies?
Well, I think the stock has been a rank underperformer, and I think it's better to shift to some other better alternatives which would be available in the same space. So I think it's better to book out of this counter at least.
Okay, Nirav, would you be able to tell us then Sterlite Tech, alternatives to this? It has underperformed as you pointed out, but what alternatives would you pick and why?
I think there are better options in the defense space also. If you were to consider, then I think you can look for a BEL or something like a Bharat Forge, etc. As a better alternative.
Okay. So those are the alternatives to Sterlite Technology as per Nirav. The next question is from Puran Sai, calling in from Vijayawada. Very good morning to you. How can we help you?
Good morning, madam. I'm invested in ITC hotels.
Okay.
Today are the results right? I would like to know about the expectations on the numbers.
Okay.
And is it right to hold ITC hotels, or could I shift to some other hospitality business?
Okay, got your question. I'll take this up with Nirav. Nirav, overall we've seen IHCL, Ventive Hospitality, Chalet come out with their earnings, and all of these earnings, although IHCL was a bit of disappointment in terms of its guidance, but Ventive and Chalet comparatively were very good. Of course, in terms of scale, they are much smaller to IHCL. But your view with respect to the entire hospitality space, and of course ITC hotels, what are we expecting?
Well, I think the hotel sector has been performing quite well, and there are strong tailwinds as far as the sector is concerned for the next 3 to 4 years. But as far as this quarter is concerned, we've seen one consistent trend, that is there has been a sharp increase in the overheads as far as the most of the hotel stocks are concerned. We've seen an increase in the other expenses especially, which has pulled down the profitability. So there's been a slight miss in the PAT as far as the hotel companies are concerned. That's what we've seen in the numbers which have been announced so far. So I think this should be no different. There could be slight disappointment on the PAT front.
We've got our next caller from Belgium. Vashishta is calling us, and so I don't want to keep you waiting for too long. Vashishta, thanks so much for calling us. It must be very early where you're at. What do you want help with?
Yeah, so I hold 250 shares of Swan Energy, which I purchased about a year and a half ago at 465 rupees per share.
Okay.
Though it had a good run-up in the last year, but I was holding on to it, and I wanted to know what the view is.
Okay, so you've got a long-term view and you bought it based on the fundamentals, is that correct?
Correct, yeah.
Okay.
I was looking somewhere that the sum of parts valuation of this is much higher than what it was trading at, and that was my fundamental, yeah.
You mean it was much, okay, the valuation picture was, okay, fine. So basically it was undervalued. I got your question. Nirav, what's your view on Swan Energy? He's lost a little bit of ground, bought at slightly elevated levels, 460. Would you hold on to this?
Well, I think he should continue to hold Swan Energy because, of course, typically we tend to look at some of the part valuation when there is an attempt to sell the business or, going for some corporate actions, etc. But I think as far as the normal business goes, then we tend to look at the revenues from the operations, the cash flows, the quality of the cash flows, the free cash flows, etc. There's been a slight disappointment over there, but I think he should continue to hold in expectation that the things will only get improved from the current levels.
Okay, so that's the view with regards to where Swan Energy stands. The next question is from Rajesh Maheshwari, who's writing in from Indore. His query is on Tata Steel. He's bought 1,000 odd shares at an average price of 125 and wants to know as to what's the short-term outlook for this particular counter. Vaishali, in terms of Tata Steel, what are the kind of supports and resistance levels that you're watching on the charts?
I think the stock has got into trend. Volume is also on rise. So I think my view is positive. For near-term basis, the support lies at 145 and it can go towards 172, 174 for now. So we'll continue holding and look for the higher targets.
Targets is a view, continue holding is a view on Tata Steel. Numbers in focus, of course. Q4 numbers were posted not too long back. Elecon Engineering, and I know that Nirav just pointed this out, which is why I'm going back to him on this one. Shankar from Bangalore is holding at a price of 419 rupees, so he's in the green right now. He points out that based on his understanding, the price to earnings is currently just above the industry price to earnings. He's wondering whether to add more. I know that you have a buy call. Can you spell that out a little bit?
Well, yes, this is a very niche company, and I think we had a couple of quarters of underperformance as far as Elecon Engineering is concerned, but they have covered up their lost ground in the last quarter of FY25. This company has been into two divisions, that is gearboxes and material handling equipment. Material handling equipment is also making a strong comeback, and gearboxes has also been on the rise. So I think going forward, the prospects appear to be quite strong as far as Elecon Engineering is concerned. With respect to the price to earnings multiple, I think PE is assigned on the basis of the growth prospects of a particular company. So if the growth is able to, they are able to outperform on the growth parameters, then definitely we will see a strong re-rating going forward.
Okay, all right, so the stock has done particularly well over the last 1 month, as you can see, up about 50%. Let's talk about the next one, and we've got Sangeet that's calling us from Hyderabad asking about easy trip planners. Hi Sangeet, how can we help you today?
Yeah, hi, good morning all.
Good morning.
I just want to check regarding East My Trip. Okay. I have bought almost 3,800 shares at price of 21.
Yeah.
I'm incurring a loss of 34,000.
Yes.
Just want to let you know, like, should I hold for long term or should I sell?
Okay. All right. And when you define long term, is this more than a year, more than 2 years?
Yeah, 1 year.
1 year, okay. You know what, let me go across to Nirav on this. Nirav, on the fundamentals, there's a lot that's happening in the travel and tourism space, and Easy Trip Plan is of course in the news because of certain cancellations at certain locations. But beyond that, on the fundamentals, it's had troubles with promoters selling, etc. Would you hold on to this?
No, I think it's better to shift to some other alternatives. You can explore Thomas Cook as an option at the current levels.
Okay, so that's the view with regards to where Easy Trip stands. Any quick view on the charts, Vaishali?
Tactically, well, of course, there's nothing much happening. It's just consolidating since a very long time. I would just say observe a range of 11.5 to 13.5 for now. There could be some further strength only if the stock moves above 13.5 to go towards 15 and so on. So in my opinion, if you have to hold, follow these levels, else shift to some other stock.
Okay, so that's the view with regards to Easy Trip. All right, the next question is from Harshit Maheshwari. He's purchased Spandana Spurti at 490 a piece and holding 100 odd shares and wants a short-term view on this particular counter. Vaishali, I'll again come back to you. What are the charts indicating for Spandana Spurti?
So this too is just consolidating after a good corrective move. In the recent, what we saw was at around 1200 levels, and now it's just in deep oversold and trying to come out of its oversold zones. So I would say 270 is the range, and well, if the view goes right and if we see a good bounce, you can see a good bounce going towards first target of 400, 430.
Today is a day to get international calls. Rahul is calling us from California, the sunny state. Rahul, thanks so much for calling us. How can we help you?
Yeah, hi, my name Rahul. I'm calling from California. I am holding around 6,000 shares of Jindal Drilling at an average price of 827, and I want to know, should I hold?
Okay.
And how long should I hold?
Okay, Rahul, thanks so much for calling us. Can you help us with why you bought this stock? It's a very small stock, just about 2,000 crore market capitalization. Why did you buy? What was the thinking?
In the month of February, I just researched and this name came up. So I just put money. So I was in a profit of around 6 lakh rupees, but I couldn't book my profit, and I just came out and kept on averaging it, and it just kept falling on me. So
understood. Okay, let me try and get your view on the fundamentals. I'm not sure if Nirav's going to have a view. Nirav, it is part of the Dharampal Jindal group from what I can read, and it is involved in offshore drilling and allied services. Do you have a view?
Well, typically these businesses tend to be like cyclical businesses, and definitely when they get the orders, then there is a lot of traction in the execution also. So probably I think he would have bought the shares, and after that there would have been some strong order inflows, and after that the order flows have kind of dried up at the moment. So the advice would be to definitely hold with a medium-term horizon, and I think he should be able to recover recoup his losses at least.
Okay, hold is the view coming on Jindal Drilling, and it's interesting because the company operates 5 oil rigs, all of which are deployed with ONGC. And around FY24, 2 rigs are owned by the company so far. And order book also pretty strong in terms of as compared to the size of the company as well. All right, the next caller, Rajkumar, is calling in from Hyderabad. Rajkumar, a very good morning to you. How can we help you?
Yeah, very good morning to all.
Go ahead with your query, Raj.
Actually, in the recent fall, that means the day before yesterday, so I purchased 500 shares of BHEL at a price of 215.
Okay.
Having some 500 shares. So my view is, what is the short-term view? Can I hold? Actually, I'm having some 10,000 profit. Can I book off now, or what exactly the price range is now?
Okay, got your point, Raj. I'll take this up with Vaishali. Vaishali, your view on the charts for BHEL, and should we wait for further upside?
No, well, depending on your time horizon, I would say the stock has already got into a trend. It is positive. View is positive. It is facing a hurdle at around 242, 243 levels. So keep a stop loss of 230 and run through the rally. This can go towards 250, 260 levels also. So keep 230 as your stop loss.
Okay, so that's the view with regards to where charts stand for BHEL. But with that, it's time to step into a very short break. Meera, Vaishali will be right back, and viewers will be right back answering more queries on the other side.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with.
Welcome back. You're watching Ask Profit. Time to deviate a little bit from the questions that we've been taking to talk about earnings. And we're talking about Ask Automotive. And it's in focus because it's a good set of numbers. Net profit is up as much as 21% in the quarter gone by, 57.6 crore rupees or thereabouts, stock reacting positively. There has been an expansion in the margins as well to the extent of close to 2 percentage points. It's come in at 12.2% compared with 10.5% in the comparable quarter, and revenue is up as much as 9% as well. That's just a snapshot. Let's find out more about what the numbers look like under the hood. We're joined by Kuldeep Singh Rathi, who's the chairman and managing director of the company. Thank you so much, sir, for taking the time. Let me ask first about the aluminium lightweighting precision. Is it still expected to outperform the growth of the ABS business in FY26?
Good morning, Alex. Yes, as regards the aluminium lightweighting precision solution, we have grown by 28% in the last financial year, and we will keep on, we'll be outperforming in this segment in the next financial year also. ABS, since we enjoy more than 50% share of the complete Indian market, all the segments, so that will grow as per the growth of the industry.
Okay, Mr. Rathi, just wanted to get an overall understanding with respect to your new partnership with the new Japanese company that you've entered into, and this is for high pressure die casted alloy wheels. What is the kind of synergy that you're expecting from this particular acquisition?
Good morning, Mahima. This is the technology that with this new technology, high pressure die casting alloy wheels, they are already supplying in Japan and to the Japanese customers. And we are lucky to associate with them. And this whole technology transfer and the new setting up the new plant will take place in this particular financial year. And we have the orders for the next financial year to start supplies.
And how much of quantification of that order stands, and how much of a revenue will that generate for you?
We hope to generate extra 250 crore revenue from this particular collaboration.
Okay, and you had also signed a collaboration agreement with a Taiwan manufacturer as well, which was for two-wheeler alloy wheels in Feb 24. Just wanted to get what's the current progress there and what are the timelines looking like?
There also the progress is very good. The product is already under advanced stage of testing. We hope that we should receive the approvals by June or July end. And once the approvals come and the pilot lot supply goes, we feel the complete supply should go in the second half of this financial year.
Half of this financial year is what you have to watch out for. All right. Can you give us an update, sir, on this Karnataka plant, the latest one? Have you ramped up to full production there?
No, not we. We have just started the commercial production on 14 January. And as you know, first 2-3 months, the QAVs take place. Most of the product QAVs, part QAVs have been completed. And we expect the good supplies in from this quarter, and we'll be EBITDA positive from this quarter.
From this, okay. So then from that perspective, based on what you've just told us, and my assumption is that you're going to be ramping up capacity utilization through the year. Can you give us a sense of, one, where you anticipate utilization to move over the course of this year, and also the sense of how much you're spending on CapEx? You've already set up this new plant. Any need for additional capacity? Will there be a greenfield, for example?
This year, from the Bangalore new plant, I think by the end of this financial year, we'll reach a capacity utilization of 60-65%. So we need to move further ahead. And being an optimist, as you know, I see a very bright future for the two-wheeler sector. And we'll be investing close to about 450 crores in the new plants or adding the capacities in the existing plants in this particular financial year.
Mr. Rathi, just wanted to understand, you've ended FY25 with a top line of 3,600 odd crores. Margins also steady margins at 12 odd %, and net profit also at 248 odd crores. If we take a look at your 3-year CAGR, your sales has grown by 21 odd %. Even your net profit has grown by a CAGR of 44 odd %. Do you expect that momentum to continue? And what is the kind of top line and bottom line growth that you're expecting by the end of FY26? Where will this number go from 3,600 odd crores and 248 odd crores in the bottom line?
See, I can't say the number, but yes, we have outgrown the industry for the last 30 years, and we'll be outgrowing the industry, and we'll be growing close to the mid-teens. And the revenue growth will be there. And the margins will also certainly improve. But yes, we will be, with the extra capacity utilization, we expect more and more economies of scale. And we expect that our EBITDA margins will improve at least by 150 basis points in this particular financial year. But we'll be trying to achieve 14%.
Okay, all right. Thank you so much, sir, for taking the time. A pleasure speaking with you. And that 14% is something to aspire to, certainly.
Yes, certainly. Even we are working hard to achieve that.
Absolutely. Thanks so much for taking the time. Look forward to the next chat as well.
Thank you so much. So nice. Thank you.
Take care. All right, so let's go back to Nirav as well as Vaishali. Thanks so much for staying by. Nirav, any quick view on Ask Automotive since we just spoke to the management? 12.2% is where they finished off Q4 EBITDA margin, and they're saying 14% is something they're aspiring to.
Well, I would be circumspect about whether they would be able to achieve the 14% margins, because we've seen in these type of companies that typically auto ancillary makers who are supplying to the OEM companies, that they tend to have a fixed margin trajectory in place. It's generally in the range of 12%, and the PAT margins tend to be in the range of 5.5% to 6%. So I think it would be difficult to achieve this kind of number. But yes, revenue growth definitely looks promising. And on the basis of revenue growth, I think they would be able to command an improvement in the market cap going forward. And hopefully, because the revenues are going up, we will see definitely the PAT moving up. And with free cash flow being available, definitely they can plan expansions, because the market is growing. Definitely, it's a very, very positive outlook. But margins is something which I think we need to be a little bit watchful about.
Okay, so that's with regards to where Ask Automotive stands. The next question is from Sanjay, who's writing in from Delhi. He's holding 3,000 odd shares of Mopen Labs, but at 78 a piece. Wants to know whether at this level should he hold, sell, or add more. Vaishali, on the charts.
So on the charts, I think the stock is doing quite well. It has just consolidated in the recent data. So 55 should be the support. And once you see the stock, and volume is also very consistent. So I think for now, observe a range of 55 to 70. Above 70, this can do even further. It can go towards 80, 85. So hold with the support of 855.
I'm coming back to you, Vaishali, on the next one. Deep Industries is the name of the counter, and we've got Jesse, who's writing in from Vijayawada in Andhra Pradesh, and he's asking, should he hold on? If he's bought at levels of 523 rupees, he says that he can hold on for a period of a year or thereabouts. Stock is currently at 410 or thereabouts. Should he do that? Hold on?
So looking at the chart, the data on daily chart and all, it is getting into a corrective mode. And when I'm looking at the weekly chart also, it's just a regular retracement. So as long as 350 levels are held on, there is not much to worry. So in my opinion, see if the stock goes towards 350, you can add more to get your price lower. And I think once the pickup starts, you'll be in gains.
Okay, so that's with regards to where Deep Industries stand. The next question is on Kotak Mahindra Bank. Vinayak from Assam is writing in and wants to know the outlook for this particular counter. Nirav, I'll come to you on this. Q4 overall growth was slightly below the street expectations. Margins did improve QOQ. The commentary was positive, and overall return on assets was sustained. But what's the view like as to where Kotak stands? Should he continue to hold?
Yes, there's no doubt that Kotak is a hold from a medium to a long-term perspective.
Can you tell us a little bit more about why you're saying that, though? So the reason I'm asking, Nirav, is that it might be obvious to some of us, but then a lot of our viewers tuning in would like to get some more information on that.
Well, I think the best-in-class NIMs, that is the net interest margins, we've seen a decent loan growth. But I think all these parameters are likely to improve going forward. So I think we need to keep a strong eye on how the NIMs tend to move forward. What is going to be the asset quality? Asset quality has been quite strong, and the profitability has been quite strong. So I think definitely it's a hold.
So hold is the view coming in on Kotak Bank. Our next question is from Bimal, who's writing in from Bengaluru. He wants to buy latent view analytics at this point of time and wants to know if this is the good time to enter from a media-term target. Vaishali, do you have enough data on the charts to give a view on latent view analytics?
Sure, I do. So this stock has not been doing much of late. Just in 2021, we had seen a high of around 720 levels, and from there on, it's consolidating, and we've seen good profit booking. And technically, if you were to ask me, it is currently attempting to make a bounce back. So 350 acts as the support, and the resistance for now lies at 450, 460. The strength confirmation is only about 450, 460. So in my opinion, just buy and hold, wait for this confirmation, and then you can see further strength, the stock going towards 600 and plus.
Okay. All right. The next counter that we're talking about is KPI Green, and it is up quite considerably today. I believe we've got a caller from Warangal, I believe. Is that right? So Govind Kumar is calling us from Warangal. Hi, Govind. How can we help you today?
Sir, good morning, sir. Alex, sir. Good morning to all.
Good morning.
Sir, actually, regarding this KPI Green Energy, I have purchased the 250 shares at the price of 550 rupees, sir.
Okay.
Can I add some more, sir? At least another 250 to 300 shares I can add it for long-term prospects, 1 to 2 years, sir, due to this demand power supply of power, actually.
Understood. Okay. I will take your question, Govind. Just let me go to Nirav on this one. Nirav, any view on KPI Green? It's been in focus.
Well, I think all these renewable power stocks have been in the flavor of the markets, and definitely he can add more at the current levels, that is KPI Green. We also have Inox Green, which has performed quite well. Adani Green Energy too has performed quite well. So I think all these stocks are looking in a very interesting space at this point of time.
All right. Jay Krishnan is writing in from Kerala, and he's asking about Amber Enterprises, which he's bought at levels of 7,047. He's incurring losses, he points out, and indeed the stock is currently trading at 6,200 thereabouts. He's wondering whether to book losses and shift to something like a Persistent. What's the view, Nirav?
No, I think you should continue to hold, because I think all these EMS firms, whether it is Dixon or PG Electroplast or Amber, they've been doing quite well. The prospects are quite strong going forward. So he should keep the faith and hold on to these stocks.
So what I wanted to ask you, in fact, is on Syrma SGS. If we can pull up that share and just see where it's currently trading. And this is my own question for you. I want to know, Nirav, what you made of the numbers, because you don't often see a 5 percentage point improvement in operating profit for a player like this. So on the one hand, you have the revenue miss, which I think the street is focusing on. But on the other hand, you have an improvement in this margin trajectory. What is your opinion on this?
Well, I think the margin improvement is a continuous work in progress. So I think the first step is, of course, that there is a scale up in the revenues, and after achieving a certain meaningful revenue trajectory, the operating leverage tends to kick in. So I think what will be important to monitor is whether they are able to maintain these kind of margins going forward. So I think management commentary in this respect will be very, very important, and it will be important to see whether they are consistent in their ability to hold on to their margins going forward.
So that's the view with regards to where Syrma stands. The next question is from Deepak, who's writing in from Chennai. He's holding 75 odd shares of solar industry, bought at an average price of 8,700, and wants to know the timeline with respect to this counter for 3 to 6 months. Vaishali, on the charts, how does it fare?
So solar industries has been doing very well, and I think the stock is really run up. So I would say keep a trading stop loss of 13,000 levels, and this can go towards 15,000 also. So that's my view, because it's already run up right from 8,000 to currently 13,800. Too overbought to make a fresh view, but hold with the stop loss and look for a target of 15,000.
Target of 15,000 is the view on solar industries. All right, our next caller, Satyendra, is calling in from Jaipur. Satyendra, very good morning to you. How can we help you?
Good morning, ma'am.
Go ahead with your query,
Hello.
Satyendra. I can hear you.
Ma'am, I have the share of PCBL, Philips Carbon Black Limited, at 420 price, and 400 shares I have. मैं इसके बारे में एक तो होल्ड और सेल और बाई जो भी इसको एवरेज भी करना है तो पूछना चाहता हूँ, और दूसरा इसका लॉन्ग टर्म शॉर्ट टर्म व्यू पूछना चाहता हूँ, और थर्ड इसका स्टॉप लॉस अगर रखना हो तो क्या रखना हो, क्योंकि ये पिछले 5 मंथ से 350 से 420 430 के बीच में ही ट्रेड कर रहा है जब से मार्केट गिरा है।
ठीक है, ठीक है। और सत्येंद्र, आपने जब ये स्टॉक लिया था तब चार्ट्स देखे थे या कंपनी का फंडामेंटल देखा था?
मैं फंडामेंटल से रहा हूँ
Fundamental.
एक्चुअली इसमें नया बैटरी सेक्टर्स में और इस सेगमेंट में इसने अपना नया इन्वेस्टमेंट किया था करंट में इसकी बोरोइंग्स ज्यादा है रिजर्व से ये एक नेगेटिव है इसका बट वो उसकी वजह से क्योंकि उन्होंने इन्वेस्टमेंट किया है नया तो मे भी बाकी इसके जो भी फंडामेंटल्स थे ठीक थे मैं
ओके सत्येंद्र आपने अपना रिसर्च बढ़िया तरीके से किया है बट लेट्स आस्क नीरव व्हाट्स द व्यू लाइक ऑन PCBL
Well, I think the stock did start going up once they made an acquisition of Aquafarm Chemicals, and I think after this acquisition, of course, this was funded by debt. So I think the integration is going on at this point of time, and once the integration is complete, we will see the margins normalize. We will see the impact of the incremental turnover. We will see an improvement in the product mix going forward. It's going to be a very interesting product mix. So this is a kind of a transition. I know the stock has been on a downward trajectory since the last few months, but I think he should keep the faith and he should hold on to the stock. If possible, he can even average at the current levels.
Okay, so that's a view on PCBL. Make of carbon black also, by the way, which goes into tires in case you didn't know. That's the reason why tires are black. All right, Milan Sarvaiya is writing in from Mumbai and he points out that Nirav Ashar had on NDTV Profit said, and he quotes, Hitachi Energy is a blind buy, unquote. He had followed and bought 10 shares at levels of 11,560. The stock is currently trading at 16,400. The question is, can he hold and should he add on dips for a period of 12 to 18 months? First of all, congratulations on a great piece of advice, Nirav. And what's the advice going forward?
Well, I think it's a blind hold.
Okay, but tell us more.
Well, I think if we were to see, there has been a huge amount of interest in grid technologies. If one were to refer to today's paper, then GE Vernova is going to invest around 140 crores in grid technologies like HVDC and FACTS. Hitachi is a pioneer in HVDC, that is high voltage direct current. This technology helps the company to be a price maker. So I think there is a huge amount of thrust on electrification at this point of time. And in the power T&D space, HVDC is the trend going forward. So I think the prospects are still very, very strong as far as Hitachi is concerned.
Okay, prospects of the company looking very strong and blind hold is the view coming in from Nirav. All right, our next caller, Venkateshwar is calling in from Telangana. A very good morning to you, Venkateshwar. How can we help you? Hi, can you hear me?
Hello?
Okay. Yeah, I can hear you, Venkateshwar.
Yes.
Okay, we seem to have a patchy line, I believe, and we seem to have lost him. So his query is basically on Olectra Green Tech. He's holding 50 odd shares at 1,844 a piece. Your view, Nirav, on Olectra Green Tech, how are the fundamentals looking like?
Well, I think the company has very strong prospects because they are a major beneficiary as far as the orders for the green vehicles, that is the electric vehicles, are concerned going forward. And there is a sizable budgetary allocation for these vehicles as far as the state transport undertakings are concerned. So I think the prospects appear to be quite robust. On and off, we've seen Olectra, companies like Olectra Green Tech and JBM Auto win orders on a very consistent basis. So I think both these companies look quite strong from medium to long-term perspective.
So, all right, so that's the view on Olectra Green. We've got the next question on Dixon Technology, and Rohan from Pune is asking this question. He's got 10 shares at a price of 14,600. Should he add, sell or hold for the medium-term perspective? Vaishali, on the chart?
Yeah, I think continue holding, and if he has to buy near 15,000 because the stock is likely to do 19,000 to 20,000 for 3 to 6 months horizon.
Okay, so that's the view with regards to where Dixon Technology stands. The next question is from Tejas Rane, who's writing in from Maharashtra, in fact from Thane itself. Power Grid Corporation, he's holding 7,000 odd shares, his buying price is 330 and wants to have a long-term view from a 3 to 6 year point of view, whether to continue to hold or buy more at the current levels. Nirav, what's the view like?
Well, I think this stock is like lazy investing. So I think there will be returns. He cannot expect any extraordinary returns, but there will be decent returns. There will be a good dividend yield, and it's expected to be a slow and a steady mover.
Okay, so that's the view with regards to where Power Grid stands. Our next question is on BEL. Kajori from Kolkata is writing in. She's bought BEL for 336 a piece and wants to know as to whether she can add more at the current levels or not, and for how much of a time can she continue to hold. Vaishali, I'll come to you on this one. BEL on the charts, how is it faring?
It's looking very well. Good run-up already taking place, and yet further upside cannot be ruled out. So if she has to add, I think wait for a dip if at all it does, because we've seen a good one-way rally coming in. And after a breakout also, it's just holding on. So I think the target is 370, and the strong support now lies at 332. So accordingly, if you get a chance to add at lower levels, to look for higher targets.
Okay, so that's the view with regards to where BEL stands. Our next caller, Anant, is calling in from Bengaluru. Anant, a very good morning to you. How can we help you?
Yeah, very good morning and thanks for your great service. And I'm a big fan of Vaishali ma'am as well. So my question is, I'm holding 96 shares of Afcons.
Okay.
I bought it at the listing price. So I wanted to hold it for a long. I just picked the share based on the fundamentals and book values. But there's a lot of up and down is happening, so I just wanted to know whether I can hold it or I can sell it on after a few months.
Okay, got your point, Anant. You saw the fundamentals and you bought the counter. So I'll go to Neerav first, but Vaishali, I'll convey his message to you. I hope you've heard that he's a big fan of yours. I'm not sure if you have enough data on the charts, so I'll come back to you as well. But Neerav, your view on Afcon, should he continue to hold or book profits at the current level?
No, it's advisable to hold because we have a very strong promoter over here. We have a strong order book. We have strong execution capabilities, and we should see order inflows moving up going forward. So I think the advice is definitely hold with a medium to long-term horizon.
Okay, so that's the view with regards to where fundamentals stand for Afcons. Vaishali, enough data on the charts to give a view?
I'll just have a look.
Sure. So that's with regards to where Afcons.
Well, so Afcons, I do have the data with whatever I have. The stock is showing signs of revival. It has made a bottom at 400 levels, and I think the stock can do well, keeping the company having good order book also. I think this can go towards 520, 550. So continue holding.
Okay, so that's the view with regards to where technicals stand for Afcons. All right, the next question is on AB Capital. Do we have the name of the... Yes, Chandan is holding around 2,500 shares at 175 a piece and wants to know whether he should hold further. He's writing from Hubli, Karnataka, in 6 years is his time horizon. Neerav, your view on AB Capital?
Well, it's definitely, it has very strong prospects going forward. So the advice is definitely to hold with a medium to long-term horizon. Preferably with a long-term horizon.
Okay. All right, so that's the view. It is time for the rapid fire segment, and this is where we throw as many questions at you over the course of 2 minutes, so do keep your answers as crisp as possible. Power Mech is the name of the counter that we're talking about first, and this is from Samba Siva. He's bought at levels of 3,353 in a loss. Is it worth buying more for the long term? What's the view, Neerav?
No.
Coforge is the next counter. Nimish is writing in from Saudi Arabia. He's holding 7,900 or he's holding 15 odd shares. What's the view like from a longer term perspective, Neerav?
Positive.
Okay, Maruti Suzuki holding from IPO levels. He says 350 shares. I'm not sure whether it still is that much. Parijat wants to know, should he hold on, Neerav?
Definitely hold.
Okay, the next counter is Bajaj Finance. Ravi from Vijayawada is holding 1,000 odd shares, wants a 1 to 2 months view. Vaishali, on the charts?
Well, hold. 2 months point of view, 8,800 support and 9,800 as target.
Paras Defense is the name of the counter. Vinay wants to know, he's bought at 900 levels. Can he add more at the current price or wait? What's the view, Vaishali?
Wait. Already run up, so wait.
Okay.
1450 should be the level to look at.
Okay, Ather is the next counter. Ramesh from Kerala wants to know whether he can invest at the current levels from a longer term perspective. Your view, Neerav?
Yes.
Okay, Websol Solar System, price of 656, 100 quantity, 2-year target is being sought. Anything on the charts, Vaishali?
Looking positive, hold with a support of 1350, look for a target of 1800.
Okay, Triveni Engineering is the next counter. Jennifer from Mumbai has purchased 350 odd shares. Wants to know whether she should continue to hold or not. Vaishali, on the charts?
Continue holding, stop loss 400, target 520.
Okay, we've got Apollo Micro, bought at levels of 108. Neha wants to know 1 to 3 month view, making a 20% profit. Should you take money off the table, Vaishali?
Continue holding with a trailing stop loss and look for a target of 155, 160.
Okay, Escorts Kubota is the next counter. Rajmohan wants to know whether he should hold or book profits. Vaishali, on the charts?
Well, book profit for near term.
All right. On that note, thank you so much to the both of you for taking the time. Pleasure speaking with you as always, and look forward to the next one. All right, and that brings us to the end of this edition of Ask Profit. Thanks so much for tuning in. Hopefully we got your question answered. If we didn't, hopefully the questions that we did answer have helped you out. Do stay tuned. Up next is Know Your Company. This is NDTV Profit.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands.
Hello and welcome to KYC. Today we're going to talk about Borosil Renewables. Interesting company in the renewable energy space, not so much talked about, and that some flavor of that you'll get when we talk what exactly the company does. First off, I want to try and iron out as to what is it that interests me in this company. One, do things change substantially? There's now an anti-dumping duty by India with regard to glass. Does this change things substantially for the company? That's the first thing I want to understand. The other piece, there's been a drag over the last couple of years with regard to both top line as well as margins. That's because of pricing. Pricing in India, of course, also under pressure, but Now with this anti-dumping duty, India is taken care of, but Borosil Renewables has a global presence. It has a presence in Germany. So I want to understand whether the global presence really, whether the global business actually also changes in any fashion, or whether we are seeing any of those trends play out, because China had cut pricing by 32%, global pricing, last year. Now, with that, you will see pressure on something like a Borosil Renewables. You want to know whether there's been a bit of a pullback from a China pricing standpoint, and therefore will Borosil benefit from this global outlook. The third piece is with regard to growth and margins. Therefore, with all of this playing out on the domestic front as well as on the international front, I want to understand whether anything changes with regard to the growth outlook as well as the margin outlook. Expansion, they are looking to add another 500 tons per day of capacity. They currently have 1,350, so the 500 tons is substantial in that sense. How quickly does that come on stream? How quickly do they set it up? And what are the capex plans like? Last off, I want to understand the domestic industry outlook. There's a large opportunity available domestically. Does that opportunity remain? What is the likelihood of that opportunity remaining? And will they continue to maintain leadership within that space? Now, let's start off by understanding what the company is about. It is the first and the largest solar glass manufacturer in India. We're talking about this big shift towards renewables. Borosil does not manufacture power. It does not generate power. What it does is it manufactures glass, solar glass, which basically is the key ingredient to generating power. And it is the largest of those, and therefore it becomes a very important cog in that entire value chain. Look at the manufacturing capacity it has. It has around 1,350 tons per day of manufacturing capacity. This ensures roughly 8.5 gigawatts of solar power generation for each year of production that they do. They are likely to add another 500 gigawatts. I'll come to that. But before that, out of this 8.5 gigawatts, they have a 2 gigawatt odd presence coming from Germany. So that is the global exposure that the company has. 6.5 gigawatts is the domestic exposure. Of course, outside of that, exports also is a relevant factor. But in Europe, in Germany in particular, this 2 gigawatt capacity is substantial because it could drag the overall balance sheet and the overall numbers for Borosil despite the domestic numbers looking good. So that's something I want to quickly highlight. The last piece is with regard to expansion plans. So they're considering another 500 tons per day of expansion that they are looking for. They've been looking for this since a while now, but in December 2024 was when the Indian government came out with an anti-dumping duty on solar glass, which has in some form or shape reignited this conversation with regard to this expansion. Otherwise, this expansion was actually on the back burner. On the back of this, they're also doing a fundraise. So something to keep in mind, and we'll chat with the management as well. You know, you want to understand what exactly is the outlook, because there's a lot of moving parts here. Now let's talk a little bit more about the business. We've spoken about the pipeline. Let's talk about the regulatory developments, because that is the other big moving part here. India has imposed anti-dumping duty on solar glass. This happened provisionally in December of 2024, confirmed now in May of 2025. The duty is up to $677 per metric ton on China as well as Vietnam. These are the two countries which are dumping. Duty benefits are to Indian solar manufacturers, and Borosil Renewables is one of those. And India imports over 90% of the solar glass that it consumes. So in that sense, it's a large chunk, and to compete is difficult given the fact that you're seeing a 32% price erosion between the months of June 2024 to September of 2024. So that was a period where competition was extremely tough for the company, especially. Now, that's broadly setting the context, right? And that kind of gives us an overview on what to expect in terms of numbers while we discuss it. But before that, let's quickly look at the parameters that we'll look at when we look at this company. We'll first look at the opportunity size for a Borosil Renewables, and how well could it play out will obviously depend on execution. But first will be the opportunity. Thereafter, we look at the income statement, balance sheet, cash flow to assess whether that opportunity is something that Borosil is capable of executing on. Thereafter, we look at return ratios, shareholding, street cred, and we look at outlook and valuation, right? So this is how we'll kind of frame it up. Let's first start off with the opportunity, because it's a fabulous opportunity, and I'll break it down the best I can. You know, when you're looking at the overall power market in India, India's power capacity currently is around 475 gigawatts, I beg your pardon. So out of this 475 gigawatts, around 35% odd is now renewable, right? And out of that as well, 106 gigawatts is solar. Solar installed capacity up to FY25. The quantum which is installed in FY25 is 23.5 gigawatts. That's nearly 22% of the overall capacity that India has built till date. 22% of that came only in the last 1 year. FY26 solar installation is expected at 35 gigawatts. Okay, so you have a very large opportunity size. And the target till FY30 is to get India's solar capacity to 280 gigawatts, currently at 106, right, at the end of FY25. You're expecting this to go to 280 gigawatts in the next 5 financial years. Let's talk about FY26 now. 35 gigawatts set up in FY26. Let's assume that that happens, and you take the Indian capacity to 140 gigawatts. Then FY27, FY28, FY29 and FY30, in 4 years, you'll have to take that 140 and double it up. So that's a very solid 18% growth rate. And what you're also needing to understand fully is a large chunk of that comes from imports into India. And that import substitution could well be a game changer when it comes to a Borosil Renewables. So even if I'm looking at a 140 gigawatts between FY27 and FY30, that amounts to 35 gigawatts per year. Now let's go back and look at what Borosil Renewables does in terms of capacity. It currently has a capacity of just under 9 gigawatts per year, right? Out of which 2 gigawatts is sitting in Germany. So you have a 6 gigawatt per year of capacity which you are currently playing with. You're going to expand this by 500 tons per day, which could take the capacity up by roughly 3 odd gigawatts. So what you're going to do is you're going to do 9 gigawatts. The requirement is 35 gigawatts, which is 25%. Today too, at 23.5 gigawatts, which they've done in FY25, roughly the capacity sits at 6.5 gigawatts. So they're still doing 25%. So largely, can they maintain their market share? Is really the question I'm trying to ask. And that will depend on execution. But the opportunity size, is there absolutely any doubt? Doesn't look like, at least at this point, based on numbers and based on India's aspiration to get to that 280 gigawatt solar capacity. Okay, so I've kind of tried to do the best I can to bring this point out, that the opportunity size, there's no doubt about. Let's talk about the income statement now. And this is where it starts to get a little bit tricky, right? They've done very well. So from FY16 to FY23, they've more than doubled their top line. Okay, so FY16 it was at 415 crore. FY23 it's at 891 crore. So more than doubled in terms of top line, right? you look at March 2024, that's gone from 891 crore to 1367 crore. Now that's on your screen, okay? And from March 4 to March 25, it's gone up not even 10%, right? So you're seeing pressure, both pricing as well as volume. That's evident with regard to how FY25 numbers have shaped up. FY24, it was okay. All right. Now let's talk about margins therefore, right? Let's talk about EBITDA. The EBITDA number, which used to be in the mid-teens, it was at 14% in FY18, FY19, jumped a little bit to 16% in FY23, but thereafter it has sulked, just 4% in FY24 and 4% in FY25. So you're seeing pressure with regard to where margins is concerned. Pricing is one of those aspects, especially dumping from China. We've heard them complain time and again with regard to that, and that seems to be the problem at this point. Now, in terms of margin profile, we're seeing sharp shrink, and therefore not really looking good. Not surprising, therefore, that they've done actually a negative profit before tax in FY24 and FY25 of 53 and 74 crore each, and they've done negative 50 crore of PAT and negative 87 crore of PAT in FY24 and FY25. So you're seeing clear pressure when it comes to the numbers. Can this improve? Well, we'll have to. There's no big concern with regard to execution, at least as of now. So it seems that this can improve, but how much will be the question. And this is something we'll pose to management, get a better perspective as to how this will play out, because it will be crucial to understand that. So that's on the financials. Look at the financials, they're strained by high solar glass imports, 90% for India. Anti-dumping duty now offers some relief. Hopefully those numbers change. And what you're also seeing is that Q4, you've seen sharp improvements, 32% revenue growth. EBITDA also came up substantially. We've turned positive with regard to EBITDA, 15.5 crore EBITDA versus a loss. Margins have come in at 4%. So you're seeing improvement across the board where Q4 is concerned. Can that sustain will be the question. Now that you have a 5-year term where you have this concern of anti-dumping duty being levied, you're likely going to see positive with regard to this piece. We'll have to wait and watch as to how that plays out. But overseas subsidiaries also continue to impact the EBITDA, the consolidated EBITDA, and that may continue to be so. Unless the European Union or Germany in particular incentivizes made in Europe, which is also seemingly in the pipeline. We'll talk about that as well. But that is on the income statement. Let's talk about the balance sheet now. The balance sheet does not seem to be a big concern. You're seeing a decent amount of equity plus reserves. You can see those numbers on your screen. The borrowing number sharply lower. This is a 7,000 crore market cap company which has given 15x in terms of the last 5-year returns to shareholders. So clearly standing out in this space. And therefore that borrowing number not looking too large. They're also doing a fundraise, mind you. And there's an equity raise in the pipeline. The equity raise, and I will talk about that. The equity raise is going to be a raise of around 600 odd crore rupees, 700 odd crore rupees. It's a pref issue. Promoters are going to put in 100 crore and non-promoters are going to put in 600 crore. So that's how it shapes up from a balance sheet perspective. We'll have to understand as to how much of this is going to be deployed as part of the new 500 gigawatt facility, if that is going to play out. And we're also going to ask about how quickly are these funds going to be fully utilized. So a couple of those answers hopefully we'll get soon. Let's look at cash flow now. The balance sheet looks fairly good. We'll give it a thumbs up. Let's look at cash flow now. The cash flow, again, is largely under pressure because of the way in which the income statement has played out. So is this more of a drag? Yes, but we started to see it inch up. So FY24, FY25, we started to see cash flow from operating activities inch up. That's a likely positive. But the overall cash flow can be negative. That's fine because the company continues to invest in capex heavy projects. But you want to see more with regard to cash flow growth. So we want to wait and watch that from here, cash flows essentially go. But that's how the cash flow is stacking up. We'll give this one a neutral. Let's look at return ratios. Again, are return ratios the best? Obviously not, because it's a loss-making company. But look at the return ratios in FY21, 22 and 23. This is as per Bloomberg. The return ratios are fairly healthy in all of those 3 years. Can they bounce back will be the question, and if so, how much? Because the company has done a couple of equity raises post that, and therefore you want to see whether that actually turns around or not. We'll give this a thumbs down for now, because right now there's a sharp drag with regard to return ratios, the ROCE number. Let's now look at the shareholding pattern. Now this is where it starts to get slightly better. The shareholding pattern looks good. You have promoter holding of 62%, so plenty of skin in the game. FIs far and few, just 4.5 odd percent in terms of FIs, no DIs there, and you have the rest of the shareholding sitting with the public. So that's how it shapes up. We'll give this a thumbs up only from a perspective that plenty of skin in the game, right? When you have such a large promoter holding. So that's the shareholding. That's that. Street cred. Let's look at that. Now, again, very interesting. Despite everything that's played out, last 6 months, it's given a 19% return, right? Last 1 month as well, it's an okayish return. Last 1 year is a 7% odd return that the stock has given. And the last 5 years is what really stands out for me. And I'm just going to pull it out. The last 5 years is 15x in terms of its return. But the last 1 month is about 5.5%. The year-to-date period, very, very muted. The stock is actually down a couple of percent. The last 6 months, the stock is up a nice 19 to 20%. Last 1 year, it's up around 8 odd percent. And the last 5 years, it's a 14 bagger. It's 1400% returns is what it's given. So very, very strong returns that the last 5 years have posed, and therefore it's already been a multi-bagger, but a thumbs up. Okay, so that's how the street cred is looking. There's not much coverage on this counter, mind you, and therefore street coverage is not really something we're looking into. But let's look at outlook. The outlook and the valuations. Valuations, I'd like to put it out of the way, difficult to determine simply because you have such a massive hole on the P&L, and there's so much uncertainty with regard to where margins are going to go, that it's difficult to determine where the EBITDA will lie at a normalized steady state, and it's difficult to determine where profitability will lie at a normalized steady state. But that's what we'll speak to management regarding. The FY25 commentary seems to suggest some decency with regard to numbers. The volume has increased by 10% this year. Price has increased by just 2%. They've been able to hold on to pricing. The decline has largely come from European markets. The dumping from China is impacting the demand for the company's product in Europe. The first 8 months, Chinese exporters reduced prices by 32%. This is something I have continuously reiterated. But Q4, sales volume is up 16% and selling price is up 22%. So Q4 is where you're starting to see some green shoots. Can they last? Will be the question. The impact continues with regard to European prices. Prices are down. European business is impacted, and therefore on a console level, those numbers are not reflecting where Borosil Renewables is concerned. So that's how we've stacked it up. Let's look at all of the metrics that we've looked at today, and let's try and give this one our rating before we go across to management and get their outlook as well. There you go. That's opportunity, definitely a thumbs up. Income statement, thumbs down. Balance sheet, thumbs up. Cash flow, neutral. We look at return ratios, thumbs down. Shareholding, thumbs up. Street cred, thumbs up. Valuation, outlook and valuation, neutral. Overall, this gets a 5 out of 8 on our KYC ratings. That's how it stacks up. Let's go across to Pradeep Kumar Kheruka, Chairman, Borosil Renewables, joining us. Good morning, sir. Good having you. Pleasure having you here. I want to first start off with the domestic side of things. Are things looking up domestically given this duty that has been levied? Is there more certainty? Does this therefore lead to an uptick with regard to the domestic numbers where FY26 to FY30 is concerned? Because now this is a five-year outlook that we can see, given that ADD has been imposed for the next 5 years. Sir, I believe you're on mute. Okay, I believe that there is an issue with regard to the audio. So we'll just wait it out over there. Now, I just want to talk a little bit about... Sorry? Okay. Mr. Kheruka, do we have you, please?
Yes, yes, I'm here. Thank you.
Okay. Mr. Kheruka, I'm not sure if you caught my question, but if you did...
I did.
Perfect.
I did.
So please go ahead, sir.
Yes. Sorry about that. Okay.
No worries.
So the duty is valid till the 3rd of December 2029. In that sense, there is a certain amount of clarity in terms of the selling price. For the rest, there is the question of production. There's a question of demand. I'm happy that both production and demand are seem to be quite clear in their view. The runway seems quite clear. There's no obstacles that you can see, and therefore it should be a clean run between now and 2029, as far as everything seems to be appearing.
So this 22% uptick in domestic pricing, can that sustain, and what would therefore the number from a domestic standpoint look like in terms of growth?
The domestic pricing should sustain. I see no reason why that would not sustain.
Sure.
There is no doubt that there are other manufacturers who will in time join the group of manufacturers who are already in the market. But I do not see that that should pose any problem for us or for the prices as such. The demand is quite vibrant, and I think whatever glass is available would be taken up by the manufacturers, and so that should be quite steady. The demand and the selling prices, production, everything.
Point taken. So, with regard to your overall global context, give us some perspective on that. How is the situation evolving globally? Because one is India, which is protecting your company as well as others, as well as domestic manufacturers. But what's happening in the global context of things? Is pricing getting better there?
Yes, I would say that the pricing has not yet got better. However, I can say definitely that the global context, the same mood which is visible across the world now, whether it is in the United States, is also visible in Germany. Germany has had a government with a very difficult coalition, which almost imploded in the end of last year. And there were elections, and the new election, the new parties which are running Germany now onwards are the Christian Democrats and the Social Democrats, both of whom have been the traditional parties to have been running the country for the last several decades, maybe 60, 70 years. I think they have their act together. They have announced that they're going to support production of solar modules in Germany. And the European Union Parliament has already mandated that 40% of all the installations that will be coming up will be in using domestically manufactured modules. So all components and modules that will be manufactured now will be coming from domestic with effect from the 1st of January. So obviously the German government has to work hard to make sure that the production comes up. The good thing about Germany is that the production lines manufacturing modules, which had shut down because of competition, have not been disbanded. So all the production lines are there in place, and it should probably not be very difficult for people to walk in and resume production. What we manufacture there is about 2 gigawatts only of glass. And what has been seen as installations in Europe are 65 gigawatts. If 40% of that comes in from Europe, that would mean 25 gigawatts required, of which we make only 2. So therefore, we do not see any problem in terms of selling glass over there. In fact, if this it comes up properly, then the opportunity could be for expansion over there, in fact.
Right. So with regard, again, I'll shift back to domestic and the overall outlook. Therefore, we'll just kind of, put this in a nutshell. You're going to add another 500 TPD to your current setup, which should likely add 3 gigawatts if I've got my math right. Please confirm that. So what's the plan here? What's the capex plan? How are you going to fund it? What are you going to do with the fresh equity raise that you're planning? And therefore, what should the outlook with regard to top line and margins be for the next 2 years?
Okay, good question. First of all, when we had announced capacity increase, we had sought the board permission for 500 tons. And what I would say is when I've gone around looking at the equipment available, it seems we should be able to make 600 tons from these two lines, but this is not official yet. I have not yet got the approval from the board. So first we need to get board approval, then we need to inform the stock exchange. Only then can I officially say. So for the time being, I shall say that we are looking at a new production facility of 500 tons, which has been approved by the board. And yes, as soon as this comes online, we do not see any problem in selling this entire capacity.
Okay, and sir, growth and margins, sir, last, please, just 30 seconds.
Yes. So I would say the growth prospects are absolutely full on. As far as margins are concerned, the prices have been improving all the way in the last 2 or 3 months, and now we are nearly at the level of the minimum import price, which should hopefully see us through to about maybe around 30% EBITDA going forward.
Excellent. Sir, thank you so much. Great speaking with you. And 30% EBITDA looks very robust. So we look out for that. I look forward to chatting with you.
You had asked a question about financing quickly. So
yes,
the
sir.
Financing, there is, we are looking at internal accruals. We had already given warrants for shares. We expect the money to come in from there. There'll be a certain amount of debt, and that should look after the financing.
Awesome. Sir, thank you so much. You know what, we'll catch up in the next quarter or two. I look forward to seeing how this plays out. So, but very interesting. Thank you so much for joining us.
Thank you very much. Thank you.
And with that, completely out of time, actually, viewers, thanks so much for tuning in.
That's huge. That is a biggie. It's out of it.
गोल्ड प्लस क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company.
Hello and welcome to Markets at 12. This is Anushri Vakharia, and currently let's see how the markets have been faring throughout the day. Now, in terms of where the benchmark indices are concerned, let's pull out Nifty 50. See, 0.32% of gains have cooled off in the last 1 hour or so. It was up around 0.5% just half an hour or so ago. If you talk about the Sensex, let's see where that is currently, the level of Sensex if we are seeing at the mark of 81,314 that we are looking at. So there's Nifty 50 and Sensex. Nifty Bank is another counter that we should be focusing on, up in fact down in trade today, seeing major cuts of around 0.12% currently. So in the last half an hour, 1 hour or so, we've seen weakness clinching back in the benchmark indices is concerned. But let's see how the sectors are performing. Let's pull out the point contribution table firstly before we go to the sectors. So in terms of where we are seeing some bit of pressure is HDFC Bank, Tata Motors, Kotak Mahindra Bank down in red, while something like Infosys, Tata Steel and M&M is bucking up the trend that in the Nifty 50 pack that we are looking at. In terms of how the sectoral indices are faring, let's pull out the sectoral indices. Metals, the top gainer in trade today. In fact, it was in the top gainer with Nifty Defense. It was amongst the top gainer in trade yesterday as well. Again, on the easing of US-China trade tensions which were there, Nifty Metal has been a key beneficiary in this. Realty is another bag which is seeing some smart moves, up over 1.8% in trade today. But it's the bank, FMCG and finance which are seeing some flattish cuts in the red currently that we are looking at. But let's talk about how the broader markets are doing in terms of where Nifty Midcap 150 is concerned, doing much better than where the benchmark indices were, up almost at the levels of 1%. Nifty Small Cap 250 if we are checking. Now that is up over 1% in trade today. Let's see the BSE 500 to get a stock of which are some of these counters which are buzzing in trade. So we have the likes of Cochin Shipyard, Mishra Dhattu, that's Kirloskar Oil Engines, which is in focus, Intellect Design, which all of these stocks, Cochin Shipyard up over 10.8% in trade today. And now do note that defense counters have been buzzing in past few days on what is happening in the India-Pakistan situation. However, we are looking at downticks for counters like VIP, Metropolis Health and Coromandel International. So that's the overall picture that we are building for the benchmarks and the broader markets indices. But let's hear an exclusive story from my colleague Shrimi Chaudhary. As a fallout of China supporting Pakistan during the recent military conflict, the Indian government will conduct tighter scrutiny on all deals, FDI and joint ventures backed by China. Shrimi joins me on the phone line for more details.
Yeah, that's right. Following the China open support to Pakistan during the military standoff, India is tightening its grip over the foreign direct investment, giving a straight signal and a tough signal in terms of economic engagement, where the FDI plays a huge role. What we have been given to understand that India is taking a close look and have a fresh review of the ongoing 6 to 7 major deals involving Chinese entities, and in fact some of those JV is likely to be proposed as a workaround, but pending JV proposal which has been there involving consumer durables and some auto sector deals as well could be delayed, is what indication we are getting at this point of time. In fact, the China-backed JVs could also face stricter compliance measure under Press Note 3. Now, Press Note 3, as you remember, introduced in April 2020 after the certain standoff at the China border to curb the hostile takeover. So with the land border India shares with, including China. Since then, there has been a multi-departmental approval required for all those investment coming under Press Note 3. Now, sources also tells us that they are reviewing each cases and giving approval on case-to-case basis is what the core of this Press Note 3. However, with the kind of current situation and the way it's evolving, it will increase increase and intensify its scrutiny on the ongoing deals is what the indication we are getting at this point. Now remember, there's a very interesting trend which has been emerged post 2020 after the press note 3 was introduced, where we have seen import from China has increased dramatically, but as far as FDIs is concerned, has been reduced over 4 to 5 years. And if you compare those, before the April 2020 rules, so there has been a talk of easing the restriction as we are, getting a lot of merchandise imports from China. But somewhere now, from last 1 or 2 years, there has been a tough stance as far as China investment is concerned. There has to be a stricter compliance measure and a multi-department approval required as far as Chinese investment are concerned. And we could see, in fact, some further tightening in the rule, maybe not in the form of notification, but definitely in terms of compliance, we could see further tightening, government may impose as far as China-backed investments are concerned.
Well, thank you for that, Shrimi. That's an NDTV Profit exclusive right there for you. But with that, let's welcome in our guest for today. That's Prashant Tapse, Senior Vice President, Research Analyst of Mehta Equities, joining us. Prashant, let's talk about the markets first. Now, we have a bunch of events this week. Today's focus was on the India retail inflation. Yesterday, it was also on the US retail inflation as well. Just talk to us about how do you see the markets faring in the next few weeks? Prashant, I believe that you're on mute. Yeah.
Yeah, sorry. So I think the overall undertone of the market remains very bullish. As you said, there are a lot of microeconomic data as with respect to domestic data points as well as from the global data points. So both like inflation data are very much supporting to the economic growth of Indian markets. I think that would be the one factor why even the RBI may think of even cutting more interest rates going forward, and that is the one reason why real estate's sector is totally on a bullish trend today. But overall, I think technical factors, the market will remain on a sideways. I think with support of 24,500 and a resistance of 24,800 and 24,900. But again, the major data point which we are missing right now is the monsoon data, which they have updated a few days back. They have said there will be an early monsoon this month, maybe around 25th of May or 27th of May. So that will also add a lot of positivity with respect to reducing the inflation rate, as well as there will be good consumption story going forward on the back of the good rainy season going forward. And the result season, they're also giving very much neutral to positive updates. If you see today, Bharti Airtel and even Tata Steel, and also they are giving a lot of confidence for the large cap stocks to remain very bullish. So overall, the trend is very bullish and the undertone is very strong.
So speaking on the earnings season, as you've mentioned, now it has approached its last leg. Now 34 out of the Nifty 50 companies have reported their fourth quarter results so far. To talk to us about how these companies have fared overall, we are joined in by Mahima to share us details on this.
Overall, if we see, around 36 companies have come out with their Nifty 50 earnings. And let's look at how these companies have overall performed. Now, in terms of out of 36 companies, 9 companies were beyond what the street was expecting. So they did better than the overall estimates. In terms of 6 companies, they were below what the street was expecting. So they were below than the estimated earnings. And 21 companies reported earnings in line. Now, in terms of overall sectoral performance, 2 sectors, that is your BFSI and healthcare, outperformed. In terms of the underperforming sectors, you had your IT as well as FMCG and consumption. And some sectors which were in line in terms of where their earnings stands, that includes your cement, your oil and gas, as well as your retail and jewelry space. Now, in terms of the outperformers and the underperformers, the top performers included Adani Ports. The stock has been up 8% since its earnings, followed by L&T, stock up 3% since its earnings. ICICI Bank and M&M both up around 1% since their earnings. In terms of what worked for these companies, Adani Ports, it did beat FY25 revenue and strong FY26 guidance the management has given. For L&T, order inflow was up 18%, exceeding the overall guidance of 10% and revenue growth did beat the overall guidance as well. For ICICI Bank, net interest income and provisions were better than estimated, and a sharp asset quality improvement was seen for this particular quarter. In terms of M&M farm margins have surprised the street positively, and overall it is a positive start for EV, and brokerages have also penciled that in their ratings as well. In terms of top losers, Asian Paints was amongst the top loser. The stock has been hardly up 1% since then. Zomato down 1.15%, but Bajaj Finance and Infosys have seen a bounce back in terms of their stock reaction. But when earnings comes into picture, Asian Paints net profit was down 45%, weak demand to continue in Q1 FY26 as well. So the management commentary not looking very positive. For Bajaj Finance, negative bias was seen on the numbers, and overall FY26 guidance was also trimmed, which was seen negatively by the street. Infosys FY26 guidance was lowered, and FY25 guidance was overall not met. And lastly, for Zomato, we've seen food delivery growth slowing down for this particular counter, and this time management did come out and acknowledge the fact that competition is playing its part and that it might put profitability under pressure. So this is the overall view as to how all of these 36 companies have performed so far from the Nifty 50 universe.
Well, thank you, Mahima, for that overall comprehensive take on how the Nifty 50 companies have done so far. Now, Prashant, coming to you, some of the sectors which have outperformed includes the likes of BFSI and healthcare. On the underperforming, we have seen weakness in terms of where the FY26 guidance is concerned for IT stocks which are there. FMCG and consumption is another bracket, where we have seen weakness continuing. Want to get your overall sense in the Nifty 50 pack. What's your assessment on the sectoral outlooks? Which are the sectors that you prefer, and also if you have stock picks in this?
I think the BFSI would be the sector one should look more going forward from Q1 and Q2 earnings, because I think the way how government is spending and giving a lot of liquidity in the financial market, so I think that will bring a lot of credit growth in the banking system as well as in the NBFC system. But again, in this PSU should be highly focused. I think they are underperforming from last 1 or 2 quarters. So there will be good uptick in the PSU basket. So led by SBI, led by even Bank of Baroda. So I think BFSI should be the sector one should look at on a very positive side. Healthcare will continue to perform well. I think even from last 2 quarters, healthcare have driven a lot of positivity. Even outperformed the market from last 6 months. I think 2 quarters were really good. Apollo Hospital is leading the sector right now. I think with respect to the IT as well as the other sector which was underperforming, I think IT we are almost like worst is behind us. And once we are very much near to the 90-day period of Trump tariffs, I think IT will get a very concession best service tariff plan for Indian markets. So I think that would be giving a lot of short-term outlook to be on a very positive side. So neutral to positive on the IT sector, but again positive to very strong optimistic outlook on BSFI.
Okay, and Prashant, any stock picks that you have in this?
I think in the healthcare, I like Apollo Hospital a lot right now. Even I think there would be a good technical breakout in the stock. So with a target of at least 70 to 100 from the current level, a good position can be taken here. And even SBI in the BSFI banking space, PSU space, post the S Bank deal, I think the best beneficial would be the SBI as a profitability through when they bought it was 10 rupees and now they've sold it almost 21.50. So I think the profit booking of this will come in this first quarter of this financial year. So SBI would be one pick for me from my side in the banking space.
Okay, interesting take over the SBI cleared pick over here. But let's shift focus back to the IT space. Will IT be able to crack the code in FY26? That is one question on everyone's mind. We spoke to Ravi Menon, IT services analyst of Macquarie Capital, about the IT sector and whether if service companies will be able to capture the growth wave that is there. Here is what he had to say.
The large cap companies are so big. We are not talking about 20% growth for a TCS, right? I mean, that's not what we're saying. But we think the overall industry can actually be in like a 10 to 12% sort of growth range. That's the possibility for 3 to 5 years or even more. And I think that itself, and with the mid caps, of course, growing much faster than that, and select large caps within that, like a smaller one, like an HCL Tech, probably even delivering 12-15% growth, quite possible. And that's what we think.
Well, that's the view for the IT space that we are seeing. But coming to the defense pack, now we have 2 counters which are buzzing in trade today. Firstly, Garden Reach Shipbuilders. Now, that is one counter. If you are looking at the stock price movement, 15% up in trade. Now, this is on the back of its 4th quarter results that we are seeing, wherein the company has shown about a 62% of a growth in its revenue, while net profit saw about more than 100% of a jump. If you talk about the order book position of this company, it stands at 23,880 crore, and the order pipeline is of of around 1 lakh crore, which shows about a 5 times of an opportunity in terms of where the present order book is concerned. Now, do note that the company currently has about 10 projects, which includes 4 export projects as well. And the expectation is for about next generation Corvette orders that the company expects. Most of these orders that we are seeing are to be executed in the next 24-month period itself that we are looking at. So Garden Reach, one stock in focus. Another stock in focus is something like a Cochin Shipyard. Now, this is up over 10% in trade today. If you talk about the recent update in this, now Cochin Shipyard and Dry Docks World had partnered for ship repair hubs in India. So they would be developing ship repair and offshore fabrication hubs across India. Now, this collaboration is a follow-up of after MOU was signed with Dubai for India's maritime sector that we are looking at. In fact, we also had a note from Antique wherein they are saying they have maintained a hold rating on the stock and seeing that the current order book of 22,500 crore, while that provides a good revenue visibility going forward, it's the order inflows going forward which may be on a muted side compared to the other peers which are there, that's Garden Reach and Moscow Dock. So that is something that we should be watching out for. Also, the stock's performance going forward would also be tied up with the ordering of the indigenous aircraft carrier 2. So that is the view on Cochin Shipyard that we are building at. So Prashant, coming to you on the shipbuilding stocks, Cochin Shipyard as well as Garden Reach, what's your view on this overall space?
I think the space is very attractive post this India-Pakistan war. There was one ship which already performed well. I think the iron biggest ship in India right now. So I think the shipping business or shipbuilding business will have a lot of big order coming down the line in next 1 or 2 quarters. I know the way they are performing. One thing was missing from last 2 quarters was the execution capability and with respect to margin stability. I think Garden Reach has showed that kind of visibility. Now they can improve their EBITDA margins. So that would be the one reason why the whole space is very much in a positive sense. Garden Reach, again, in terms of valuation, I think Garden Reach, Cochin and Mazagon, Garden Reach still has very cheap in comparison with other two. So one can have a good position in this. Overall, the sector is very strong, focus from export orders as well as government focus.
Optimistic view is what we are seeing for these two counters. But another stock in focus is ITD Cementation, again on the back of its 4th quarter earnings. Now, the Q4 profit, if we are looking at, has jumped 27%, while margins rose to 10.5% versus 9.8% last year. Margins majorly in line with the management's guidance of 10%. It's the order book which is an important one to keep a track of. Now, if you look at the order inflows, they were lower than the guided range of 9,000 crore for the year. So outlook forward for FY26 would be important. Order book stands at 18,300 crore as of March 25, which is about a 2.1 times of a book-to-bill ratio that we are looking at. Do note that the company also announced a new order worth about 593 crore, and this pertains for construction work at Jaipur International Airport. So ITD Cementation in focus, but to discuss more on the outlook forward, we also had a chat with the management, so to listen into that as well.
Gradually, we see an improvement in our margins, and we are seeing that in the numbers that we are reporting as well. So while there may not be too much scope for the margins to improve, but yes, certainly our focus is on cost control and improvement of margins, and we'll see our margins inching up in the current year as well.
Mr. Prasad, what about order inflows? One, that the flows are slightly lower than the guided one. But broadly, if I look at the order book trajectory and the book-to-bill ratio from March 23 to March 25 now, that number has come off a bit. I mean, is it that you are consciously bagging lower orders, or is it that the system is throwing up lower orders?
Well, we are not consciously reducing our focus on order booking, so that focus continues. But yes, our execution rate has improved significantly over the last couple of years. So, we were probably doing, 1,500 or 1,800 crores a quarter, which has now gone to, about 2,400 crores in the quarter gone by. So while the pace of execution has picked up, there have been fewer orders coming up for tendering. Last year, the first quarter was a washout because of the Lok Sabha elections. And then gradually the pace picked up at a much slower pace. Basically we saw new orders coming up for tendering at a slightly slower pace than earlier. But government continues to focus on infrastructure, and we are pretty sure that going forward, we'll see, order booking, the pace of order booking also improving in the current financial year.
So would you reckon that FY26 could be different? Is it possible to predict that? And what is the guidance that you are laying out for order bookings for FY26?
Well, order bookings, difficult to give a guidance, but we are pretty confident that the order book will improve significantly in the current year. And we should be able to maintain or improve upon the execution as well in the current year. So a 25-30% growth in top line is definitely possible in FY26.
Well, that was the management of ITD cementation and the order prospects forward for FY26. Prashant, coming to you, do you keep track of this stock, ITD cementation? What's your view over here? Also, on the order pipeline that we have seen for majority of these players in the space, we have seen a muted side for state government. That was the point that my colleague Neeraj was trying to make. I want to get your overall sense on how the order pipeline is expected to be for the next year.
I think it was a great day for the stock once the results were out, plus the dividend was declared, and even a new order book was given from the northern part of India. So I think that was the reason why stock was up by 9%. But again, outlook on ITD cementation would be very positive from my side. I think the way they are growing their margins, I think from last 1 year they were struggling to have the double-digit margins in the EBITDA. So I think this quarter, in the March quarter, they tried to get a better than the last 2-3 quarters. So that would be one positive sense which I am looking. With respect to order books, I think yes, 15-20% growth in terms of quarter-on-quarter order book can be expected from the current business plan. Overall, the infrastructure space is very much positive. I think government focus more will be on the building large infrastructures, and then I think a lot of order books can flow into ITD cementation. So overall, from the 9,000 crore order book, I think the next year they can be at least 15-20% growth in terms of order book, and the execution is very much important right now. They are trying to get a lot of execution expertise and then simplify these things in every quarter. So 10-12% EBITDA margins can be expected from next financial year. This will bring a lot of business to the company.
Okay, so that's a view that we are seeing for ITD cementation. Another stock in focus is Tata Motors, and again this is on the back of their fourth quarter results, which were largely in line with what the estimates were. The counter held a media call yesterday. Puneet joins in with a con call highlights on the same.
Well, thank you for that. So definitely, quarter four results were largely in line. But I think the stock might be under pressure today, and that's because the company has refrained to give any guidance for FY26 for the JLR business. Now, guidance is something that the company usually gives, but they have cited, the tariff uncertainty as one of the key reasons for not giving guidance this time. However, they mentioned that they have an investor day which is planned on June 16th this year, and they will be looking to give some more details at that time, because currently they don't have the fine print of the UK-US trade deal as well. But that's could be something that the stock might be under pressure because of, and that's something to watch out for as well. Overall, revenue came in at 1.2 lakh crores, largely in line with estimates of 1.22 lakh crore, while the EBITDA margins are coming at 14%, which is a fall of roughly 60 basis points compared to the same time last year. But it's in line with it's beaten estimates which were of 13.3%, anticipating some slowdown in quarter four. And the discounts have been lesser, as well as the the raw material cost has also been controlled. When you look at the profits as well, it's down 51% to come in at 8,470 crores, and we highlighted that yesterday in our preview that that's because of a deferred tax write-back that happened the same time last year. So that's one of the key reasons. But still, its beaten estimates are roughly about 7,600 crores. So largely, as I mentioned, numbers were largely in line. But again, the guidance will be something to watch out for. In FY25, the company largely met its guidance. They had guided for 29 billion pounds of revenue. It's come in at 28.9, while they have gotten 8.5% EBIT margins for the full year, which was in line with what they had guided for. It's also important because in quarter four, they needed to make 10% EBIT margins for JLR business. They did 10.7 to meet the annual guidance. So definitely a big thumbs up on that aspect. But the guidance for FY26 has not been given. And one of the key reasons is that while the JLR manufactures roughly 75,000 units, which are exported to the US from the UK, they do manufacture around 28 to 29,000 units from Slovakia in EU, and that will have a higher tariff of roughly about 25%, which was earlier just 2.5%, and hence they have refrained to give guidance, citing some of these key reasons, because the higher tariff from these models will affect sales as well as margins going forward in the next couple of quarters, at least in the near term. So brokerages have also largely maintained their view. They have mentioned that there will be it's a tough year ahead, and a lot of uncertainty for Tata Motors. So might be under pressure because of the guidance aspect, but results largely in line for Q4.
Okay, so thank you for that, Puneet. One point that he kept reiterating was on there was no guidance given for FY26 while the margins or the results were largely in line with the estimates. Prashant, what's your view for Tata Motors and overall auto space if we are looking at for the next year?
I think with respect to Tata Motors, the near-term outlook could be volatile again. I think the reasons are very much penciled by the anchor again. The geopolitical momentum in terms of the tariff war, so that would bring in a lot of pressure in terms of global sales. So that will be one reason why stock may be under pressure for a very shorter period of time. But again, I would like to focus more on the margins, which are in line with what we were expecting, like the 14% average in last quarter. So they have delivered the same thing, and more focus would be on the JLR business model, obviously, and they are more focused on U1. I think the UK and India deal will have a lot of benefits in terms of importing the JLR as well as the Land Rover products into Indian market, so which will have a lot of sales in India. Second, again, the demerger plan has been approved, so I am looking at a very positive sense with that. I think in this financial year we'll have two companies like PV and CV. So for me, near-term outlook will be very much limited to the price action. But again, I think with 1 year, I see a lot of optimistic outlook for the stock. With respect to auto as a sector, I think we are almost like behind the worst. I think we will see a lot of good traction in terms of month-on-month sales. EV would be under pressure. I think by Mahindra is doing a lot of good sales in EV, and even MG is doing a lot of good sales in the EV segment. So Tata Motors EV sales may be under pressure, but the non-EV segment is going to perform well. I think that would be the segment where I am focusing more on. So demerger as a story, plus worst is beyond the markets right now for overall auto sector. So that would bring a lot of optimistic outlook for next 1 year.
Very interesting. The worst is behind for the auto sector. Well, that's something that we should be watching out for. But thank you, Prashant, for joining and sharing your view on a lot of these counters that we had discussed. But that's all the time that we had on this show. Stay tuned to NDTV Profit. Lots more lined up on the other side.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
welcome to NDTV Profit. A very good afternoon to all the viewers. You're watching Profit Buzzers. I'm Hiral Datia, and with me is Mahima Vachajani. Mahima, good afternoon. An interesting day of trade because 24,650 is where Nifty 50 has been hovering, and that's somewhere where the key resistance is, right? What is interesting right now is that you're not seeing selling that's coming at higher levels. So there is that momentum play, which is absolutely there. We are seeing gains of almost around 0.3%, but you're not at the day's highs as we speak. You are inching slightly lower from there. We did hit a high of 24,767 in terms of intraday trade in today's day. Let's quickly pull up Bank Nifty as well, and then we'll look at the sectoral play and the Nifty heat map. Bank Nifty, interesting, at the day's lowest levels with cuts of around 0.2% coming in there. And with this, if we can just have the PSU bank index to understand where is the pressure coming in from as we speak right now, because from the private banking space as well, it's an interesting move. See, the PSU bank index is what is trading in the positive with gains of around 0.4%. Let's look at the sectoral heat map. Defense as a play has been pretty strong. If we can have the sectoral heat map, there you go. In terms of individual sectors as well, you have metals, which is leading. The reason why metals is up today is the benefit it is taking from a Tata Steel, which is up nearly over 4%, and that's what is aiding the metal pack. Real estate is also doing pretty well over the last couple of trading days. What's losing is Bank Nifty, finance, private banks, and FMCG. FMCG absolutely on the borderline. The key question with FMCG is there a turnaround? Is there a conviction in the turnaround in the consumption story? Maybe for the next, not for the next 3 months, but from a 9 to 12 month perspective. So that is something what we need to watch out for. But apart from that, oil and gas in the positive, IT in the positive, energy, media, all of the other sectors which are trading with gains. Let's quickly look at the heat map in terms of individual stocks on Nifty 50 to get us a sense of the advanced decline there. Absolutely in favor of the bulls. Tata Steel, the top gaining stock in today's day of trade. Shriram Finance is another one which is seeing some smart moves as we speak. M&M again on the top line. Coal India trading in the positive. What's taking a beating is what is interesting. Cipla is under pressure. Asian Paints is under pressure, as well as a few of the other names like I'm not able to read the screen well, but few names which are under pressure as well. Mahima, the VIX is interesting, which is now receding. It's down 5%, but we're still at elevated levels of around 17.23. Anything above that is telling you that there is some bit of cautiousness and volatility which is still prevalent. Now, whether that is seen in the broader markets or not is what we need to wait and watch and see.
But today the broader markets are definitely outperforming the benchmarks. I mean, let's pull up the mid cap 150 up by around 1% and the small cap 250 also doing very well in trade today, up by about 1.4%. So the broader end of spectrum is doing much better than how the benchmarks are performing at present. In terms of some stock specific action to start with, some counters that are really doing well today, and largely it is earnings focused day, and plus some defense counters that are doing extremely well in trade today. There's Garden Reach Shipyard, there's Cochin Shipyard, there's Mishra Dhatu, something like an Ircon is also doing very well. So a lot of defense names plus counters on the back of their earnings are also doing well. Some counters like Fusion Micro up by about 9.8%, India Pesticides up by about 9%. ITD Cementation is also one counter that came out with its earnings. Good set of numbers, stock up almost 9%. Dalmia Bharat also doing very well on the back of its earnings. There's Railtel, DCX Systems also doing well. Some stocks although worth addressing as they are languishing. Raymond, of course, correcting on the back of its demerger since the record date is today. Kaveri Seeds down by about 6%. Sirma on the back of earnings down by 6%. Metropolis feeling the heat of earnings again, down by 5%. VIP Industries also not good set of numbers, stock down by about 5%. With that, let's also welcome in our guest for the day, Gaurang Shah, Senior Vice President at Geojit Investments Limited, joining us now. Gaurang, a very good morning to you. Just your sense as to the earnings that have panned out so well. We're on the last leg of overall earnings. What's the sense like here? Which sectors do you think have done extremely well, and which sectors do you think have languished?
Thank you so much for having me on the show, and good afternoon to all of you all. Well, first of all, to sum up, third quarter vis-a-vis the fourth quarter, I think we've done relatively well in terms of shade and color in the fourth quarter compared to third quarter. Most of the managements in their press conference PCs have guided well for the upcoming quarters this financial year. And our understanding says that the shape and color should improve as we go into the earnings season this financial year. Which are the sectors who have done relatively well? First of all, I think a sector which is not spoken much about is, of course, defense. Not only in the last couple of days, we've been positive on defense since the time the government of India announced FDI and liberated the sector with policy changes. The defense has done well. Financials, banking, finance, and BFCs have done well. Cement has done equally well. Capital goods engineering has delivered well. Overhang in terms of IT by default, fourth quarter is always every financial year. Fourth quarter is a little bit under the weather, no surprising, and of course the overhang of what happens to the US economy, etc. So these are some 5-6 sectors that we believe have done reasonably well, and our understanding is that going into the future, these earnings should improve, and that should re-rate certain stocks, and of course the overall outlook in terms of targets for Sensex and Nifty.
That's an interesting take, Gaurang, and I'll pick up from what you started off with in terms of where defense as a sector goes. Let's just pull up a 5-day chart in terms of the defense index, and that will tell you the kind of gains that you're seeing for this. And what is interesting is that clearly the policy framework, which is favoring indigenization, and the substantial government investment that is coming in with regards to defense as a sector is what is the key. In fact, the Defense Acquisition Council itself had approved orders worth over 8.45 trillion, and this was between FY22 to 25, which is almost 3.3 times the same number for the preceding 3 years as well. In fact, this will actually translate into significant order inflows for financial year 26-27 for defense shipyard companies. And you see the defense sector, a 10 to 11% up move you've already seen. In fact, two stocks from the space that are in focus are Garden Reach and Cochin Shipyard, both sailing on a strong footing in today's day of trade. Earnings plus other key highlights. Anushi standing by to tell us more. Anushi, tell us more in terms of both of these stocks. Strong order book, strong numbers as well.
Right, Hiral. So Garden Reach, if you are seeing, it's a particularly strong set of numbers that we are looking at. Revenue up around 62%. Margins also rose to 14% of a mark compared to 8.9%, and net profit over 100% of a growth that we are seeing. Now, do note that a lot of the shipyard companies, they follow the S-curve pattern, which is there. So revenue recognition may vary from quarter to quarter basis based on the execution which is there. But it's the order book which is an important point to consider. Order book stands at about 23,880 crore, and they have an order pipeline of worth about 1.06 lakh crore in the next 2 years, which is a 5 times of the size of the current order book that we are looking at. Currently, the company has around 10 projects, including 4 export projects which are there. And the focus now is for this year to get more repeat orders. There are expectations for next 2 large orders as well. So how that would pan out is something that we should keep a track of. On the non-defense side, focus would be on the shipbuilding and building green energy platform. So Garden Reach, overall a strong outlook is what we are expecting. While coming to something like a Cochin Shipyard, in the recent update we did see that the company and Dry Docks World had partnered for ship repair hubs in India, which means developing ship repair and offshore fabrication hubs across India. This collaboration was follow-up of the MOU which was signed in Mumbai with Dubai that we are looking at. If you are talking about the view for Cochin Shipyard now, Antique currently has a hold rating on the stock, saying that the present order book of 20,500 crore, while that provides a 5-year revenue visibility going forward, order inflows for the near time may be on a muted side as compared to something like a Masgao Dock and Garden Reach. But despite this muted order book that we are looking at, near-term revenue growth remains on the healthier side. However, the stock's performance would also be tied up with the ordering of the ISC-2, that's the indigenous aircraft carrier that we are looking at. So both of these counter strong up moves that we are looking in today's trade.
All right, so that's the view with regards to where all of these defense companies stand. Anushi, thank you so much for breaking that down for us. The next stock that we're focusing on today is ITD Cementation. The stock is up 8.5% as we speak. It did come out with its earnings as well. Revenue is up 10%, EBITDA up 17%. Margins in line with what the management had guided and a tad bit higher also as compared to what the management had guided. Net profit was up 27%. In fact, it also did secure a new contract worth rupees 593 crores. We also spoke to the management of the company, Mr. Prasad Patwardhan, the CFO of ITD Cementation, about whether they expect margin to improve further in FY26 or not. Here's what he said.
Gradually, we see an improvement in our margins, and we are seeing that in the numbers that we are reporting as well. So while there may not be too much scope for the margins to improve, but yes, certainly our focus is on cost control and improvement of margins, and we'll see our margins inching up in the current year as well.
Mr. Prasad, what about order inflows? One that the flows are slightly lower than the guided one, but broadly, if I look at the order book trajectory and the book-to-bill ratio from March 23 to March 25 now, that number has come off a bit. I mean, is it that you are consciously bagging lower orders, or is it that the system is throwing up lower orders?
Well, we are not consciously reducing our focus on order booking, so that focus continues. But yes, our execution rate has improved significantly over the last couple of years. So, we were probably doing, 1,500 or 1,800 crores a quarter, which has now gone to, about 2,400 crores in the quarter gone by. So while the pace of execution has picked up, there have been fewer orders coming up for tendering. Last year, the first quarter was a washout because of the Lok Sabha elections. And then gradually the pace picked up at a much slower pace. Basically we saw new orders coming up for tendering at a slightly slower pace than earlier. But government continues to focus on infrastructure, and we are pretty sure that going forward, we'll see, order booking, the pace of order booking also improving in the current financial year.
Right, so that was the management of ITD Cementation. Gaurang, the stock, in fact, is probably buzzing on the back of the big order win, because that's a big chunk. Q4, they did around 800 odd crores, but today they've received an order almost worth 600 odd crores rupees, and that's why we're seeing that uptick in stock. Because overall, in terms of earnings, Q4 revenue growth was slower as compared to previous quarters, as well as the FY25 order flows was also lower than what the management had actually guided for. What's the view like where ITD Cementation overall earnings stand, and what's the outlook like?
So, I'll give a general statement because we don't have coverage on ITD Cementation. So, look, I think the government is doing a lot in terms of policy changes. I was referring to the defense when at the beginning of the program, I alluded to the policies. Similarly is the case with, improving infrastructure, getting new infrastructure created, cleaning of rivers, etc., improving connectivity via waterways. So, the company has been on a good run rate as far as earning is concerned. And the only thing is, these kind of sectors, whether it is to do with infrastructure or complex infrastructure, or it is to do with connectivity, whether either by road or by waterways, or it is to do with the defense sector, the time gestation to execute the order book is equally longer. So there is a possibility wherein one or quarters out of the four, there could be a little bit of miss here and there. But should that prompt you to take an exit call from your investment? I don't think it would be a wise thing to do.
Right. So that's with regards to ITD Cementation. But moving to the auto pack, few stocks that we will be discussing is Tata Motors, Honeywell Automation, as well as Ask Automotive. To start off with Tata Motors, clearly the results were in line with what the street was estimating. What's interesting is there has been no guidance that has been given for FY26 in terms of JLR goes, and this is mainly on the back of tariffs. The production from EU will be hit on the back of tariffs is what they have indicated. And you have the Investor Day, which is scheduled for the 9th and the 16th of June. So there will be interesting commentary that will be coming in from there as well. In fact, let's hear out, short chunk from the conference call that Tata Motors had with the analysts as well to give us some bit of an idea.
As far as JLR is concerned, I think, as I said earlier in the tariff one, there are just too many moving parts and too many unclear. We need a lot of clarifications, let me put it that way, in terms of how it is going to get treated. So therefore, let's just wait for the investor day on 16th of June where we'll be able to give you a better update. Otherwise, I'm completely shooting in the dark, which is never our intention. We'll never do that. And growth-wise, as I explained earlier, I would expect to see growth this year, given that it has been a weak year last year.
That's for Tata Motors. If you can just pull up a Hero Moto as well on the screens, because on the back of the earnings, you have a JP Morgan, which has maintained a neutral, and they have a target price of 4,260. Goldman Sachs has maintained a sell, and they have a target price of 3,270. So clearly, if you talk about the target price, I mean, both of them have a divergent view. Goldman Sachs is saying they're expecting to make an EV launch in the near term, and they will focus on FY26 outlook plus the management transition. JP Morgan is saying that the margins have been in line. Raw material cost to sales has improved, and this is on an annual basis as well. So that's with regards to Hero Motor, which is absolutely trading flat, Tata Motors, which is under pressure, and you have a Honeywell Automation. The stock is seeing gains. Profits are down, but it's better than what the street was estimating. Overall, if you see in terms of the margins, they've seen a dip at around 14.3% versus a 17.9%. The stock is seeing marginal gains of around 0.7%. And apart from these, you have Ask Automotive as well, which has reported numbers. In fact, if you see in terms of Ask Automotive, revenues are up around 8 to 9%. Margins have come in at 12.2% versus a 10.5%. A 20% growth in terms of the profitability as well. And they have done a couple of new partnerships in Japan and for high pressure die casted alloy wheels for two-wheeler space. So that's with regards to the entire auto ang space. Gaurang, your quick view in terms of the few names that we mentioned: Hero Moto, Tata Motors, Ask Automotive, as well as Honeywell.
Well, so last two we don't cover, but Honeywell Automation, it's a very niche kind of a company, and they are, they work in ultra high tech environment. And the volumes are very, very thin if you actually go to see. But one of the most strongest companies in terms of the sector that it caters to. Ask Automotive, again, we don't cover, but yes, Hero MotoCorp and I beg your pardon, Tata Motors. So here is the problem with Hero MotoCorp and why it became an underperformer compared to the likes of the Bajaj Auto and the TVS Motors or the Eicher Motor, because they manufacture Royal Enfield motorcycle giant, is primarily because of a little bit of lagness in terms of R&D, concrete focus, and of course launches. But I think all that is now a thing of the past. I think the company has realized that if you have to stay in the race, you have to do what you have to do. And I think with that perspective, they are going to do much better. We have a positive coverage on Hero MotoCorp with a target of somewhere close to about 5,300. On Tata Motors, I think there is visible improvement, and that's what we were looking out for in terms of green shoots. Our understanding is that the trade agreement between UK and US will enable high-end segment products like JLR to penetrate much better. Margins could improve. Overall impact of negativity has reduced by 10%. India and UK also has finalized the free trade agreement. I think we should be delivering that sooner rather than later. And of course, between India and US, I think the progress is quite good in terms of the tariff and other trades. So we are positive on both Hero MotoCorp and Tata Motors.
So that's an interesting view coming in between the two. But moving on, Standard Glass Lining is the next stock that we are putting the spotlight on. What's interesting is 4.5% is the kind of gains, and this is on the back of a new product launch. In fact, they formed a strategic partnership with Japan's AGI group. To discuss more in terms of what does this mean, joining us is Yasuyuki Ikeda, Non-Executive Director, as well as Nageshwar Rao Kandula, MD at Standard Glass. Welcome to the show, gentlemen. And my first question coming to you is, how big an opportunity is the new product launch? One, it's a 20-year license, exclusive license, and this is to make glass-lined shell as well as tube heat exchangers. So if you can tell us the opportunity size firstly.
Thank you for opportunity. And this shell and tube glass lining heat exchangers, except Japan, we are going to sell in the globe and India. India have opportunity 2,000 crores, and globally this shell and tube glass lining heat exchangers 2 billion we are estimating. That is present opportunities available for this product.
Okay, Mr. Ikeda, this is Anushi joining in. I want to understand from you now this strategic partnership that we are looking at. It is one of a kind in India. We are seeing a potential of around 2,000 crore itself, while for the global side, we are looking at a $2 billion of an opportunity. Just want to get your sense on how this could mean for the company going forward. What's the kind of incremental flows in terms of where the order pipeline is concerned?
Recently, we 1 month back we started booking, and based on limited capacity production, we are now present. We are importing complete this heat exchanger from Japan, and order is almost within 1 month we received 150 numbers order from customer response. Customers are very exciting because of this is graphite heat exchangers, and high equipment have a lot of limitation. Graphite releasing particles in pharma area and a premature failure and batches failure. This is complete solution. This is a robust design glass lining shell and tube heat exchanger. This is high performance and a complete solution for pharma area. So December on partially we are started assembling in India, and we are importing from Japan, and full-fledged December onwards we are going to produce 200 heat exchangers per month in India, assembling in India.
So help us understand in terms of the revenue potential that you will see out of this agreement. So say, for example, X is the revenue that you're seeing in terms of FY25. What's the incremental addition you will see in terms of your revenues and in terms of your order book?
Glass lining area, we are expecting at least to only particularly glass lining area first year, means this may be next this 3 quarters, coming 3 quarters is partially revenue going to add, but last quarter going to add another 15-20% glass lining area, particularly this product, and 26 financial year I believe this is going to 30% impact in top line in the glass lining division.
Okay, so while the expectation is that these operations will start from fourth quarter of FY26 onwards, just want to get an overall sense. Now, you're considering that the guidance you have given is for a 650 to 670 crore of a revenue for the year of FY26. So, considering from there when we move to FY27, what, if you can quantify the number for us, what is the kind of growth that you expect from with the kind of more incremental orders coming from this side?
Let's see, overall business is going to this coming year, we are going to grow 25 to 30%. I'm sure that.
Right, and next year onwards, FY27, if you can give a picture, is that the long-term target also that we are looking at 25 to 30%?
Long-term target also continue. This is unique product, and coming months through GLACO, one more product we are signed, that is conductivity glass lining. This is going to increase the plant safety. And now whatever we are using non-conductivity glass lining reactors, that due to that non-safety issues are there, we are going to address for that also. Coming 2 months, we are going to launch this product officially.
In fact, let me also ask a question to Mr. Yasuyuki. How are you looking at this strategic partnership as well, and what's the kind of opportunity you're seeing?
Okay, so GL Hakko, we have a limited production capacity in Japan, and as you can imagine, the production cost in Japan is a lot higher than India. And if we try to export everything from Japan, it just becomes too expensive for the Indian customer, and the lead time is too long. So we decided to make a partnership with a standard glass lining, so that we can provide a Japanese quality at the affordable price for the Indian customers. And having this glass line shell and tube heat exchangers in the market, replacing graphite heat exchangers, customers can get a lot of benefit from this product, and the safety will increase, and also the productivity will go up, because the lifetime of this is depending on the chemistry, but the lifetime normally is a lot longer. So I see a great, this this will be a great opportunity for us as well.
Absolutely. So that's, I mean, an interesting point that you're making as well. So that's Standard Glass, clearly on a strong footing in today's day of trade. Thank you, gentlemen, so much for joining us on the show and sharing your views. If we can just quickly have a 6-month or a 1-year chart as well in terms of the stock. I think it's a recent listing, if I'm not mistaken. There could be some bit of moves that you would see. 3.5% is the kind of up move that you're seeing in today's session. If we can just have a longer term chart since listing, that will be interesting to watch out for. 6 months, 3.5% is the kind of downtick. So I think it's listed, I think, in Jan or February. So that's the view in terms of Standard Glass. But let's quickly slip into a short break, and thank you, Anushi, as well for joining us in this conversation. We'll be right back with lots more on the other side. Please stay tuned to NDTV Profit.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Welcome back. You're watching Profit Buzzers. Now, the next counter that is in focus is Bharti Airtel, and this is on the back of its Q4 numbers, which are in line with the estimates. And Soumit joins us with more details on that. Soumit, what are you picking up?
Well, if you look at it on a consolidated basis, the Bharti Airtel numbers are pretty much in line with what the street was expecting. Revenues were higher by around 6%. EBITDA came in higher at 10%. Margins came in at 56.4%, which is the highest that we have seen in at least the last 5 years. While the net profit number, that was down 25% on a sequential basis. Now, net profit was lower on a sequential basis owing to exceptional gains that were there in the base quarter. But when you compare it with the analyst estimate, net profit number was ahead of the street estimates because of some tax reversals that we had seen in the fourth quarter of FY25. Now coming to the key business of Bharti Airtel, that is the India mobile business. There the growth slowed. The revenue and EBITDA growth was around 1.3 and 2%, which is the slowest or the lowest that we have seen in the last 8 quarters. Apart from that, if you look at the DTH business, that reported a weak set of numbers yet again on the back of higher cost. Broadband segment reported strong set of numbers on the back of subscriber additions and stable ARPU, while the enterprise segment, here the revenues were down 6% because the company had decided to exit the low margin businesses. But because of this move of Bharti Airtel, the EBITDA, that increased nearly 13%, which is the highest growth that we have seen in at least the last 5 years, while margins were at its all-time high of around 42%. Now if you look at the India mobile business, there the 4G and the postpaid subscriber addition grew at around 2.5% each, while the data consumption on the network increased by around 4.5%, and this clearly reflects that there has been strong subscriber addition when it comes to 4G and 5G users. When it comes to the net debt part, that was up around 4% on a sequential basis, but this was largely on the back of the capital expenditure, purchase of Bharti Airtel Africa's stake, and because of other factors as well. Now if you compare Airtel's number with Jio for the full financial year, Airtel has outperformed Jio compared on the revenue, EBITDA, ARPU, subscriber and data traffic basis. Their growth were much ahead when compared that to Reliance Jio for the full financial year.
Thanks, Soumit, for getting us the details. So that's with regards to Bharti Airtel. You have another one from the pharma pack, which is in focus, which is a Cipla. The company has reported numbers. If you see in terms of supply, it is one of the top losers today with cuts of 1.5% coming in there. Macquarie has maintained an outperform and they have a target price of 1,875. Nomura has a buy and they have a target price of 1,780. What's interesting is Macquarie saying that in terms of their FY26 guidance, that is seeming absolutely conservative. However, in the last 3 years, the company has constantly beaten its own guidance regularly for the past 3 years. In fact, the North America generics market is something which has declined for the company in spite of the ramp up that they've seen in terms of lanreotide supplies. And the launch of differentiated low competition products is largely on track. In fact, let's also hear in a slice of that conversation that the management had in terms of with the media on a con call.
If there is a tariff, firstly, there is none on pharma as of now. But if there is a tariff, then I would think, A, the tariff is going to be significantly lower than it is for regular goods. B, whatever that is, I think will probably have to be divvied up between, being passed on to the customer and for some of it to be absorbed by the companies themselves. So I don't, as of now, we don't think it's going to be very material into the net impact of this for any company, or at least for us. I can't comment about the rest. But I don't think there is one answer on whether everything will be passed on to the customers or everything will be absorbed. I think it's going to be a combination of the two.
All right, so that's with regards to where Cipla stands. The next focus is an EMS stock, that is Sirma. The stock is languishing in trade today, and this is after its Q4 earnings. In terms of the stock performance, it's down by about 6%. We spoke to JS Gujral, MD of Sirma SGS, about their top-line growth outlook for FY26. Listen in.
We achieved a top line of about 3,800 crores this year in FY25. Going forward, I think we would be growing at about 30 or 35% for the next year, and maybe at the same percent or marginally higher or marginally lower percent in 26, 27. So I don't think that matches up to the 6,500 crores you said, but my growth will be about 30, 35%. What we had shared earlier this year, that we are recalibrating our strategy to focus on high margin verticals. And that is essentially the industrial, the healthcare, and the automotive. And I'm very happy to share with all of you that in the current year, we have been able to bring down the low margin consumer business to about 35% of our revenue, which was a target which I had set for ourselves. And the balance 65% is a high margin business. Going forward, we'll try to recalibrate this again and endeavor and bring down the consumer business to below 35% or closer to 30% by the end of this year on a year-on-year basis. Now, if that was to materialize, then I think we are on track to achieving superior EBITDA margins of about 8%.
Right, so that's with regards to where Sirma goes. The stock, though, has been trading under pressure. But moving on, you have Ventive Hospitality. That's the stock that is in focus on the back of earnings. Stock down 2.5% in today's session. What's interesting is the kind of numbers that have been reported, because overall it has been an absolutely strong set of numbers. In fact, it has been better than what the street was estimating. It seems that the outlook and the demand is also looking pretty strong, because if you see the revenues, a 5.5 times kind of a growth coming in there. Margins have dipped to some extent. However, the profit number is up nearly 2.7 times as well. To discuss more in terms of how the quarter has been, what's in store from here on, Atul Choradia, Chairman at Ventive Hospitality, joins in. Atul, good afternoon and welcome to the show, and a pleasure to speak to you at NDTV Profit. This is Hiral on the side. My first question coming to you is, what has led to this kind of growth? And number two, is this something which is going to be sustainable in FY26 and 27?
Yeah, so before I get into Q4 numbers, I would like to highlight that the company has crossed two important milestones: revenue exceeding 2,000 crore and EBITDA of over 1,000 crores on a pro forma basis. With this, we are among top 4 listed hospitality companies. Q4 was the best quarter in Venteam's history we delivered. That was about 717 crore in consolidated revenue. That is up 20% year on year. 270 crore in hospitality EBITDA, a 47% year on year increase. So consolidated EBITDA margins at 52%, possibly the highest in the industry. Consolidated hospitality margin at 46%. So this was driven by strong room and F&B performance, MICE-led demand and cost efficiencies in both India and international.
Mr. Chorade, hi. Mahima also joining in this side. Just wanted to understand that right now 80% of your overall portfolio is luxury, where hospitality comes into picture.
Yes.
Just wanted to understand that will this ratio change going forward? Will it go beyond that 80% mark? And overall, you've also said that you're planning to explore newer markets and newer segments. What will those segments be?
So yes, we are positioned ourselves only into the luxury segment in India and internationally. Going forward, also we will be in the same segment. So we are not doing more of mid-segment hospitality. We are just focusing on 5-star and 5-star super deluxe segment.
Okay.
So going forward, we are doing about 3 hotels which are under finishing. One is in Sri Lanka, Ritz-Carlton Reserve. Other one is in Varanasi, a Marriott. And in Bangalore, we are flagging a new brand called AC by Marriott.
Okay. And in terms of geographical expansion beyond that, Sri Lanka, Maldives and India, is there any other geographies that you're planning to explore outside India and even inside India? I mean, this from a longer term perspective, let's say 3 years down the line?
Yes, we are definitely, we have kept our eyes open, whether internationally and in India, we'll be expanding it. So it's not that we're going to stick to Maldives and Sri Lanka, but yes, we are exploring all over.
Okay. Atul, the other part in terms of expansion is, you had mentioned earlier as well, 5,000 keys in the next 3 to 5 years through new construction is what the aim is, right? Done through acquisitions, done through rights of first offer. There are 2 projects which are already under development that will be ready by FY28, which is, if I'm not mistaken, 350 to 400 keys. Is this on track? And if so, what's the kind of, capex that you will need? Because on one side, expansion is at play. The other side, you already have your debt reduction, which is happening pretty fast. So what is the strategy?
So our company is doing almost 1,000 crore plus EBITDA. So that is a free cash flow. Technically, we have a annuity portfolio, which is where we have leveraged it. Hospitality, the hotels are debt free. And if you take a 5-year horizon, we'll be earning about 6,000 crore. Out of that, even if 30% goes back to the bank on repayment, I still have about a good 4,500 crore to invest. So we have 3 hotels which are under construction, which will be through the cash flow. We are not taking any debt on that. Plus, we have about 3 ROFO assets, which are in New Bombay, 500, 450 room JW Marriott and Moxie in Pune and again New Bombay. And we are still open to do any acquisition if it comes our way. At the moment, we have just diluted 11% of our company. We still have to dilute another 15% over a period of 3 years. So we'll raise enough capital and we have enough liquidity for expand, even without taking any more debt.
Atul, an interesting point that you made, you're saying another 13 to 14% equity dilution that could be on the cards in the next 2 to 3 years. That's yes. One. And 2, what's the status in terms of the promoter pledge? Because if I remember reading correctly, 100% of the promoter pledge was, promoter holding was pledged for almost around a $180 million loan, right? Is that correct? And if so, what's the status now?
No, so there are 2 promoters for this company. One is Blackstone and one is Panchsheli. So we have not done any secondary sale. We have just done primary. And the pledge was done by Blackstone and not by Panchsheel.
Okay.
So, and we can raise the capital whenever we want and whenever it is required.
Okay. And Mr. Choradi, you did mention that you don't plan to raise any further debt. Just wanted to understand, because through IPO proceeds, your debt has already reduced from that 3,400 odd crores to around 1,700 odd crores. This is your net debt figure. Just wanted to understand further how much of a debt reduction is on the cards in FY26, and from a longer term perspective, overall, what are the debt reduction plans?
See, we are a AA rated company by ICRA. Our debt cost is very low in the industry. My debt cost is from 7.4% to 7.9%. So my average debt cost is 7.75%. And we have enough cash flow to support all our new acquisition and growth.
Okay. Atul, the other question I have is, acquisition has been one of your key strategies. I think the acquisitions that you did back then in 2024 as well, that actually significantly scaled your portfolio. In terms of looking ahead, what is the strategy with regards to future acquisitions, and how do you plan to leverage that, from a strategy perspective, because that in turn reduces your capital costs as well?
Acquisition strategy, we are looking out for some hotels. Blackstone is very much fronting this part. I'm more focusing on the construction and putting up the new assets. But we are certain that we will do some acquisition in the current year and next year also. So I cannot reveal all my acquisition plans, but we will expand our room count from 2,000 to close to 3,000.
And Mr. Choradi, I just wanted to understand in terms of the mix between your hospitality as well as the annuity assets, will there be a change going ahead? Will there be more concentration towards hospitality as compared to annuity assets?
Yes, our annuity will remain the same, or maybe it will increase a little bit, but our focus is to increase the room count and F&B outlets. Currently, we have 1/3 annuity income. To our EBITDA, 1/3 is international hospitality income and 1/3 is Indian hotels. And my debt is only on the annuity business. My hotels are technically debt-free.
Okay, and so then how does your margins then change? Because I believe that you've given your guidance for Indian hospitality at 42% in the next 2 to 3 years, and for the Maldives business around 35 to 36%. What are the levers that you're penciling in for this kind of growth, and what will the blended margins be at?
Our aim is to reach at 42% margin in India, and for hospitality in Maldives will be around 42 to 46%. Maldives is a cyclical, it's a business. So my first 2 quarters are usually low and the end 2 quarters are extremely high.
Okay, so overall blended margins, what are you aiming at, let's say 2 years down the line, considering your annuity business, your India business as well as Maldives business?
Blended, we will be close to 45%, 45-46%.
Okay, and lastly, Mr. Choradi, I just wanted to understand that overall in FY25, you've done a top line of 1,600 odd crores and bottom line of 165 odd crores. Just wanted to get your sense as to what is going to be the run rate at which you're penciling in growth for the next 2 to 3 odd years, and FY26 year end, what is the kind of growth in terms of percentage? I know that you don't give guidance, but in terms of percentage, what is the growth that you're aiming at?
I'll just give you 23-24, we did about 869 crore EBITDA. 24-25, we clocked 1,012. That has been a good 18 to 20% growth. And going forward, I feel we'll grow at the same run rate.
So that run rate becomes crucial as well. But thank you, Atul, so much for joining us on the show and sharing the views. Clearly, the stock has been under pressure today, but from a valuation perspective, if I have to say, it is one of the most expensive stocks in the hotel industry. And I think I'm sure Mahima will have to add some input on that front as well, because I think 85 to 90 times is what Ventive is trading at as compared to any of your other hotel companies. If you can just pull up a long-term chart as well to understand the kind of performance the stock has given, because volumes are pretty okay on this one. 2.5% is the kind of cuts that you're seeing today. 802 was the intraday high, but in the last 1 month, you've seen a slight uptick that's come in, 8.5%. 6 months again, it's a very topsy-turvy ride that the stock has seen. So that's with regards to where Ventive Hospitality goes. But moving on, another stock that we need to discuss today is a Metropolis. If you see in terms of Metropolis, the profits of this company have slipped around 20% on a year-on-year basis, and that is what is keeping the stock under pressure. The stock is seeing cuts of nearly 5% coming in there. In fact, there is a one-time cost impact of nearly 21 crores in terms of Metropolis, and that is what has impacted the profit. The estimate was around 39 odd crores on that one. Apart from that, there has been a one-time cost related to 3 acquisitions that Metropolis has done as well. The cost linked to the legal and professional fees is what they have indicated over here. Their adjusted EBITDA, however, is higher by around 5%, and that's not what the street is still looking at. Adjusted EBITDA margin comes in at around 24.3% versus a 25.5% as well. But pressure continues with regards to where Metropolis goes. In fact, let's welcome in Brijesh Ale, Head Technical and Derivative Research at IDBI. Brijesh, 2 stocks, Ventive Hospitality that we just spoke to the management, and a Metropolis Health. Ventive, now major moves in the last 6 months. It's a 9 to 10% move, pretty topsy-turvy charts. And a Metropolis which is trading under pressure in today's session on the back of earnings. What would your call be on both these counters?
Hi, afternoon. So basically, if I do look at the this Ventive hospital, so I think we have a very small limited chart, but whatever I can see and make out from the chart pattern, it looks like there can be a positive move. Basically, the structure, the averages in the technical formation is looking positive. So I believe this recent high of this 840, which we saw a couple of days back, I think that can be retested. And then in the near term, we can speak about another 15-20% kind of a rally in this particular stock. So it would be more of a directional trade. So somebody wants to take that bet, I think that opportunity can be there. And the lower side, the level of 700 has acted as a demand zone. So anything below 700 should be the stop loss. And with that reference, somebody wants to take the long bet, I think that can be there. Now coming to Metropolis, specifically, I'm not very sure how this stock will trade, because the near-term charts it suggests there can be a sell-off, and there has been a continuous selling in this particular stock. And when in the recent trade, when there was a bounce, it has got sold off. So I think today again there has been a fresh sell-off, which distribution has been happening in this particular space. So I think outlook looks slightly cautious. Maybe from the 1600 level, this may come back to 1500 level.
So 1500 is what you should be looking at in terms of Metropolis. Thank you, Brijesh. But let me quickly address HAL, that's Hindustan Aeronautics, where the numbers have just come in. The stock is seeing gains of 2.5%. The expectation was of a revenue decline, and this was mainly on the back of execution delays in terms of the manufacturing order book. But if you see the profit number, that has seen a downtick of around 7.7%. That has come in at 3,977 crores. That is what you're tracking in terms of the profit number. Revenues have seen a dip of around 7.2%. 13,700 odd crores is what the top line number has come in at. So yes, the decline in terms of revenue was on the cards. Quantum was not something that is known to I mean, because the expectations from analysts have been very varied. Execution delays in terms of manufacturing order book is the key concern why you're seeing a dip in terms of where the top line number goes. Apart from that, in terms of the commentary, if there is a shortfall in the LCA and the ALH deliveries is what we should be tracking. In terms of the order inflows pipeline for FY26 as well is going to be crucial to look out for. The margin number is going to be interesting. EBITDA is down around 10.3% and the margins have come in at 38.6% versus a 40%. But this decline is mainly on the back of a high base, and that's the reason why I don't think so the numbers are reacting as well. Your previous quarter margin number was 40%, high base, and hence the decline was absolutely on the cards. But now you're seeing the stock which has slightly started to correct as well. Mahima, any other updates that you can pick up from the press release so far?
Right. So what I'm seeing here right now in terms of the earnings that they've come out with, press release is yet to come out, but other income has inched up. In terms of cost of raw materials also, it's an uptick of around 40% odd. Overall inventories have inched up as well, and probably that's what is something weighing on the numbers as well. Employee cost has also slightly gone up. In terms of finance cost, that has come down, so that's a positive one. Depreciation overall has inched up again. They've also have had an overall direct input to WIP expenses which has come down significantly. Other expenses have also inched up by around 10 to 12 odd%. In terms of the overall view in terms of taxation also, I mean, it's better than what it was in Q4 FY24. So all in all, that's with regards to the P&L picture. In terms of the overall commentary, there was a out-of-court settlement from Government of Maharashtra, which was for some 7,000 odd lakh rupees. There is also a revision of pay scales that have taken place, which have kind of inched up the employee cost as well. In terms of inventory, the management has said that it was damaged due to floods caused by some effect, and this has an inventory estimated loss of around 78 odd crores. So that is also penciled in. In terms of the 4th June 2024 overhauled Su-30 aircraft and SB-182 got crashed, and insurance policy impact is also there in this particular statement. Overall, there was a cyber fraud that was also reported by the company in this quarter, and so this is the overall view as to where the numbers stand for HAL. The stock is not reacting much to the earnings, and in fact almost at its day's peak right now, but the overall picture in terms of how the stock is fared has remained fairly stable during the day. Brijesh, quickly on the charts, a lot of these defense counters have been buzzing. What's the view like in terms of where momentum stands for HAL?
The directional trend for the HAL is positive, and I think before this, during the start of the day, there was a lot of call writers at 4,600 who has unwinded their short positions, and during the day, 4,800 and 4,900. So these prices, there has been a fresh longs has been added. I think this decline, whatever while we are speaking, the stock has been correcting. I think this is an opportunity, and I believe 4,600 will be held, and somebody wants to take the trading opportunity. Even the 4,600 call option can be bought at this level. That's clearly a trading bet. And this momentum came from the level of 4,500. So I believe whatever the corrections might come, this 4,500 will be respected. And I think this can be an opportunity. Since there has been a shift in the call writing position, I think this will go back to 4,800 level.
Right, 4,800 levels, and any dips could be a buying opportunity with regards to AHL. That's the word coming in from Brijesh, but interesting moves on the counter because it's seeing a good amount of correction from the day's highest levels as well. And one more aspect I want to note out over here is that with regards to the military roof cockpit development, the supply contract was with CAE Canada, where the company expected the cockpit that was purchased from HAL to CAE for further fittings and is currently awaiting the delivery. Now, there has been a cost escalation that has come in on that front, so they are awaiting that impact as well with regards to the final quote and delivery schedules as well from CAE. What is the kind of impact it will have on HAL's deliveries is what needs to be watched out for, but that's the clear picture that we're getting in terms of some of the aspects as well. But moving on, let's quickly look at two other names, Coromandel and Nykaa. Both of them have been added to MSCI Standard Index, and this is in the May 2025 region. Coromandel is now trading at the day's low, cuts of around 4% coming in there. Nike also at the day's low with marginal gains on that front. Now, Coromandel could see inflows of around $220 million, whereas Nykaa could see around $180 million. What's interesting is that Paytm has not been added and Thermax has not been deleted. Let's look at all these four counters, Brijesh, and see where are you seeing interesting charts where there could be buy or sell strategies.
So if you ask me specifically for the Coromandel, I'm not very confident because the stock has already seen a very decent gain, and today there has been a profit booking. So this extension of this profit booking can be there, and then there's a possibility that this can come back to 2200, 2100. So no fresh buying. Anybody is having a position should take the profit is what I can suggest as of now. Nykaa is looking good on charts. Recently, there has been breakout for the level of 200. So possibly we can talk of another 10-15% kind of a bounce. 215 is what the maximum move I can see. So mostly if I'm having a position, so I will be holding for 215 levels. Coming to Paytm, Paytm has seen some kind of buying, but it is still in that consolidation phase. So I would, if somebody is having a position, should hold on to the long position because there's a possibility that we might see 900, 930 levels on the higher side. So that this stands to be immediate upside, but then if that level is taken out, then maybe further upside can be there. But on an immediate basis, 900, 930 can be seen on Paytm.
Okay, and your quick view on Thermax as well?
Pardon?
Thermax. Okay, we seem to have lost him. Okay, you're looking for the charts. Okay. How are the charts faring for Thermax is my question, Brijesh.
Understood. But Thermax may be a very small move, not too much of aggressive. From the current level of 3400, some buying can be seen. The level of 3600, 3650 is a resistance zone. So not too much upside, 200, 250 points. That can be a small trading opportunity, but not from the directional point of view.
Okay, thank you so much, Brijesh, and I believe we'll have to let you go at that. So thank you so much for taking out the time and speaking with us at NDTV Profit. All right, let's shift focus to the tourism space. Indian tourists are taking mass revenge on Turkey and Azerbaijan for extending support to Pakistan during the clashes between India and Pakistan. Remember, Turkish-made drones were shot down by the Indian armed forces during the firing and attacks took place. Sesa Sen joins us with more details on that. Sesa, what are you picking up?
Tour operators and online travel agents are seeing mass cancellations of tours to Turkey and Azerbaijan after these countries publicly supported Pakistan in its conflict with India. In just 6 days, over 50% of the bookings to these destinations have been cancelled, with IsMyTrip reporting 22% cancellations for Turkey and over 30% for Azerbaijan. Now, these cancellations follow a travel advisory issued by the platform on May 9th, urging travelers to avoid non-essential travel to these countries. Other agencies like Ixigo, Cox & Kings and Pick Your Trail have also suspended new bookings, and smaller operators are also seeing significant decline in bookings as well as cancellations. Now, despite the political tensions, India remains a key source market for both these countries. In 2024, around 3.3 lakh tourists visited Turkey and 2.4 lakh visited Azerbaijan, spending over 3,000 crore, which the industry now suggests should be redirected to India-friendly destinations. Over the last few days, the call for the boycott, further intensified, with Indian authorities confirming that the drones shot down near the border were of Turkish origin. Prominent figures including Harsh Goenka, Rupali Ganguly, singer Vishal Mishra have urged Indians to avoid traveling to these countries or has cancelled their upcoming shows. Travelers are seeking refunds, postponing plans, or choosing alternative destinations like Thailand and Greece over Turkey and Azerbaijan. Industry experts also warn that these cancellations could continue for the next 6 to 9 months, potentially surpassing last year's Maldives crisis, which cost the island nation around $1.8 to $2 million. Airlines are also at risk. Currently, Indigo, Turkish Airlines and Azerbaijan Airways operate flights between India and these countries, but they may now be forced to reduce capacity if demand continues to decline.
Thank you, Shesha, for getting us the details as well. And these are interesting times as well when you talk about the tourism world, Mahima.
Absolutely. It's interesting because, we've seen the stocks also perform well yesterday after the entire 32 airports. Travel was allowed from those 32 airports
from
as well.
hospitality names to even stocks which are related to your airlines, all of them saw a strong footing, and let's see how they could perform from here on. But completely out of time. With that, it's a wrap on this edition of Profit Buzzers from Mahima, the team that put that show together, and myself. Lots more lined up on the other side. Please stay tuned to NDTV Profit. You'll have Somit Sarkar next.
That's huge. That is a biggie. It's out of there.
गोल्ड ग्लास क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial.
Hello and welcome. You're watching Top Trades on NDTV Profit with me, Somit Sarkar. Now, if you look at the Nifty chart for the better half of the day, we were trending lower from 24,750. We touched the low of 24,550. But in the last half an hour, we have seen a sharp up move of around 100 odd points. When you look at the sectoral data, other than the banking and the financial names, all other sectoral indices are trading in green. The Nifty Metal Index is the top sectoral gainer, gaining around 2.3%. Largely, these gains are led by Tata Steel, which is one of the top Nifty gainers in trade. On the losing side, as I mentioned, the financial names and the FMCG counter is down around 0.2% in trade. Apart from that, on the gaining side, again, it's Nifty Real Estate, Nifty Energy and Nifty IT among the top gainers. It's for the third consecutive session that we are seeing a sharp up move in the broader market. In fact, the broader market have been outperforming the benchmark for the third consecutive session. When it comes to the FNO names, it's Aditya Birla Capital, Titagar Rail, NBCC, Nalco, Steel Authority of India and MCX that have been gaining more than 4% in trade. While in the cash market, it's stocks like Garden Reach, Dredging Corp, Dynamic Cables, Om Infra, Fusion Finance, which have been gaining more than 10%. On the losing side, it's RAC, which is down more than 3% in trade. Tata Motors down 2%. PFC again on the back of the weak guidance coming in from RAC, that stock is down around 2% in trade. Asian Paints down around 1.5% in trade. But yeah, it's the broader market that has been outperforming the benchmark. And let's also welcome in Sharmila Joshi, the founder of sharmilajoshi.com. Sharmila, are you expecting this outperformance in the broader market to continue for a time, for a while now going forward?
Well, I wouldn't say that all stocks will kind of continue to give you the returns that we've seen, but there would be, I think, sort of themes playing out. Like we did see the entire defense theme play out when we had the war situation going on. And I think now it will be, the focus may shift to stocks where earnings are strong. And we are seeing that in a number of stocks, quarter four earnings have been fairly decent, and corrections have been very severe in the mid-cap space. So you could see some amount of buying return to such names. So I think it will be, whatever is the theme of the day. And I think the sustained buying will come in good stocks where earnings are good, valuations are good. So my focus is clearly on those stocks where we've seen good corrections and you like the stock from a longer term perspective.
Right. The focus remains now on banking and NBFC names. RBI is preparing to introduce tighter norms for unsecured personal loans, signaling concerns on the growth and potential vulnerabilities of the retail credit. Sources told to NDTV Profit. My colleague Shubhana joins us with more details over the same.
That's right. The RBI is actually planning to bring in tighter norms for unsecured loans as it is still concerned with the growth in this segment and the potential vulnerability that it brings in. Sources are actually telling us that RBI is actually nudging select banks to strengthen their internal policies and to bring in stricter threshold limits for such unsecured loans. What sources are also telling us that the RBI could ask banks to cap the limit on these unsecured personal loan borrowers. And what they're also saying is that these would be based on their ratings and credit score. So, for example, if a borrower has a personal home vehicle, a home loan and a vehicle loan, then in that case, banks would have to exercise caution and assess whether they want to give out a personal loan, and if they are, then how to. What sources are also telling us that right now the RBI is suggesting this to banks, and they would formalize this into a draft notification, and this could come out as soon as within the next fortnight. While banks already have their internal limits, but RBI wants banks to actually document this clearly and closely monitor the development so that it helps the central bank also to inspect on this, and it will ensure robust risk management.
Right. Thank you for that news piece coming in. Sharmila, coming to you on this, how do you see this impacting NBFCs and the banking space going forward if RBI is actually putting a curtail again on the personal loans and unsecured credit?
So, honestly, one would hope that these, whether it's banks or NBFCs, at least the good quality names would already be having, a lot of checks and balances already in place, because nobody would really like themselves to be exposed to such kind of a risk if things were to go awry. But I think it's a good move, and probably NBFCs may feel the heat more, because I think the unsecured loan part, I think banks are slightly more cautious when it comes to giving loans. So it would be the NBFCs which would probably feel the brunt of it in terms of stock prices getting aligned or having to make internal changes, etc. But as I said, I think that I would continue to be positive on this step, given the fact that we are now in a phase where there is sort of improved liquidity in the banking system, as well as the fact that we've seen the first of interest rates come in. So I think it's market will take it in its stride, this measure, and net, I think it's a good measure.
Another group of stock that remains in focus is the shipbuilders, that is Garden Reach and Cochin Shipyard. Both are sailing strong post a robust fourth quarter numbers. Anushi is joining us with more details on the Q4 numbers of Garden Reach and Cochin Shipyard.
Garden Reach, if we are seeing, it's a particularly strong set of numbers that we are looking at. Revenue up around 62%. Margins also rose to 14% of a mark compared to 8.9%, and net profit over 100% of a growth that we are seeing. Now, do note that a lot of the shipyard companies, they follow the S-curve pattern which is there. So revenue recognition may vary from quarter to quarter basis based on the execution which is there. But it's the order book which is an important point to consider. Order book stands at about 23,880 crore, and they have an order pipeline of worth about 1.06 lakh crore in the next 2 years, which is a 5 times of the size of the current order book that we are looking at. Currently, the company has around 10 projects, including 4 export projects which are there, and the focus now is for this year to get more repeat orders. There are expectations for next 2 large orders as well, so how that would pan out is something that we should keep a track of. On the non-defense side, focus would be on the shipbuilding and building green energy platform. So Garden Reach, overall a strong outlook is what we are expecting. While coming to something like a Cochin shipyard, in the recent update we did see that the company and Dry Docks World had partnered for ship repair hubs in India, which means developing ship repair and offshore fabrication hubs across India. This collaboration was follow-up of the MOU which was signed in Mumbai with Dubai that we are looking at. If you are talking about the view for Cochin shipyard, now Antique currently has a hold rating on the stock, saying that the present order book of 20,500 crore, while that provides a 5-year revenue visibility going forward, order inflows for the near time may be on a muted side as compared to something like a Masgao Dock and Garden Reach. But despite this muted order book that we are looking at, near-term revenue growth remains on the healthier side. However, the stock's performance would also be tied up with the ordering of the ISC-2, that's the indigenous aircraft carrier that we are looking at. So both of these counter strong up moves that we are looking in today's trade.
Right. Sharmila, coming to you on this shipbuilders, Garden Reach and Cochin shipyard, did you get time to look at the numbers? How are you looking these couple of stocks on the number front, and also how the valuations appear right now?
So very favorably on both fronts. I think there was a time some months back when we had that entire run-up in defense stocks where a lot of stocks were ahead of their valuations. And then we did see the correction come in also. But, that was always my point even then, that, a lot of these orders are long gestation orders, and, how they get recognized in the balance sheet is what is going to be key. And again, I think, as you heard, the order pipeline for Garden Reach, Masgao Dock is so strong that they make very compelling investments. My only caveat here would be to investors who are getting in now that you can't expect the kind of gains that we've seen investors make in that period from say 2022 the last 2024 period or so, because that kind of return is to my mind not something that you can go by, but definitely good returns even from these levels. Given how strong their order books are. And I think that's really what we should consider, because from a valuation perspective, now the stocks are looking at.
Right. Another stock that remains in focus is REC. It's the top F&O loser in trade, and this was on the back of the management commentary that had come in. Now, the management for FY26 has guided that their loan book will grow around 12% versus the earlier growth guidance of 15 to 17% that was given. So, kind of, they have cut down on their growth guidance by around 300 to 500 basis points. However, the management is confident that for medium term, their growth guidance would remain at around 15 to 17%. They have also maintained that target loan book for FY30 at close to 10 lakh crore rupees, and the renewable energy loan book will be close to 3 lakh crore rupees. Apart from that, they are expecting disbursements to touch around 2 to 2.1 lakh crore for FY26, and they aim to become net zero NPA by the end of the current financial year. Their NIM spreads is in the range of around 3.5 to 3.75 for FY26. However, given the fact that the management had cut down on their growth guidance, the stock had seen a downtick of around 3% in trade. Sharmila, any views on REC? Though management has cut down on their growth guidance, the 12% guidance seems to be still better off when you look at the valuations currently.
Absolutely, and I think this is a bit of a knee-jerk reaction, as you said, because the management cut their guidance. Because if you look at what they have done, what they hope to do, whether it is the NPA picture they are presenting or the kind of growth picture that they are talking of, I think both, and I think the whole sector and what one is expecting from power as a sector going ahead, the correction has happened in the stock from the levels that stocks were at. So now, to my mind, the downside is limited, and these look very good from a investment sort of a perspective, both REC and TFC. I'm taking actually this sort of cut that we're seeing as a view to really enter the stock than anything else.
Well, Cipla's fourth quarter con call highlights a robust growth trajectory when it comes to the respiratory and the neurology segment. Let's listen into my colleague Sajid. What are the key takeaways coming in?
That's right. The Q4 numbers were pretty much slightly below expectation, with EBITDA getting hit because of the higher R&D expense and the net profit boosted by other income. But during the con call, the management gave a guidance of 23.5% to 24.5% for EBITDA guidance for FY26. They also gave a Q1 sales, US sales guidance of $220 million. But the street is pretty much looking at a flat growth for FY26 and FY27 with respect to US sales growth. The management didn't expect much because of the India-US tariff, which is at this point in time, and didn't give much of that. But there is no revenue guidance that's coming from the government, and that's primarily because of the tariff situation that the management is talking about. Now, there are certain growth areas which the management spoke about, which is respiratory, neurology, which has outpaced market growth, and they expect to do that. There is a lot of there's a pipeline of products in the respiratory, especially inhaler segments, but the management did not give out any timeline for that launch there. Macquarie basically has an outperform on Cipla with a target price of 1,875, and they're saying that operationally it is in line the Q4 numbers. Nomura on Cipla has a buy rating with a target price of 1780 rupees, and they're saying that the Q4 EBITDA was a miss, but outlook in line with estimates.
Shamila, any views on Cipla? The street doesn't seem to be quite enthused with the FY26 guidance here.
Yes, but I think the valuations are reasonable, and I think, if you're looking at the sort of a sector situation going ahead, I think in that sense, this last week has not been that great. But from the US tariff perspective, probably this is a better sector because it will be impacted less, which is what we are even hearing the management say. So from that perspective, if you were to enter into stocks where valuations are good and where you want to be sort of take some kind of a defense from the US tariff situation, then pharma, to my mind, is a good sector. And within that sector, at this valuation, Cipla looks reasonable. It may not be my top pick within the pharma space, but definitely I think at this valuation, it's a good and solid stock.
Right. Thank you, Shamila, for joining us and giving us your perspective on the markets and the stocks that we discussed. Moving on, Max Financial reported a strong set of numbers, and we are now joined by Amrit Singh, the CFO of Axis Max Life Insurance. So firstly, to start off with, April has been a strong month for Axis Max Life on both premium and AP front. What growth do you expect from the first quarter numbers and for FY26 here now?
I think we have, over the last few years, demonstrated a strong momentum in our sales, and you would have seen for the full financial year as well in FY25 that we have grown at 20%, which is almost double the growth rate of the overall industry, which grew at 10%, and 500 basis points faster than the private industry growth rate. And this actually has been done on an equally strong financial year 24, where we had outgrown the market, which grew at that time at 8%, and we grew at 16% in that year. So now 2-year basis, our momentum has been strong. We have grown at 18%, and we are one of the fastest growing life insurance among the top players. And I think that some of that momentum is what you're seeing in the month of April as well. But I will only caveat that April is a small month. It can't be a reflection of how the full years will pan out. But only thing that we will be committed to is the fact that we will drive faster growth than the market and the industry growth rate.
Right, sir. Okay, now if you look at the Q4 margins, that came in slightly over the 28% mark, much ahead of what the street was expecting this number to be. What helped the margins when ULIP growth was actually impacted negatively? Also, have quarterly margins peaked at the current levels of 28%?
So Q4 margins, we reported at 28.1%, which very similar to how it was in the previous quarter, where we reported 28.4%. But on sequential basis, from 23.2% in the previous quarter, we have moved to 28.1%. Largely, this has been enabled by optimizing for product variants, product design tweaks, focusing on category which are margin accretive. And that has actually helped us enhance and improve our margin profile. For the full year, we have reported margins of 24%, which is in line with how we have been guiding to the market. And the margins did come under pressure because of a product mix shift towards unit-linked designs during the financial year. As we look forward, I think we do expect some moderation on back of overall weakness in the markets on ULIP designs, which will favor traditional products. And we should remain in the range of 24-25%. But more as a philosophy, I think our focus will continue to remain in building distribution and growing and consolidating our overall position. We have gained a market rank in financial year 24. We have moved to number 4 position. And for the last 6-7 months, we have actually been number 3 player. So our efforts will remain to build distribution and further expand and grow faster than the industry growth rate. At the same time, keeping the margins in the corridor.
Right, 24-25% margin expectations for FY26. So what's your expectation when it comes to VNB growth? I believe for FY25, your VNB growth was around 7%.
I think we don't want to kind of provide an absolute number. I think it will all be relative to the market, and the only thing that we can say is that whatever the market growth expected, we will be 300 to 500 basis points faster than the market growth rate. And needless to say, with the margins improving or becoming better, we should actually demonstrate VNB growth rate in line with our business growth rate or marginally higher than the business growth rate.
Right. The higher surrender value. Now, these regulations got implemented in October. What has been the impact of it in the second half on the margins, and what impact do you see for FY26 here?
So, as I mentioned, we did experience that impact in Q3, and we had kind of disclosed at that point around 100 basis point impact. But as we moved to Q4 and we tweaked some of our designs of products, also shifted our variants, and tweaked from a pricing perspective, certain actions on the product forms, we have been able to almost eliminate most of that impact, and hence going into FY26, we should not see a significant bearing of that on our margin profiles.
Right. And sir, what is the contribution coming from Axis Bank to the AP? Also, how much did it change from the start of FY25 till now?
So, as a stated strategy, we have been investing in our own channels, as we call them, the proprietary channels, which is a mix of agency, direct selling teams, and e-commerce. And progressively, as every financial year has moved, we have been improving the contribution of our own channels. And you would also see some of that reflected in our numbers, where the 2-year CAGR of our own channels is 27%. Last year also they grew at 26%, which has meant that the proprietary channel shares is kind of touching almost 45% kind of levels. And this used to be a few years back at the ranges of 34-35%. So there has been a progressive improvement. With respect to Axis Bank, I think the growth has been very steady. They have grown at around 10%. That channel has grown at 10%. From a contribution to our AP, that channel now contributes around 48% for us.
Okay. Protection segment, now that grew around 35% in FY25. Could similar growth on protection side continue in FY26 as well?
I think there are a couple of product categories of our choice, and we do articulate those as our strategic priorities, which include protection, health, and annuity. And our focus with respect to driving those products will remain. You're absolutely right. We did grow at 35% for our protection business, and a focus of similar nature will remain. There could be some moderation. I mean, 35% actually has come on a base of 2 years where there was a slowdown post-COVID. So some bit of moderation will happen, but definitely, we are targeting upwards of 20% growth for this category.
So lastly, a couple of questions on the regulatory side. Any update from the regulator on bancassurance channel growth front?
No, we are not in any receipt of anything specifically on bank assurance. I think we do understand, the regulators and the government understand the importance of bank assurance as a channel. And they are also equally committed to develop and holistically drive this channel so that the insurance penetration for the country can keep improving.
And lastly, sir, when do you start the process of merging Max Financial into Max Life? And once the process starts, then by when does it conclude? And by when do you see Axis Max Life getting listed?
I think we have, clearly shared our intent, even from an investor perspective, that we are keen in collapsing the structure and simplifying the structure for any other reason. And though this can only be enabled by certain amendments, and we are very glad that the regulator themselves and the government themselves has proposed that amendment as part of the Insurance Act, which we are hearing from the chatters that, monsoon session is when the same could be tabled. And once there is clarity on that, we will engage with the regulator. Any scheme of arrangement or a merger process is a 12 to 18-month journey post that. So we are looking for that key milestone of the same getting introduced in the monsoon session.
Well, that would be all, sir. Thank you for joining us and explaining the growth prospects of Max Financial going forward. Moving on, here's an exclusive story from my colleague Shrimi Chaudhary. As a fallout of China supporting Pakistan during the recent military conflict, the Indian government will conduct tighter scrutiny on all deals, FDI and joint ventures backed by China. Shrimi joins us with more details on the same.
Yes, clearly after China opened support to Pakistan in a recent military standoff, India is tightening its grip on the foreign direct investment involving Chinese entities, signaling a toughened stance in terms of economic engagement, and FDI plays a huge role there. What we've been given to understand that at least 6 to 7 major deals which has been in the pipeline could face greater scrutiny. In fact, Indian authorities will have a fresh look on those deals under Press Note 3. Some of the JVs, joint venture, could be also worked out under the same regulation. But clearly the approval could take some time, and that could, delay the entire process and the deal as well, is what indication we are getting at this point. Sources also tells us that, the joint venture could be worked out in space like auto and consumer durable, which has been in talks and are in advanced stage, but that also require a monitoring and closer scrutiny. Press Note 3, as you remember, was introduced in April 2020 to sort of have a curb on the hostile takeover and requires multi-departmental and multi-ministry approval for any such investment coming from land border which India shares with, including China. And since then, we have seen decline in the FDI inflows from China, but there is a clear uptick in the import from China, especially the mercantile import are concerned. So there has been some discussion in past whether to ease the restriction under Press Note 3, but at the given evolving situation, it's clear that India may further tighten the current regime. That could be considered, but as long as easing the restriction is concerned, is completely ruled out. And in fact, we would see some stricter compliance is coming in place as far as China-backed deal is concerned.
Well, thank you, Shrimi, for that exclusive. With that, it's a wrap on this edition of Top Rates. Stay tuned and keep watching NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay
Hello and welcome. You're watching India Market Close here on NDTV Profit. I'm Harsh Saita, with me is Neeraj Shah. Let's quickly look at how the markets are shaping up for close today. We're around a fifth of a percent lower on the Nifty 50, an hour and a half to go off trade, around 40 odd points up versus yesterday. Nifty Bank lending no support to the Nifty. That seems evident. Let's look at the intraday chart as well. And in that sense, to a certain extent, it's been a fairly range-bound day of trade. 535 being the low point, 767 being the high point. But for a major part of the day, we've been in this tight band. For a very brief period of time, we've seen a bit of spikes on at least the Nifty. So that's how it's playing out at this point. Let's look at the heat map as well. And some of the metal counters as well as defense counters in focus. Again, today a Tata Steel, a Hindalco up 2+%, a BEL, second consecutive day being one of the top gainers on the Nifty. Again, 2.5% higher. So those are some gainers for you. The texture of the market, at least on the index per se, on the Nifty 50 index, looks much better than yesterday. So in that sense also, there's been an improvement. IT stocks have done fairly okay today. After yesterday, we saw a bit of a pullback in terms of IT. Today, we're seeing that reverse a little bit. So Tech Mahindra up 1.6, TCS up 1%. You have the likes of auto stocks in focus on the back of Tata Motors' numbers. M&M is up 1.4%. And Tata Motors there languishing, the top loser on the Nifty 50 index today, 2% lower. Tata Steel and really the metal counters are where a lot of the zing in today's market is. Let's pull up the sectoral heat map as well, and we'll see likely that the Nifty metal and the Nifty defense, of course, is the top gainer, but the Nifty metal is also doing very well for itself, 2.5% higher. The Nifty bank is, and within that space as well, even the financials in that same breath are the one pocket which are not doing well in this market. We'll zoom into the Nifty Bank, but I want to also quickly highlight the Nifty IT index, 1% higher. The Nifty Auto and the Nifty Pharma as well, doing fairly well today in trade, 0.5% odd higher. Let's look at the advanced decline today. And in that sense, the breadth is quite strong. You're seeing a 3:1 breadth on the index today, Neeraj, and that's where you're getting all your cues from. The broader markets outperforming the index for a third straight day, Neeraj.
And you're seeing some select solid moves. So today actually the PSUs are in focus, right? You look at the Nifty Defense Index, so that there is an index like that, and you look at the PSU defense names contribution within that. It just shows you the moves. So Garden Reach Shipbuilders, massive 16% higher. Then you have a Dredging Corporation, Midhani or Mishra Dhatu Nigam, Cochin Shipyard. The gains are stellar into each of these. 12.5% for Midhani, Cochin Shipyard. Look at that. Dredging Corporation up, I think, better than Midhani if I'm not wrong. Quite a stunning move on Dredging Corporation as well. So that's the bucket which has done really well. There is ITD Cementation, and we spoke to the management, up about 10-11%. On the flip side, names like Surma, Metropolis, and Ganesh Housing. Both Metropolis and Ganesh Housing for the last couple of days have been correcting, so keep an eye out for that. And PFC REC have a bit of a pullback move today. Lastly, Indorama Synthetics, amongst others, which has had this very strong up move today. Keep an eye out for that one. Let's get in Akshay Bhagwat to talk about how he sees the scenario currently. Akshay, good having you. Thanks for joining in. Is there a trade on any of the indices this afternoon?
Yeah, so good afternoon. Well, today it's been an off day, a slight selling pressure, which is evident. But data points. If you look at the FI selling today, that's slightly a question mark because significant selling numbers came out of around 6,500 crores in index futures before the day started. So slight pressure today, but level-wise, 24,500. Considering tomorrow's weekly expiry, should offer a good support if you're a BTST or a short-term trader. So from a trade perspective, I would look to buy Nifty in the range of 24,500 to 24,550 zone, that spot, and I'll keep a stop loss of 24,450 on 400 roughly on this trade, and expecting a recovery back to 24,750 to 800 for tomorrow's expiry.
Okay. Is there a call on the Bank Nifty?
Bank Nifty, there is no call, unfortunately, because the setup is not conducive for a risk reward at the given juncture. There is slight pressure. Bank Nifty may try to cover the gap which we saw, the gap up on the charts, which we saw on the couple of days before. The gap closes at 54,000. So there's a slight risk that if there is some sell-off in tomorrow's trading session, Bank Nifty might aim to cover up that gap near 54,000. So currently, not recommending a trade in Bank Nifty, but yes, if 54,000 is visited in tomorrow's trade, I would be keen to buy Bank Nifty there.
Right, Akshay, Harsh also joining in. Quickly onto your picks for this afternoon.
Yeah, so two recommendations, both on the buy side. For the first trade is in Jindal Steel and Power. So metals are in the limelight. Jindal Steel and Power has staged a breakout on the daily charts, and that's a very strong development. The breakout comes at 920 and gives you a possible target of 1027. Keep a stop loss of 915 on this trade. Second recommendation is in Mahindra & Mahindra, a very healthy price structure. Last 4 days, slight consolidative action, sideways action, but believe that a breakout, the next level of breakout is happening soon of this small range, and the stock should be heading for around 3285 on the upside. Keep a stop loss of 3042 on this trade. So Mahindra & Mahindra and Jindal Steel are the top two bets for short-term trading.
Akshay, I wonder what's the take with regard to the Nifty metal, because that's the one which is standing out outside of defense. I will ask you defense, but metals first. Tata Steel, Hindalco, some of the stocks are really doing well in trade today.
Yeah, absolutely. If I were to look at the metal index, last 3 months, it's been more of a topsy-turvy move for the metal index. The index roughly trades around 9050, and there has been choppiness between 8000 to 9050. But with the current news, which is supportive, the news a couple of days back, we had tariffs being kind of de-escalated between US and China. That is helping a surge in metals, and probably 9400 is where this metal index should be heading for, at least from the short-term trading perspective. So expect some more momentum to be seen in metal counters. Tata Steel, Jindal Steel and Power, Steel Authority of India are the top three charts which should bode well along with the metal index in the next 3-4 trading sessions.
Okay. Akshay, last off, need your take with regard to defense as well, because this one has been particularly outperforming the index and even the broader markets. What's the sense like, and what are your top picks within defense?
Well, you're absolutely right. Defense and metals have been the limelight, hogging the limelight last couple of days. Here, most of the stocks are on the verge of breakout or registered a breakout on the short-term trading charts. So BEL is one name, Bharat Electronics, which you can look forward to. It has staged a breakout today, as I see, at the levels of 340. So that's a very strong development, because this breakout, which is almost near the all-time high, comes almost post 1 year. So that's a very strong development in this chart, and positionally 390 400 plus can be the targets in the making. So yes, it is more of a buy and hold. Do not chase the prices, but a very strong chart structure in BEL. Also, you can look at Cochin Shipyard here. That also is moving strong, given a possible breakout above the levels of 1675. Volumes are very strong. Almost, I believe, after 2 years, we are seeing this kind of volumes in the stock. So 2200, 2300 is where the stock should be heading for. So yes, strong price structures in defense names, but it is more of buy and hold. Minimum time horizon of 3+ months holding should do justice to these trades.
Graphite India numbers on your screen, by the way. Revenues are down, but their EBITDA has moved up, and there is obviously positivity on the operational front, as a result of which we're seeing a spike on that stock. So low revenues, EBITDA has moved up, as a result of which net profit of 50 crores versus 16 crores. Maybe there are one-offs there, but predominantly look at those numbers from a EBITDA perspective, because revenues are down, but EBITDA margins have really shot up, and which is why I think the street likes what Graphite India is doing. 7% higher. Can't really take a call on something that's just come out right now. But very quickly, Akshay, before we thank you, a word on a couple of these solar companies which have come out with exceptional numbers. Borosil Renewables, good numbers. KPI Green Energy and KPI Green Engineering, some very solid numbers. We have the management up next. Any thoughts on Borosil, KPI, KP Green?
Borosil, I believe this is a very strong price chart, which I see on the monthly price. 450 has been a massive support base for the stock. It is in an accumulation zone, looking at the volumes and delivery action, and possibly with a buy and hold perspective of minimum 3 months plus, 750 should be revisited. So positive view. Stop losses below 450 is the trade in Borosil Renewables, and KPI Green Energy has charted a very strong support base at 350 and trying to catch momentum, but there are strong resistance at around 480. So I would go with Borosil Renewables, which has a better price structure over KPI Green.
Okay, Akshay, we'll leave it at that. Thanks much for taking the time out and being with us. We appreciate your time. Let's talk about KPI Green, the numbers. Revenues were up at 569 crores, up about 96%. EBITDA expanded 73%. Margins down about 400 basis points at 28.29 versus 32. The net profit, though, 142% higher at 104 crores versus 43 crores. Mr. Farooq Patel, CMD of KP Group Johnson, right now to talk about those numbers. For KPI Green Energy, we'll also maybe try and talk about KP Green Engineering, the numbers of which came out, which also looked pretty okay. Mr. Patel, good having you. Thank you so much for taking the time out. Some of the quarter for us, did it live up to what you wanted, or did the margin pull back a little bit more than what you had penciled in?
No, margin is quite reasonable, Neeraj bhai. And what we have thoughted or what we have predicted, we have delivered more than what we were said in a last quarter also. This quarter and this year is a very best for the KP Group whole.
So how, when you say you've delivered more than what you had penciled in, Mr. Patel, what contributed to that, and in terms of both the IPP performance as well, which was slightly lower than what you had guided for. Give us some instance of that, and also what led to this outperformance relative to what you had guided.
See, in IPP, it's a seasonal. IPP always give you the revenue by the seasonal effects and all. But I'm very much sure about the next year production that we are moving ahead in the IPP segment in KP Group, in KPI, even in the KP Energy also. And we will serve you in next year about 1.2 gigawatt upcoming project in IPP. And see, this year you can see the IPP growth is also pretty good as per the revenue wise and as per the say kilowatt wise if you see in the balance sheet.
So what's so Harsh also joining in. Good afternoon. So what's the outlook like for FY26 in terms of execution? How much are you expecting in terms of incremental growth? Order book, how is that shaping up? Give us some color around both of those aspects.
See, I always has thank you very much. We always says that we are growing with the very good tradition of the Indian market on the renewable energy, and we are going 50 to 60%, and we have delivered since last 5 years, and the same trajectory you will see in the next financial year also.
Okay, and sir, how is demand order book shaping up?
Order book, as you see the order book all together, we have already presented in the presentation also. Whole group wise 3.8 gigawatt we have order in our hand. So out of that we have energized about say 1.8. So now 3.8 is still in our hand as a group wise. In KPI 2.9 and the in KP Energy 2.2. So altogether, we are very strong order book for the financial year 2026, and we will execute this business in this year only.
I want some clarification, Mr. Patel. I heard you say that 3.8 gigawatts of orders in hand, out of which 1.8 gigawatt is energized, right? So there is a pending 2 gigawatt of current order book, which you are saying you will execute in FY26?
No, let me be very specified.
Please do.
Over here. Like, in KPI, there is a 2.957 megawatt.
Okay.
So it is 2.9 gigawatt. Out of that, 1.2 gigawatt is IPP, where the GUNL orders, and 1.756 again the CPP, as you can say the EPC work. At the same time, in the KP Energy also, we have the 2.2 gigawatt orders in hand, and we have executed 1 gigawatt. And this 2.2 is, of course, is the CPP business. So you, as we say, we have the order of 5 point, both company 5.1 gigawatt order book, and we have energized 1.9 gigawatt already. We have energized. So you can say if we take it out the internal GUNL business from the company to company, 3.8 gigawatt is a purely business what we have to deliver in this year by the companies.
Okay, Mr. Patel, so I'm just trying to make it simple. Let's focus only on KPI Green. What is the outstanding order book, and what is the execution guidance that you're giving for FY26 only for KPI Green?
Okay, for the KPI Green, 2.9 gigawatt is the order book which we have in our hand.
Right.
Out of that, 1.2 gigawatt is the GUNL IPP business,
Yes.
which IPP business goes to the KP Energy,
which is fine.
And 1.756 gigawatt is the CPP business.
Yes.
So execution For the CPP business, 1.760, and the IPP it's running, and we will get the revenue from the IPP business is for the revenue for the sale of the electricity. Today we have already energized 9.95 gigawatt, or you can say 950 megawatt. Out of that, 171 IPP.
Sure, sure. So the remainder you will execute in FY26, or will it spill over to FY27?
No, it is in a FY26 only. So Neeraj bhai, one thing you will get it in the KPI balance sheet next year is the IPP business and the CPP business, which you can see over in this year. 13% of the IPP and the rest of from the CPP. Next year it will goes to the about 20% from the IPP and the rest of from the CPP.
And just one follow-up there. So effectively this whole 2.9 gigawatts in KPI green, you will execute the balance which has not been energized in FY26. I get that.
Yes.
Yes? Okay.
Yes.
Part 2 of my question, on the IPP side, the GUNL numbers, right? When does the revenue start to materialize from the power purchase agreement entered with GUNL?
In the next March, we will get the whole revenue from this 1.2 gigawatt also, sir.
Okay. Okay.
Understood. So, give us context or give us perspective with regard to where margins will lie. This time around, margins saw a slight bit of pullback. Is this the normalized steady state to expect?
See, when you are growing with the big numbers, you don't have to be stick on the perfection of the margin, rather than the numbers of the profit is gone very high. You can see 70 to 80% PAT is increased, which we have to see in the things. When we were doing 100 megawatt and now we are going for the gigawatt size. So of course there will be some thin things less than the previous year in terms of say percentage. But in terms of numbers, if you go and see, you will get the 70 to 80% hike in the numbers.
Understood. So I fully appreciate that growth is priority and margins will likely take a bit of a backseat. But just trying to suggest, because your full year margin you've done at 32%, it's just that Q4 has come in softer. So can we expect that KPI Green will likely continue to do 30% plus? Is that the goal, aspiration, target?
Last year, if you go see, if you see the renewable business, you have to be a whole year around and round and round. So in that case, last year PAT was 162 crores, which this year the PAT is grown up to 325 crore rupees. And the next year, of course, you will get the very better than this.
Okay. Moving focus, Mr. Patel, before we wrap up on KP Green as well. The numbers, revenue numbers looked okay. EBITDA was very solid too, but the net profit, a downtick of about 47%. What led to this?
Sorry, I can get you properly, Mr. Neeraj.
On KP Green, Mr. Patel, when I looked at the Q4 numbers, revenues were up 76%, margins expanded as well. Net profits were a bit lower, if I'm not wrong, 24 crores? Or am I wrong?
KP Green Engineering or KP
Engineering,
Green?
KP Green Engineering.
No, KP Green Engineering is a half-yearly result.
Okay.
It's a half-yearly result.
Okay.
So KP Green Engineering, I always is a 46 is a PAT for the H2.
Okay, fine.
And
so okay, on KP Green, the margins, are they at about 15.5%, 16%? Would you believe you will maintain these margins?
We will try to maintain the margin, as I told you before to us also, that when we are expanding, see, last year we were done the revenue about 300 plus, and this year we have crossed the 700 plus. So of course the next year will be much more higher than the what we have produced this year, because next year we are completely come in the Mathur new factory, which we have came with the IPO last year. we have already started Martha this year about 20 to 30% production. This year we are going to get the 100% production from the Martha. So of course this year we have crossed the 74 part and the 710 something 702 is revenue. Next year you will find out the at least double. It is what I am watching as per the order, because the order in a KP Green also 807 crore rupees order in hand, and in KP Green we are doing the 45 days to 60 days order completion, not like the renewable energy KPI and KP Energy where we are doing the job in 18 to 24 months.
Got it. Okay. One final question, Mr. Patel, on KP Green Engineering. You've shown an order book of 800 crores as you just mentioned. What is the order inflow likely to be in the future? What is the maybe the guidance that you're giving around orders?
I cannot give you the perfect figure, but you can
Ballpark.
expect the at least double than the what we have done till date. And the pipeline is very strong because we are going with the 18 products in the KP Green.
Okay.
And that 18 product is a heavy product, PEB structure and all the things. And we are coming with the turbine towers, wind turbine towers and all. So which gives a very, very robust, I can say, the revenue also from there. We expect.
Okay. Okay, Mr. Patel, we wish you all the best for that. Thank you so much for taking the time out and speaking to us today.
Thank you very much, and so nice of you people, Neeraj Bhai and the Hers. Thank you very much to making a notice about the KP Group. Thank you very much.
Thank you so much. Thank you so much. Okay, that's KPI Green and KP Green Engineering. They've the stocks have done well, but the markets haven't, by the way. Just keep in mind that they've come off from the highs of the Sensex, dipped into the red as well, but the broader end of the spectrum continues to be very, very strong, which is actually a good thing. Also, the interesting piece is Heikel. The numbers don't look good, but the stock has reacted very positively.
Yeah, I mean 7% uptake on the stock price, and you'll see the spike on the stock as well. It will be interesting to take some perspective as to how this is looking from a technical perspective.
Yeah, which we'll do that once the guests come in for sure.
But I'll just quickly read out the numbers, Neeraj. 7% revenue growth, 46% on EBITDA. So EBITDA margins are at 22% versus 45%. Apologies.
No.
Revenue is up 7.5%. Margins are down. EBITDA is down 47%. My bad. So EBITDA is at 123 crore versus 232 crore YOY. Margins are at 22.5% versus 45% on a YOY basis. And profits are down 48%.
On Heikel?
Yes.
No, I think that those numbers seem a bit off. We'll get those numbers going. I think the margin number seems a bit off, Harsh. So we'll try and reconcile with these margins in a bit. In the meanwhile, Edelweiss Financial, net profit down 37% at 105 crores. So bear that in mind too. The numbers on the bottom line at least don't look very, very appealing. What we'll do is we'll take a break. As we hit at the break, a stock that's actually doing well is ITD Cementation. The company's margins are in the 9 to 10% range. We spoke to Prasad Patwardhan, CFO of the company, or whether the management expects the margins to improve in FY26. Here's what he had to say.
Gradually, we'll see an improvement in our margins, and we are seeing that in the numbers that we are reporting as well. So while there may not be too much scope for the margins to improve, but yes, certainly our focus is on cost control and improvement of margins, and we'll see our margins inching up in the current year as well.
Mr. Prasad, what about order inflows? One that the flows are slightly lower than the guided one, but broadly, if I look at the order book trajectory and the book to bill ratio from March 23 to March 25 now, that number has come off a bit. I mean, is it that you are consciously bagging lower orders, or is it that the system is throwing up lower orders?
Well, we are not consciously reducing our focus on order booking, so that focus continues. But yes, our execution rate has improved significantly over the last couple of years. So, we were probably doing, 1,500 or 1,800 crores a quarter, which has now gone to, about 2,400 crores in the quarter gone by. So while the pace of execution has picked up, there have been fewer orders coming up for tendering. Last year, the first quarter was a washout because of the Lok Sabha elections, and then gradually the pace picked up at a much slower pace. Basically we saw new orders coming up for tendering at a slightly slower pace than earlier. But government continues to focus on infrastructure, and we are pretty sure that going forward we'll see, order booking, the pace of order booking also improving in the current financial year.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Hello and welcome to NDTV Profit. You're watching Earnings Edge and we have with us PB Balaji, who is the Group CFO at Tata Motors. How do you look at FY26 in this scenario? Means are you penciling in a growth or at least a growth over FY25, or is it going to be a strong robust growth with respect to volumes and value coming in?
See, firstly, I think one thing we have been very clear is that we never run the business for a quarter or for a year.
That's why I asked FY26.
So we always position the whole business at all points in time in the right direction. So for us, the fact that investments continue apace should give you enough and more indication that we are absolutely feet on the pedal when it comes to the growth agenda and the investment agenda. What we are conscious of is that I think we need to get tighter with respect to our cost and cash agenda so that we can navigate whatever noise comes on this front. At the same time, we should be clear that we'll have to be super agile. Wherever pockets of growth emerge, you'll have to go and be able to tap into it and deliver on that. Which I think Tata Motors has more than adequately demonstrated the ability to move things with speed and with agility. That we will continue to execute that way. And the demerger just gives us that additional ability to drive focus on the CV side and the PV side much better.
I was coming to that because, that's a domestic factor which is going to play out over the next 2 to 3 quarters, which is there. And how do you see both the businesses now placed now that they would be independent maybe from October onwards?
So I think firstly they're in a very good place, both the businesses. The fact that you got net debt free also is a huge relief for both the businesses, because we shouldn't forget there's almost a 4,000, 5,000 crores buffer that has got created if you go back to earlier era to where we are now, which gives us the flex if we have to flex the P&L. At the same time, if you look at the CV business, let's take one at a time. Barring the small commercial vehicle business, I think every part of the business is firing very well. And this is a year where we hit the 12% EBITDA margin. We grew margins when our revenues declined, which haven't happened in CV for the last 25 years. That business delivers a ROCE of almost 40%. It's a rock solid business where the market shares of the heavies, the intermediates, the buses are all in a very, very good place. And the realizations are stepping up, profitability is stepping up, and we are able to now deliver value there at a very strong ROCE. So that business, when it demerges and then becomes a standalone business on its own right, it's got a very, very strong cash generation potential, which it's been demonstrating. And we would want to keep that going on that front and use that to go deeper on all other aspects of the business. I think when we crack the small commercial vehicle business, which we are confident we'll do it this year, I think that will also give you higher returns in that business going forward. So CV in a good place, be it the balance sheet, be it the shares, be it the profitability, cash flows, any metric that you take, that's in a good place. CV cycle, let it come whenever it comes. It doesn't matter, because anyway we are stepping up our cash flows and profitability even in a down cycle. So it's only upside from here on, from that perspective. Passenger vehicle side, I think last year was a year of consolidation where we did about 13.2% share. And the thing that we should have done a better job of is on service, where the growth came in so fast over the last 4 years. The service requirement was way ahead of what our capacity to serve was. That has got fixed in the last 6 months. Another 3 more months, we should get this completely nailed down. Then you have the product offensive coming in. If you look at last year, SUVs we did well. The only product category that went down for us was the hatches. Tiago has been relaunched, Altroz has been relaunched just now. With that, we would expect to see that come back again. And we then have the Harrier EV launching in, the Punch MC coming in, Sierra coming in. So there is enough and more products for us to. Our product offensive is from competition was last year. For us, it is this year. This combination should help us deliver growth on the PV side. EV side, the only area where we lost out was the fleet segment, which is again FAME 2 incentives went away. A few of the EV fleet players had challenges in their own. That is something we need to attack. There is a substantial CNG segment out there in the fleet side. We are clearly looking at products that can go and cater to that segment, and you should see that play out in the course of this year. So if I say when the demerger happened, that business is already cash positive, and it has a task on hand to pick up another 100-200 bits of profitability on the EBITDA side, which it will deliver in the course of this year. Shares going up, profitability going up, balance sheet remaining strong. The PV business, and it is now cash positive, the entire PV business, no challenges there. That should take care of, it can stand on its own legs. And JLR, we have consciously said all the capex will be funded out of operating cash flows, even in this environment. So we are having a good upside coming through as far as the PV side is concerned, despite the tariffs, despite the global environment, despite EV competition, everything laying out there. So even if I look at assuming this year, what we see right now is the worst of times for JLR and PV, you are still delivering these kind of numbers. So the upside is only from here on. So we have enough in our kitty to give us sound confident. The only reason we said, okay, the next obvious question is, why would I not put a guidance on top of all this? I'm sure your eyes were popping out on that. I'm not surprised. If we have always said whatever guidance we put, it needs to be credible and we should hold ourselves to account. You tell me how will I put a guidance and I don't even know whether the tariff is effective retrospectively or not. Mathematically, I can't put it. So let it come through. We have said, okay, hopefully we'll get clarity by the investor day. The minute we get clarity, we'll put it out there, which also helps us to go for it.
Sir, one question on the passenger vehicle side specifically, you spoke about that the service was one thing that you focused on last year, and I think the last time we spoke to you after quarter 4 of FY24, you mentioned that you were expecting a 3 to 5% industry growth, and that panned out. But for you specifically, the growth was negative for FY25. You mentioned almost 4 to 6 new launches, some going into petrol, a couple of refreshes. But in FY25, it was a year of recalibration. Was that something that from the onset was the plan? Because we've seen one of your closest competitors take market share this year, while the other industry players have also suffered. I think the expectation from Tata Motors from FY24 was industry growth. So how would you tackle that question? Because it's a fall in sales essentially in this month at a time where you've planned so much in FY26. The refresh is also a couple of years. This thing. So, in terms of planning, how has that happened between the last year and this year?
See, last year the thing that did not work in our favor were two things. One was the hatches segment, where we lost substantially more than what we should have lost, because we grew much lesser than the market. And the second was the fleet segment sales error. SUV segment, we are in a good place, and that continues to do well for us. I think the hatches segment, we didn't realize the weakness of the product range till the relaunch happened. Once the relaunch happened, Tiago is coming back into the equation quite nicely, so we should get that picked up. Maybe the fade was simply too sharp on that side. Look at the EV segment, the FAME incentive-led fleet sales. I think that was beyond, it's just the nature of the market. Our market structures was like that, because the Tigor EV did not work at all last year because of the fleet segment sales. That is quite a substantial portion of it. But the rest of it have done well for us. And I think with the stabilization of the battery prices and the put-on prices therefore stabilizing, we should expect to see a more sensible portfolio. If I have a one product launch, then the pricing I can do whatever I want. If I have a full range of products that are already in the market, for me to intervene in one price also means that I have to take the full piano has to be worked with. That took us a little bit more, it was more challenging than what we thought it would be. But as we get into this year, battery prices having stabilized, we are on a good wicket on that side. And we've also now got flex in terms of the range of battery packs that we can put onto it. So all this is going to give us the benefit as we go forward. Add on top of it the PLI benefits that are coming in. That gives us ammunition to actually play this much better than what we could last year, because the PLI benefits came in only by Q3. So Q4 has been a decent play, but the losses that we suffered in Q1 and Q2 took us a while for us to recover from. But that I'm confident from here on we should get that right. And internally also, we had such a rollicking growth for the last 4 years. Your systems, processes, business planning, everything also works in one direction. You needed to correct a few things. We've used this time, that's the reason the year of consolidation, we've used that to fix some of the internal processes that were a bit off kilter in this kind of a growth environment.
Would you also say that last year you mentioned 3 to 5% growth for the industry? Is that analysis again for FY26? And do you expect Tata Motors to outperform comparatively? I know you can't quantify, but significantly, anything that you can share?
We are absolutely clear that this is a year where we'll go significantly higher than the market. And it is backed by product launches and the fact that the service network has been fixed. Those were the bleeders for me last year. So having fixed that, I should get the kicker this year, with competition also now more or less finishing off their product launches the way their plans are.
You know, FY25 at 13.2% market share. So do you see that market share going up in FY26?
Absolutely. It's a growth plan. Share growth plan is what we're currently working with.
So that's a piece of the conversation with Tata Motors, the full conversation at 3:30 p.m. today. Tune in. It's a very interesting chat, I am told, by Puneet as well as Sajid, who both have done that chat. But that time of the show where we bring in Somit to get us slightly delayed heard on the street. Somit, what are you hearing from dealing group?
Well, multiple stocks that continue to remain in focus of dealers. Firstly, it's Coforge that remains in focus. Dealers are indicating that there is delivery-based buy flows from FI desk when it comes to Coforge. When it comes to Tata Power and PB Fintech, large HNIs have started to accumulate both these counters ahead of the Q4 numbers in trade today. Crompton Consumer and Info Edge. Now, these two counters are dealers indicating that there are sell flows on DI desk. So keep an eye out for Crompton Consumer. Yesterday, one of its subsidiaries did report its numbers. The numbers were strong, but there are the sell flows continue on Crompton Consumer. And Godrej Consumer is one stock where large FI was a seller, and hence there was some pressure on Godrej Consumer of late. But now what dealers are indicating is that the selling has been over, and we could see a bounce back when it comes to Godrej Consumer going forward. And lastly, it's Kiri Industries, a small company. There are buy flows at lower levels in anticipation of a positive news that could come in for Kiri Industries. Now, dealers are expecting some announcement related to the arbitration amount of around 700 million, which the company needs to receive from Senda International. Any announcement regarding this could come in anytime soon is what dealers are indicating. So keep an eye out for Kiri Industries as well.
Okay. Kiri, after a while, seeing a story on this one could be interesting.
It has been a buzz for a very long time, but let's see.
Yeah, let's see. But what is a buzz today, Somit, is Tata Steel.
Yeah, it was one of the top Nifty gainers at one point of day. In fact, could be one of the top gainers
Still
right
is,
now
still
as well.
is.
Yes, still the top gainer. Now, why the stock has been gaining?
So metals have done well too, but
Yeah,
Tata Steel is a
entire
story of
pack
its
is
own.
up, but Tata Steel, again, there was a conference call yesterday. Analysts came out with notes post market, and then there were a couple of upgrades as well. IFL had upgraded the rating. But why majorly this focus on Tata Steel? Because of the cost reduction plan. On a consolidated basis, they are looking to reduce their cost by nearly 11,500 crore rupees for FY26. Now, for India unit, they are expecting to achieve a cost conversion or cost reduction of close to 2,800 crore. 2,800 crore is something that they achieved in FY25. For FY26, they are aiming at close to 4,000 crore rupees. And this cost reduction will be in form of optimization of maintenance contract, vendor procurements, wage bill reduction, and productive improvements. That is what the management has guided. Now, more importantly, this cost reduction will lead to an EBITDA per ton uptake of close to 1,000 to 1,200 rupees per ton. So that is what has got the street excited. Now, when it comes to the European operations, UK, they are targeting a cost reduction of close to 3,000 crore rupees on an annualized basis, which will lead to an EBITDA per ton uptake of close to $125. And for Netherlands, they are targeting a cost reduction of close to 4,500, which will lead to an EBITDA uptake as well going forward for that unit as well. Now, apart from this, there were multiple positive commentary that came in from the management side. They are saying that there's no more room for steel prices to drop any longer. So that's one of the key positive commentary. They're expecting the UK operations to break even or even start making profits in FY26. So that's a key guidance that the management has given, and execution on that is something that the street will be wanting to know going forward. And they're expecting conclusion of the Netherlands transition to happen in the second half of this calendar year. That means that post June, they're expecting this transition period to complete. Now, when it comes to the demand, they're saying that India demand continues to remain resilient. In fact, for India volume, they're expecting at least 1.5 million tons of higher volume in FY26 when it comes to steel. And when it comes to net debt, which was an issue for Tata Steel earlier, they're expecting net debt to go down further this year, that is in FY26, and deleveraging will accelerate further with cost reduction plans and EBITDA uptake that the management is expecting to happen in FY26. So FY26 will be a very crucial year for Tata Steel, and a lot of plans that the management has led, but execution is something that we need to watch out for coming in for Tata Steel.
Well, thanks so much for that, Somit. 4% higher perked up in trade. Indeed, positive commentary coming through. We also spoke with the company's CEO and Managing Director, TV Narendran, who talked about their FY26 outlook. Listen in.
In FY26, we are guiding that the volume will be about 1.5 million tons higher. Kalinganagar itself will be about 2 million tons higher, but we have a blast furnace relining coming up in Jamshedpur, which will take out some of the volumes at an overall level. So that's why our guidance is 1.5 million tons more, basically in India in FY26 over FY25.
Okay, I just want to quickly flag off earnings coming thick and fast at the bottom of your screen. Stocks buzzing on the back of that. You have a Surya Roshni, which is currently flashing, perked up 5% in trade. You had a Berger Paints earlier as well. That one also up nearly 3% on the back of numbers. Decent set from Berger, frankly. But let's quickly move on because the defense pack is in focus. The BEL, the major in defense, has celebrated a major win. Its indigenous Akash Tir air defense system shown in combat. The system, integrated with ground-based defenses, successfully thwarted Pakistan's aerial threats during the recent conflict along the western border. Let's bring in Anushi with more details. Anushi, the stock has been doing very well since the last couple of days especially, and defense as a whole doing well. Give us perspective.
Right, so big focus has been on Bharat Electronics and its involvement in the Operation Sindoor that we are looking at. We're just looking at in terms of affirmation from the company side on how they have played a role in this. So now the company just put out an announcement that their air defense system, that is Akash Tir's role in Operation Sindoor, wherein Akash Tir was responsible for destroying several of those low RCS radar cross-section drones of Pakistan as we speak. Do note that this is an integration drone detection and interdiction system, and which has been manufactured by Bharat Electronics. So this is a big update that we are seeing from the company side on how they were involved in the Operation Sindoor. What this could mean for the order pipeline going forward for the business is something that we should keep an eye out for. Just yesterday we had a note from Axis Capital on BEL, wherein they are seeing upward potential revision to India's defense capex, and especially in areas where Bharat Electronics may have a role, may have a key role to play in. So this proof of product is also effective because of their involvement in the role that they have played in the current situation. So medium term local to export outlook improving is something that could be expected going forward. Now do note that this also shows BEL's product reliability and boosts prospects for the business going forward. And again, it is India's surface-to-air missiles playing a key role to counter some of these drones that we are looking at, in which Bharat Electronics is involved, is something which is very important for a nation's standpoint of view. If you talk about the order book position of the company, order book at the size of 71,650 crores, this is as of the March number that we are seeing. Do note that they have got orders worth about 18,715 crore at the end of FY25, which was lower than the guidance of 25,000 crore. There are expectations of spillover in the first quarter, so that is something that we should be watching out for. But it's FY26, which is an interesting year for the business going forward, because from the 25,000 crore guidance, now the expectation is of a 50,000 crore of order inflows coming in. This includes the orders for quick range surface to air missile in the range of 25 to 30,000 crore. Along with that, next generation corvette related orders worth about 14,000 crore as well. Along with this, also some of that slipover that we have seen in the fourth quarter could also be seen in the first half of this financial year. So Bharat Electronics strong footing in terms of where the order pipeline is concerned and how it has played a key role in Operation Sindoor.
Interesting. Thanks for that, Anushi. Well, a quick word from Kush Bora, who joins in before we get to the next management as well. Kush, thanks for joining in and thanks for waiting by. A word on all of these defense names, because this rally continues, right, in different pockets of defense. And today the shipbuilders are at the fore. How do you play them, if at all? Is there a trade in any of them? It's a very wide spectrum, of course.
Neeraj, first, a very good afternoon. Well, we did say that there perhaps was a day of pause, and we got that on Monday. But after that, we are seeing a good bit of traction in all of these. I think more than a trading bit from a very near-term perspective, these are now medium-term stories that you must, have in your portfolio. Yes, the shipbuilding stocks are doing well, but I think the BELs and HALs of the world, perhaps even a BDL, these are the kind of stocks that you want to add. Now, because of the recent run-up that we've seen yesterday and today, some of them, I'm not saying overheated, but slightly stretched. So it might not be a bad idea to start accumulating them on all declines. But now the way they've consolidated for a very long time, and now the way they are giving you a breakout on the back of good volumes, I think these are now medium-term to long-term plays. And any dip that comes about in HALs and BELs and BDLs of the world should be taken as a buying opportunity.
Okay. Kush, what are the stocks that you're recommending therefore for us today?
So have a positive outlook on the index Nifty. So with that view in mind, I'm going with two long calls. One of them is on SJS Enterprises. We've had a good breakout on this one in the last 3 to 4 sessions, but it's sustaining that breakout and gaining more traction. So from a near-term perspective, 1110 and 1140, 1140 are your targets, with 1050 being your stop loss. Since the stock moved higher, closer to the first target, you might want to bump up that stop loss to 1075 now. The second one is Varroc Engineering, a very similar story, but now it's completed that rounding bottom formation and given a breakout above the 475 mark. Looks like this could sustain and gain further down basis the kind of volume action that we're seeing on this one. 515, 535 are your targets, 475 is the stop loss.
Okay. Kush, stay on. We'll ask you about real estate stocks as well, because one of the companies in focus right now is a real estate company, and that's Ajmera Realty. The company came out with numbers, and let's get in Dhaval Ajmera, who's the director of Ajmera Realty, to talk about those numbers. Dhaval, good having you. Thanks for joining in. What was it in quarter 4? Lack of lower execution, because revenues down, EBITDA down. As a consequence, of course, net profitability also has taken a hit.
So basically right now what has happened is that we were expecting a few launches to happen this quarter and the last quarter, but due to the recent Supreme Court orders or the NGT, where the environment permissions have become a problem, and that is why we had to push a few launches of us. And that is why we got a little bit of slowdown in our revenues. But overall, still the company is doing well, and we've been bang on our targets in terms of our profitability. And PAT margins have been consistently growing up. and that's why we've been efficiently moving the company ahead in terms of our projects and profits.
Well, hi, Tamanna here as well. What have collections look like in Q4? They seem relatively weak.
So, as I said, the collections are related to the construction which we do, because most of our projects collections are based on the the work which has happened. So wherever the projects we have permissions and things are going, we are steadily getting collections. As far as the new launches are concerned, we were expecting 1 or 2 projects to launch, and which were going to have a larger piece of pie coming in, which is being pushed by a quarter or so, and that is why we are seeing a little weaker in the last quarter.
Expecting this to resolve by this quarter?
Yes, absolutely.
Okay. And even in terms of the approval pipeline, so you mentioned 2 factors. One was, what you're seeing with the NGT and approvals. I'm just trying to understand if this choke now has been resolved, or it's something that we'll continue to see in the next few quarters.
Well, we are hopeful that matter has been going on in the Supreme Court with the overall permission and not just us. But I think we are hopeful to have some resolves coming in the next few weeks. So by the next quarter, a lot of things would be streamlined.
But what is the exposure to your projects which would be exposed to perhaps a negative response or a negative order from the Supreme Court? What is the extent of exposure?
2 projects, 2 of our projects which we were expecting to have a launch pipeline of about 500 crores launches coming in, and from which we were expecting around 100-150 crores of sales revenue coming across. That is which is gotten pushed. But otherwise, other than that, all our other projects are moving on time with the expected timelines, and we are continued with our sales with other projects as well.
Okay. Dhaval, one word on how the market is looking. A dipstick study around the MMR region seems to suggest that inquiries for both premium as well as slightly sub-premium properties has actually dwindled quite significantly. Maybe it's the impact of the markets, equity markets not being very robust in the first 3-4 months, which might be the reason. But at least that's what all brokers seem to suggest. Are you facing that as well?
Honestly, not really, because if I have to look at it, yes, initial stage during the first quarter, I would say January, February, we were seeing a little bit of slowdown in terms of inquiries. But, we have seen, and it has been observed by many companies, wherever there has been a launch, there has been a successful launch, and they have seen good numbers which have coming. And we have seen a lot of listed entities who have done a good sales over the launches. And even today, when we are looking at few launches which are going to come in the pipeline, whereas this year we are having 9 new launches coming in with a top line of 6,500 crores roughly. With our survey and all these different 9 projects, we've already started speaking to the brokers and the community over there. It is looking positive, and we don't see too much of a challenge.
So you're saying 9 projects in this financial year. What is the kind of timeline that you see for the next 2 quarters?
So we've divided of these 9 projects. I think every quarter roughly about 2-ish, and some quarters will be 3, but 2 projects every quarter is what we will be launching in this financial year.
And in terms of the outlook for this financial year, do you see margins maintaining around the 28-29% mark? Do you see any pressure coming up there? Any guidance you can give us on GDVs, etc.?
So we are working efficiently on our margins. We have right now looked at 28-29%. That I'm sure we'll continue doing that. We are also working on reducing our debt costs. Obviously, the projects where we are doing will have debts coming in, but we are trying to push our cost of debt down so that our margins subsequently have a better hit. And our aim is to improve a little bit more in our PAT margins. But most important is to see to it that we launch these 9 projects, putting in 6,500 crores of new portfolio in our books.
These 9 are subject to approvals or any regulatory hit with the NGT case?
1 or 2, not all.
Okay, so 2 out of 9 at the most.
Yes.
All right. Thank you for that. Dhaval Ajmera, Director, Ajmera Realty and Infra India talking about the quarter gone by. We also saw Keystone's numbers up there a few minutes ago. So we're in the middle of result season, and I think you're going to see a huge bulk of numbers coming in very, very quickly. All right, those were the Keystone instant reaction that we're seeing, about 2.5% up. Nothing too dramatic. BASF is also now reporting. BASF, I don't know, we'll wait for the details of that numbers. Margin seems to have contracted as well. So we're trying to get you all of those numbers as quickly as they come in as we're speaking. Kush Bora with us, founder kushbora.com. I'm also speaking with G. Chokalingam this afternoon. G. Chokalingam, great to speak with you after a while. Do you like the realty space?
Yeah, certainly one cannot ignore. But I prefer stocks like Oberoi Realty, DLF. Yes, I saw Ajmera Realty results, quite decent and decent valuation also around 23. So one can consider Ajmera also for medium to long term.
Mr. Chokalingam, did you say you liked the Ajmera Realty results? Because almost everything seemed to be off, top line, margins, bottom line.
Yeah, I mean, my first preference is for DLF.
Sure.
And second, Oberoi. Third, if somebody wants to look at it's one can look at Ajmera because you are absolutely right. That is to some extent reflected in the stock price also. It's corrected quite a lot, and therefore one can consider it for medium to long term.
Okay, fine. That's the perspective. Kush, any thoughts? Real estate, some of these stocks, Ajmera in particular, because we just spoke. But anything else? Today I was seeing Max, for example, is up about 5%, but that's an odd one out. Most of the others are kind of sluggish, if you will.
Well, certainly on the radar, but not something that I would go out and pick right away. Even Ajmera, if I speak about there's a very clear falling trend line resistance on a weekly basis, which actually hits at the 860 mark. So up until that level is taken out, I would not really venture into an Ajmera Realty. Honestly, doesn't really feature very high on the list. One positive, though, I must say, is that the 720, 730 support zone has acted quite well in the past. As long as that is maintained, I think the bias for anyone who's holding will perhaps be a little positive. The two stocks that I prefer in this space, one of them is Valor Estate. The stock actually rebounded quite smartly over the last 2.5, 3 months and is still gaining ground. So that's one stock that I suppose viewers should have on their radar. And the other one is DLF. 700 is a bit of a resistance for this one, has been for some time now, but I think once that level is taken out, you will see the stock boom past, much higher to about 770, about 825 levels also. So Valor Estate and DLF are the two stocks. It's just that a lot of these stocks are starting to consolidate with a positive bias, but very few of them have actually given any kind of breakout. So definitely on the radar, not buying anything yet except for Valor Estate.
Okay, I know we've been talking non-stop about defense, but I mean, what to do? Look at the way it's been performing. I want to pull up HAL as well. The numbers are okay, not half bad for quarter 4. Revenue was down 7.24%. EBITDA is down 10.28%. Margins have also come down about 130 basis points, 38.64%. Net profit is also down about 7.5–8%, but nobody cares as far as the stock price is concerned. So here are the key monitorables. There were execution delays in manufacturing order book, shortfall in LCA and ALH deliveries. Management commentary that has come in says that margin may dip from the fourth quarter's base of 40%. That's Q4 FY24's base was 40%, so it's going to dip from there. The F404 engine Tejas Mk1A execution becomes now key. Their order book is at 95.4% at 1.84 lakh crores and new manufacturing contracts at 1.02 lakh crores as well. But like I said, Street is looking at completely a different angle and aspect of this. It's all roaring out there. Kush, before I come to the view on the results as such, on the charts, is there anything that is giving opportunity here? Because the run-up has been quite phenomenal last few days.
It has been, and if I can just throw in a few puns, so to speak, I think the defense stocks are protecting more than just the borders. They're now starting to protect our portfolios as well, and now they seem to be going on the offensive, which is they're now starting to roar. Just speaking to Neeraj about it, which is that these are now medium to long term plays, and you don't play them just for very near term gains. However, yes, the momentum does suggest that you could gain. If you enter into a BEL or an HAL even now, 4700 was a bit of a resistance for HAL. It's now crossing that, sustaining above that will push it into 4950, 5100 kind of territories. BEL, new highs above that 335 mark. I think there is still some way to go before these stocks, start to see any kind of meaningful correction. And even if dips do come about, it's a good idea to start, accumulating them from a medium to a long-term perspective.
Okay, I mean, long term is how long term? I just want to pull up the 1 year chart of HAL, BEL as well. That run up has already been quite phenomenal in 12 months. Because remember, there was a dip and a lull for quite some time. It's about 16% up on an HAL. BEL, let's talk about, and Garden Reach as well. BEL is 50% up in the last 1 year, nearly 50% up, and Garden Reach is 122% up. I mean, do you take some profit off, Kush, if you're holding?
If I just put that in perspective, just the last year, just the last 12 months have been a consolidative to corrective for these stocks. But if we dial the clock back about 4 or 5 years, I mean, we know the kind of multi-baggers they've been. So I will take the last 12-year performance in my stride. And no, I will not kind of, book profits right now. The reason being that, if I've held them for some time, especially the last 1 year or so, I don't buy for small profits or maybe exiting at cost. So I'm looking for big moves on these names. They've already started to see some accumulation even before the tensions escalated. About a couple of weeks prior to that, also there were accumulations happening on some of these names. The price traction was already there. So when all of that is starting to sort of move the prices higher, I wouldn't want to sell them just yet. At best, what I would prefer to do is have a trailing stop loss. But other than that, I would say continue to hold.
Continue to hold, says Kush Bora, on some of the top defense plays. G. Chokalingam, do you concur with that? Are there any favorites there?
Yeah, HAL is better than other two different stocks you mentioned, because I'm just looking at the balance sheet. Though valuation is little stretched at 37 times.
Better than the other two. Which one is better than the other two?
I mean, HAL is better than, Garden Reach and BEL.
Okay.
If you look at the balance sheet, it's almost 50,000 crore of advance payments the company is getting, sitting on 33,000 crore of cash. I think, the balance sheet is so strong in terms of getting advances and holding cash. So it can manage to get order and, sit on receivables and inventory and try to, still post a very good profit. So I believe HAL is most attractive among these three stocks.
Okay, HAL is top bet for G. Chokalingam. We'll take a very short break at the side. On the other hand, we're giving you the top BTST ideas and our segment you should not miss, Bull versus Bear. Come back to see which company we've picked for the day.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Alright, back with India Market Close right here on NDTV Profit. The Sensex keeps on bobbing, but it's doing okay. The Nifty IT is the big one today, in addition to the Nifty Small Cap. I think the Nifty IT and the Nifty small cap, I believe, is probably trading at the highest point of the day right now. The Nifty IT too, not doing too badly, by the way, 1.33% higher. Not bad, really. And the market breadth looking exciting. Volatility index too has cooled off quite a bit today. So bear that in mind. Okay. We've spoken about the gains for the market. Let's talk about a stock which is not quite doing well, and that is Syrma SGS. Now, it's in the spotlight today because post the numbers, the stock has really cracked badly, 6.5% lower. But there is a bull argument to this as well because the margin performance has looked very, very strong. So, Puneet Johnson, you talk about the bull versus bear case for Syrma.
Well, thank you for that. Definitely a very big bull case forming in because of the Q4 earnings. But there have been 2 to 3 key negatives, and we'll highlight that as well. In the first bull and bear case, the order inflow, that's been slightly negative in this particular year. It was expected that fourth quarter would have new order inflows coming in from European clients, but the company has outlined that there was some impact of tariffs there, and clients have pulled back some spending as well as orders, and essentially that's impacted the order inflow in this particular quarter as well as the full year. That's the first bear case. Essentially, the low margin consumer business share has been falling. It was 40% in FY24. It's now 35%. The company is now anticipating this to go to 30% over the next year. What this does is it's boosting margins significantly. In this quarter, the last quarter of FY25, margins were up 505 basis points from 6.6 to 11.6, and hence lowering of the consumer business share, something that the company has been harping on for a while, is now boosting the margins effectively, and that's something that the street likes. When you look at the second bull and bear case for Syrma, the key aspect is the export revenue for this year. It was expected to be 1,000 crores. It's coming at 854 for FY25, and that could be one of the key reasons because these are high margin orders in the industrial and the auto segment. That's not come through, at least what the company had guided for, could be one of the potential reasons as well for Syrma to fall in trade today, because exports forms roughly 1/4 of the revenue for the company. In terms of bull case, we've seen a new good customer additions in this particular quarter, and that's also happened in the largely in the domestic business as well. So it's competing well with its peers like Keynes Tech in the auto segment. That's a positive. That's the second bull and bear case. The third one is, of course, on the stock reaction as well. When the Sensex ran up, the Nifty ran up 900 points, Syrma was up 14%. It was up again on Monday. So 17% run up before the results. So slight disappointment as well, which is coming now in this particular quarter because of the export, has taken the stock down, but it's still up significantly in this particular month. Could be a key reason to watch out for. And the bull case has been the industrial and the auto business. The industrial business now forms 44% of the revenue. It's become the highest in terms of revenue contribution, and that's because of the smart meter segment of the company. We've seen multiple companies in the EMS as well as the engineering companies getting a lot of orders in the smart meter space. Syrma is also one of the key gainers, and they are going to be at the tier 2 manufacturer for a lot of companies. So that's one of the key aspects. Auto segment also contributing more than 20%. So 69% of the revenue is now the high margin business. Finally, in terms of valuation, 29 times FY27 for something like a Syrma. In comparison, Dixon trades at 80 times. A Keynes Tech and an Amber are at 60 times. So the valuation is definitely in favor. I think the street is right now on the fence because of revenue growth, and that's not there because of the consumer business. But the EBITDA margin will be something that brokerages will incorporate maybe tomorrow, because the conference call happened during the day today. The lower export growth has been one key negative, and a share of consumer falling will impact revenue growth but will help margin. So I think it's a to and fro between margin growth as well as revenue for something like a Syrma, but definitely a stock to keep on your radar going forward based on relative valuation as well.
In fact, we spoke to J.S. Gujral, MD of Syrma SGS, about their top line growth outlook for FY26. Listen.
We achieved a top line of about 3,800 crores this year in FY25. Going forward, I think we would be growing at about 30 or 35% for the next year, and maybe at the same percent or marginally higher or marginally lower percent in 26, 27. So I don't think that matches up to the 6,500 crores you said, but my growth will be about 30-35%. What we had shared earlier this year, that we are recalibrating our strategy to focus on high margin verticals. And that is essentially the industrial, the healthcare, and the automotive. And I'm very happy to share with all of you that in the current year, we have been able to bring down the low margin consumer business to about 35% of our revenue, which was a target which I had set for ourselves. And the balance 65% is a high margin business. Going forward, we'll try to recalibrate this again and endeavor and bring down the consumer business to below 35% or closer to 30% by the end of this year on a year-on-year basis. Now, if that was to materialize, then I think we are on track to achieving superior EBITDA margins of about 8%.
Okay, so that was the view coming in from Sirma. On what their results are looking like. Meanwhile, markets are looking decent. Markets are looking decent at this point, despite a bit of fatigue coming in off its highs. Definitely for the Nifty, we're about 15 minutes into close. Just the index call from your Kush at this point.
So I think there is a good possibility that we might just consolidate for some time, and by that I mean maybe a couple of days. The reason for that being, if you look at the weekly option, expiry setup, which is tomorrow, then you've got the 24,500 put that has a good base, but very strong open interest build up around the 24,700 mark. So I will keenly watch for 24,500 and 24,700 as the range for today, for whatever time is left, and tomorrow as well. There's a possibility that we might spend the expiry within that range. I think closer to 24,500, I'll be more comfortable buying with a stop loss around the 24,300 mark. And on the upside, then again, 24,800, 25,000, open up your target, open up as targets. So for now, sideways consolidation, par for the course after the kind of, last few volatile days that we've had. And 24,500, 24,300, that support zone still continues to remain a strong one. So yes, closer to those levels, I will be a buyer. Just a quick word on Bank Nifty. I think the muted performance that we are seeing over the last 2 weeks or so, I'm not too surprised by that for a very simple reason, is that when the rest of the markets weren't doing anything, it was the banks and the financial services space that pulled its weight and the sentiment for the market as well. Now that you're starting to see FIIs come back, a lot of domestic money also starting to pumping in mid and small cap sectors performing, I think this is more of a case of a sector rotation than anything else. I think Bank Nifty is also in a good state from a positional standpoint. That said, we did put out a buy put call on our advisory this morning on the Bank Nifty, and that's played out rather well. So some more muted performance up until the level of 54,000, where there is a gap, is perhaps likely. But as I said, from a medium-term perspective, I think this dip will turn out to be a buying opportunity in Bank Nifty.
By the way, just those flashes on your screen, I would just urge people to be a bit careful. We don't know. The investment by the HCL group need not necessarily be through HCL Tech. In fact, I would presume it is not through HCL Tech because it's an IT services firm not involved in manufacturing. I really doubt that it's HCL Tech balance sheet being used for this. It's a JV between HCL Group and Foxconn. So HCL Tech, the listed entity, I would think doesn't get him. So just urging people to be careful about this. All the past news that I have read on this, the memory serves that it is HCL Group and not HCL Tech, the entity. So bear that in mind for sure. Mr. Chokalingam, is India is making its semiconductor presence felt, though we don't have a very strong supply chain or a sector here, but are there any potential beneficiaries of the semiconductor cycle becoming stronger in India? Maybe ancillary companies, if not the pure players?
Yeah, the two players I can think of. One is CG Power, who got a phenomenal subsidy as well, and it is part of most successful reputed Murugappa group. I have been tracking that group for nearly 35 years, and whatever new acquisition or new business diversification they have done, they have been consistently successful. So I believe this is one can consider. And second is Cyient Limited. It floated 100% subsidiary for semiconductor business. The stock is also down 40% from the 52-week high. And it has got a 3 diversified business model. Apart from IT services, it is into engineering product business through Cyient DLM, and then semiconductor through 100% wholly owned new subsidiary. So these are the two stocks I think would be it could be potential beneficiaries of this emerging semiconductor theme.
Okay, so the defense play, the solar industries, let's just pull up the solar industries counter for you. They've put out a post on social media right now saying that they've conducted trials of Bhargavastra. Bhargavastra, developed by Solar Industries, micro rockets used in the counter drone system, underwent trials. It's been designed and developed by Solar Defense and Aerospaces Limited. Might not be the same company, we should check. Conducted 3 trials at Gopalpur today. I think more and more the role of Indian defense companies is going to become very, very crucial. But is there a limited upside to the kind of spends we can see? G. Chokalingam, let me come to you on that. Is there now a limited upside to the kind of spends we'll see? Because these are lumpy spends, right? And they will take a long gestation period to turn around.
Yeah. I mean, it's already, rallied a lot and more than 1 lakh crore market cap. So I am not confident to recommend this stock at the current value. It's a great company, no doubt. But is it a good valuation? I have my own doubts.
Okay. Yeah. I mean, 13,721. I think I would suspect that the market cap of Solar Industries, which had crossed the 1 lakh crore mark, 124. This is serious gains that this stock has done. I think if you can pull up the 6-month or the 1-year chart for solar, you'll see the kind of gains that this stock has made. It's been stunning, really, for a business which was floundering maybe 6 years back because the capacities were not being utilized. It's been a really remarkable run for this one. So keep this one in focus for sure. The other set of stocks, Mr. Chokalingam, and then I've taken a question to Kush as well on this, but we're looking at the stocks which have had a good move today. ITD Cementation, 10% earnings growth, margins flattish, 10% bottom line growth. The stock is up, maybe because it won a 530 crore order, but how do you look at a company like ITD Cementation if you track it, Mr. Chokalingam?
I used to track in the past, but not recently. But then definitely, when it was a part of MNC group, it has already developed a very robust system and process and, channels. So I'm sure, it can add a lot of value to Adani Group. And I believe one can continue to hold. If there is any marginal correction also, one can accumulate the stock.
Kush Bora, strong move today, 11% higher. What do the charts suggest?
This is too high, too fast. There was a good consolidation that was happening in this stock for some time, but the move that it's made today, it puts it on a slightly overheated territory, and any risk-reward ratio from a near-term perspective is lost. But typically, how I prefer to play these momentum trades is that you book them out partially. So if you have any holdings from lower levels, where say about 560, 550 or lower, where the stock actually been for the last 6 months or so, to exit partially and continue to hold the rest. Up on the upside, if this momentum continues, 665 is also a level that the stock could touch, but I wouldn't really play for that now. So yes, no fresh positions recommended. If you have any positions, book 50% and continue to hold the rest with a trailing stop loss around the 600 mark.
What about this thing, your top closing strategy?
Sure. So surprisingly, the cement play continues to shine even now. I mean, one would expect that because of the momentum that they've witnessed for some time, and even the seasonality plays, there might be some cooling off, but that's not happened. So from a BTSC perspective, it's Dalmia Bharat that makes the cut. We've discussed this stock a couple of times in the past.
Dalmia Bharat Sugar or Dalmia Bharat Cement?
No, Dalmia Bharat Cement.
Cement, okay.
Yeah, with the targets of 2090 and 2110. And the stop loss around the 2030 mark. Dalmia Bharat, as I said, continues to impress and can be considered as a BTSC trade or a medium-term trade as well. And by that, near-term trade, a week or so, maybe not much longer than that.
The other sector that's blowing hot, blowing cold, almost on a daily basis, and leaving everyone mighty confused, I would say, are IT stocks. And we had a great conversation today with Macquarie on why they are bullish. But Kush, just on the charts. Is there anything that you're seeing for a breakout right now in the IT space?
Yes, so I am in that camp where I'm not too convinced about the kind of moves that you've had. You're quite right, actually. I think the silver lining that we could take out of this is that about a couple of weeks ago, everyone was bearish on the IT play. Consensus was building up that, there's one shortfall on the street and that's IT. And that's now starting to shift, and that is reflecting in the price. For me, however, not much has changed in the sense that, yes, there's been a run up, but there's not been a breakaway run up. So let me give you an example. TCS still below that, 3600, 3650 resistance zone. Infosys also below that 1600, 1625 kind of resistance zone. So unless some of these are taken out and you see a sustained move, above these levels, I think these pressures will continue. So no, not really. HCL Tech is something that I like in the larger names, but I will still prefer Coforge and Persistence of the world, where I think there is a lot more traction, and momentum could well continue in the coming days as well. So if you have to pick something, pick a Coforge and a Persistent in the IT space.
Interesting to see that HCL Tech chart. Just pull it up for us if you can. And the point you were making, Neeraj, that one cabinet briefing announcement talking about HCL and Foxconn.
Yeah.
But it says HCL and Foxconn. There's no clarity that HCL Tech is involved or not, but Street has jumped on it in one way or the other.
Yeah,
I mean,
but because
we'll wait and see. Yeah.
Yes, we should wait and see. The only reason I'm saying this is because all the previous newspaper reports that you see speak about HCL Group.
Yeah.
There's no mention of HCL Tech, the entity, and just logically.
What would they be doing? What would an IT service company be doing in semiconductor?
Manufacturing, yeah.
So, but anyway, this is a trigger happy time maybe for whoever is seeing in the IT space, because the question is, will IT be able to crack the code in FY26? That is a question on everyone's mind, and we spoke to Ravi Menon. He's the IT services analyst at Macquarie Capital about the sector. He's one voice who's quite bullish that the worst is over. Listen in.
The large cap companies are so big. We are not talking about 20% growth for a TCS, right? I mean, that's not what we're saying. But we think the overall industry can actually be in like a 10 to 12% sort of growth range. That's the possibility for 3 to 5 years or even more. And I think that itself, and with the mid caps, of course, growing much faster than that, and select large caps within that, like a smaller one, like an HCL Tech, probably even delivering 12-15% growth, quite possible. And that's what we think.
Okay, and Nifty IT 1.4% higher. Now, Mr. Chokalingam, this gentleman was making a point that IT services companies could actually do well, whereas the last 10 years have been clearly the product companies which have had a good run, because AI adoption will lead to more requirement for IT service companies, because they will be able to help corporations go through this. Now, is that a fair argument? If so, are you constructive on any IT service company?
I'm not able to agree with that point of view. I may be wrong, absolutely.
Of course.
I've been tracking IT service from 92 when the whole India's export was $5-6 billion. We have come a long way. In a strong triple digit we are exporting. One major limitation is the base itself. And that started showing it up in, 4 years back itself in terms of, dollar exports growing in a poor single digit. I have of the firm view that they would continue to grow in the range of 2 to 5% in dollar term, the exports, revenue exports. And I don't see opportunities could be there in select to small and mid cap, because if you recall 2014 to 2021-22, you saw a lot of acquisitions starting from Patni Computer to Polaris to Mini. And that should happen once again now, because they made a lot of cash. But one mistake they have not done is they have not diversified outside IT services. That's why when we were talking about even HL technology, I hope and pray that they correct that mistake and they get involved directly into these kind of joint ventures and business deal, because there's so much of cash not diversified. But for IT services, I am negative. I don't think the large cap stocks can create any meaningful wealth in the next 1 to 3 years. So it is better to look at a small and mid cap where possibly the acquisition opportunity is there.
Okay, what about metals? Metals is something that we've not spoken too much about. The US-China trade deal will see some spillover effect, and one of the sectors which was badly hit in fear of that global recession were metal stocks. You're seeing a rebound today, and the metal index has been pretty strong as well. Any picks over there, Chokalingam?
Yeah, definitely. As you rightly mentioned, it's a big deal for metal sector. All of us know that China plays a major role in metal. So the trade deal, temporary deal, also positive. So one can, consider stock like Hindustan Zinc. the zinc business is relatively safer than many other core industrial metals. So, and also the stock is down almost 45-50% from the 52-week high. So this one stock gives you a lot of comfort. In added comfort is the silver business, which is now slowly becoming equally important to zinc in terms of the profit contribution. So one can consider Hindustan Zinc.
Hindustan Zinc is what G. Chokalingam likes. Kush, any views on the metal pack? Sale is roaring today. Jindal Stainless. We have quite a few winners.
We do, but I mean, not this sector is with its share of volatility and rather high at that. But the two names that pop up on my list, one of them is Hindustan Copper. This is now breaking out above the 225 resistance. The accumulation that it's witnessed over the last two sessions has been very, very encouraging. So I think from a near-term perspective, about 240 and 250 are your targets. Keep 220 as a stop loss. So 1:2 risk-reward ratio also playing out there. The other one is Nalco. Here too, we've seen consolidation for some time and a sustained breakout move over the last two sessions. Today also is crossing above the 170 to 170 350-day moving average. The next call congestion is at 180, so that's a good run that the stock can have. So about 180 to 187 are your targets, and you could keep the stop loss around the 165 mark. So Hindustan Copper and Nalco are the two stocks that are popping up on my radar in the metal space.
Wow, 5% high. So, but you are comfortable buying it 5% higher, huh, Kush?
Oh, absolutely. Again, I'm generally not perturbed by the kind of single day big moves as long as the risk reward ratio is favorable. It's backed by a couple of other technical parameters. The biggest one being volume, and we are seeing that. So yeah, I'm not perturbed at all by a big move.
Well, very quickly, Jubilant FoodWorks. If indeed India, Turkey, and those things that are going on right now, because we've seen serious cancellations. Jubilant FoodWorks, large presence in Turkey. Is it a stock that one should avoid?
Yes, I believe. Conservative investors should avoid at this juncture after this news.
Then why not look at an Interglobe as well? Interglobe up on the ceasefire coming down, but then again, business with Turkey. It's a bit of a tricky terrain there. Thank you so much, Kush and G. Chokalingam, for joining us today as we wrap up what has been not so hot, not so cold kind of a day. It's been a Goldilocks kind of a day. Started off decently enough, and we're closing above 100 points on the Nifty. Not quite making the 24,700 mark. Let's see if we nudge past in the last minute or so, but seems unlikely. Bank Nifty just sat out on the sidelines today. It was the Nifty IT that really took on, and just pull up the Nifty IT index. We'll see the intraday as well as we go forward, and this is near the day's high on the Nifty IT. This is where really you're seeing some boost. I just want to pull up the Nifty heat map also while we're at it and see what's happening there. It's all about steel. It's all about defense. Definitely, I mean, defense is the story of the moment as far as the Indian markets are concerned, and a smattering of banks there on the top line. Tata Steel looking very interesting, 4% up, and strong fundamental story there as well, which has boosted Tata Steel, pulled up the entire Nifty metal as well. But Hindalco also following suit. Interesting to see and good to see the move coming back on Eternal, about 2% up after languishing for the last few days. On the downside, Asian Paints taking a bit of a knock. Cipla, impact of brokerage notes and seeing that pain point there. Tata Motors, again, people didn't quite like that there was no guidance from JLR, and we spoke to the management today. They are saying that passenger vehicles has been a bit of a pain point. So JLR on one hand, passenger vehicles on the other. Neeraj, I think for Tata Motors and for the auto pack, that pain is going to continue for some time till some clarity comes in.
Yeah, so very likely. But I think, as was the case yesterday, I mean, very quickly the action at the broader end of the spectrum, and we've spoken about that. But the defense names, if you can pull up that defense index components, or individually just look at the kind of moves that some of those have made. Garden Reach, Midhani, DCX, Cochin Shipyard gave off a little bit from the highs of the day, but still doing okay. Zemtech up another 5%, Paras Defense 4%. I mean, there's some serious moves that have happened in some of the defense names. So that is one aspect of today's trade. And then Nifty IT, yes, we marked the large caps, but if you can pull the Nifty IT performers out here and see if the mid cap names have done. So Emphasis 3.5, Coforge up 2.5%. So it's not just restricted to the large 4 or 5. Some of the others too have not done too badly.
Yeah. And what I found interesting in the last half hour of trade is how defense companies have started coming out and posting on social media about which of their products was used in Operation Sindoor. This is very, very unusual because usually defense companies would be tight-lipped about it. But they have come out and they've said that this was my product and this is how it was used. That's not something one quite sees. Let's just look at the advanced decline ratio as we quickly wrap up the show today, because that's an important marker on seeing the inherent strength of the market, because it's a great ratio there, advances to decline coming in. So strength there. The broader indices also closing fairly strong. The mid cap and the small cap will pull that up for you, about 1.5% on the mid cap, 150. Definitely outperforming the Nifty. So is the small cap, 250, doing fairly well. Should we quickly look at the top gainers and losers in the broader markets before we wrap for the day, and then we look at factors? No prizes for guessing that on that side. You have key defense names. I think here there's a demerged entity today, which is why you're seeing that glitch. But Metropolis held on the downside because of numbers, not too exciting there. And then you have a clutch of names that haven't done too well. But on the gainer side, again, it's rail as well, not just defense leaders, it's rail as well today.
Yeah, a bit of gains for Urcon for sure. So that's to be kept in mind. Apart, some pretty good moves, and JK Lakshmi up 6%. Wonder if cement companies could actually, selectively they have done well, but not all of them. But very quickly, the factors to watch are the things to watch out for. So this is of course the interim dividend coming in from likes of Manappuram Finance, hardly anything, but BEML and Great Eastern Shipping or GESCO could be the ones to be interesting to watch.
Yeah. Apart from that, shares which will exit lock-in. We spoke with this company today. Ask Automotive will see some pressure tomorrow as investors can exit, and earnings, of course. Earnings continues to be the focus to watch out. Watch out for a Cainstech, BKG, Inox as well, JSW Energy. So quite a few movers. PN Gadgil, quite a few movers will be reporting tomorrow, including NLIC Housing. So we'll watch out for all of those. So it's going to be another action-packed day tomorrow. Stay tuned for all that and more on NDTV Profit. But for now, from Neeraj, me and the team that puts together the show, thank you so much for watching.
And watch out for the management of Tata Motors speaking to us on the other side of the break.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Hello and welcome to NDTV Profit. You're watching Earnings Edge and we have with us PB Balaji, who is the Group CFO at Tata Motors. Balaji, interesting times, too much happening globally in terms of tariffs, US, China, India, UK and now India, US. And in middle of that, I think both the businesses are now net debt free. How do you sum up the quarter and the year for Tata Motors?
Thank you. Firstly, thanks for having me on the show. The year has been a very good year for us. It was a challenging year. It was not an easy year. And also it is a year where the comparator was pretty strong. We had a very strong FY24. It was a record year. So that way I'm pleased that be it on the revenue side or on the profit side, we beat last year in this kind of an environment. Why that's important was that it tells you the underlying fundamentals of the business are doing well. And yes, there may be operating challenges on a growth level, which we will deal with, but intrinsically we're in a good place. That's an important part of the turnaround, that you'll need to deliver a resilient performance under all conditions. And that's also the reason why we also declare a dividend of 6 rupees per share. It's a sign of confidence that we can, because last year the ordinary dividend was $3, the special dividend was 3 rupees. And this year we've taken a final dividend ordinary at 6 rupees, which is a sign of confidence that we can sustain this performance, number one. And at the same time, the external conditions are a bit unclear and challenging at the same time. Challenging means we can start executing strategies. It's unclear. We don't know which way it's going to go. So we just need to wait for much more clarity to emerge before we can move. And if you take the US-UK tariffs, yes, it's a great, finally it happened. But we shouldn't forget that it's 2.5% tariff that's gone to 10%. 25 maybe have come down to 10, but 2.5 has gone to 10. So we still need to ensure that we keep our house in order, do our disciplined cost execution, cash execution, choose the right pockets of growth, ensure where inevitably we need to put up pricing. All that we'll have to take care. At the same time, there is also, we don't know whether it's going to be retrospectively applicable from April 3rd. We don't know whether it's applicable for parts and accessories. There are a lot of unanswered questions on that, which I'm sure will emerge in the coming days. So that is one part of it. If you take UK, India, that's again, it's an excellent development there because it augurs well for the future. My current cars are anyway all locally CKD manufactured, barring the Defender, and therefore it won't impact the current cars that are already there. But when I look for future cars, that we should be able to get it into the market faster at global prices. But here again, we need clarity on what are the quotas, what are the speed at which the 100% goes to 10%. So we need more details, which I'm sure will emerge in the coming days. And that's why we are dealing with a strong delivery. At the same time, we need to deal with these uncertainties as well.
How do you look at FY26 in this scenario? Means, are you penciling in a growth, or at least a growth over FY25, or is it going to be a strong, robust growth with respect to volumes and value coming in?
See, firstly, I think one thing we have been very clear is that we never run the business for a quarter or for a year.
That's why I asked FY26.
So we always position the whole business at all points in time in the right direction. So for us, the fact that investments continue apace should give you enough and more indication that we are absolutely feet on the pedal when it comes to the growth agenda and the investment agenda. What we are conscious of is that I think we need to get tighter with respect to our cost and cash agenda so that we can navigate whatever noise comes on this front. At the same time, we should be clear that we'll have to be super agile. Wherever pockets of growth emerge, you'll have to go and be able to tap into it and deliver on that. Which I think Tata Motors has more than adequately demonstrated the ability to move things with speed and with agility. That we will continue to execute that way. And the demerger just gives us that additional ability to drive focus on the CV side and the PV side much better.
I was coming to that because, that's a domestic factor which is going to play out over the next 2 to 3 quarters, which is there. And how do you see both the businesses now placed now that they would be independent maybe from October onwards?
So I think firstly they're in a very good place, both the businesses. The fact that you got net debt free also is a huge relief for both the businesses, because we shouldn't forget there's almost a 4,000-5,000 crores buffer that has got created if you go back to earlier era to where we are now, which gives us the flex if we have to flex the P&L. At the same time, if you look at the CV business, let's take one at a time. Barring the small commercial vehicle business, I think every part of the business is firing very well. And this is a year where we hit the 12% EBITDA margin. We grew margins when our revenues declined, which haven't happened in CV for the last 25 years. That business delivers a ROCE of almost 40%. It's a rock solid business where the market shares of the heavies, the intermediates, the buses are all in a very, very good place. And the realizations are stepping up, profitability is stepping up, and we are able to now deliver value there at a very strong ROCE. So that business, when it demerges and then becomes a standalone business on its own right, it's got a very, very strong cash generation potential, which it's been demonstrating. And we would want to keep that going on that front and use that to go deeper on all other aspects of the business. I think when we crack the small commercial vehicle business, which we are confident we'll do it this year, I think that will also give you higher returns in that business going forward. So CV in a good place, be it the balance sheet, be it the shares, be it the profitability, cash flows, any metric that you take. That's in a good place. CV cycle, let it turn, let it come whenever it comes. It doesn't matter because anyway we are stepping up our cash flows and profitability even in a down cycle. So it's only upside from here on, from that perspective. Passenger vehicle side, I think last year was a year of consolidation where we did about 13.2% share. And the thing that we should have done a better job of is on service, where the growth came in so fast over the last 4 years. The service requirement was way ahead of what our capacity to serve was. That has got fixed in the last 6 months. Another 3 more months, we should get this completely nailed down. Then you have the product offensive coming in. If you look at last year, SUVs we did well. The only product category that went down for us was the hatches. Tiago has been relaunched, Altroz has been relaunched just now. With that, we would expect to see that come back again. And we then have the Harrier EV launching in, the Punch MC coming in, Sierra coming in. So there is enough and more products for us to. Our product offensive is from competition was last year. For us, it is this year. This combination should help us deliver growth on the PV side. EV side, the only area where we lost out was the fleet segment, which is again FAME 2 incentives went away. A few of the EV fleet players had challenges in their own. That is something we need to attack. There is a substantial CNG segment out there in the fleet side. We are clearly looking at products that can go and cater to that segment, and you should see that play out in the course of this year. So if I say when the demerger happened, that business is already cash positive, and it has a task on hand to pick up another 100-200 bps of profitability on the EBITDA side, which it will deliver the course of this year. Shares going up, profitability going up, balance sheet remaining strong. The PV business, and it is now cash positive, the entire PV business, no challenges there. That should take care of, it can stand on its own legs. And JLR, we have consciously said all the capex will be funded out of operating cash flows, even in this environment. So we are having a good upside coming through as far as the PV side is concerned, despite the tariffs, despite the global environment, despite EV competition, everything laying out there. So even if I look at assuming this year, what we see right now is the worst of times for JLR and PV, you are still delivering these kind of numbers. So the upside is only from here on. So we have enough in our kitty to give us sound confident. The only reason we said, okay, the next obvious question is, why would I not put a guidance on top of all this? I'm sure your eyes were popping out on that. I'm not surprised. If we have always said whatever guidance we put, it needs to be credible and we should hold ourselves to account. You tell me how will I put a guidance and I don't even know whether the tariff is effective retrospectively or not. Mathematically, I can't put it. So let it come through. We have said, okay, hopefully we'll get clarity by the investor day. The minute we get clarity, we'll put it out there. This also helps us to go for it.
Sir, one question on the passenger vehicle side specifically. You spoke about that the service was one thing that you focused on last year, and I think the last time we spoke to you after quarter 4 of FY24, you mentioned that you were expecting a 3 to 5% industry growth, and that panned out. But for you specifically, the growth was negative for FY25. You mentioned almost 4 to 6 new launches, some going into petrol, a couple of refreshes. Yeah. But in FY25, it was a year of recalibration. Was that something that from the onset was the plan? Because we've seen one of your closest competitors take market share this year, while the other industry players have also suffered. I think the expectation from Tata Motors from FY24 was industry growth. So how would you tackle that question? Because it's a fall in sales essentially in this month at a time where you've planned so much in FY26. The refresh is also a couple of years. This thing. So in terms of planning, how has that happened between the last year and this year?
See, last year the thing that did not work in our favor were two things. One was the hatches segment, where we lost substantially more than what we should have lost, because we grew much lesser than the market. And the second was the fleet segment sales error. SUV segment, we are in a good place, and that continues to do well for us. I think the hatches segment, we didn't realize the weakness of the product range till the relaunch happened. Once the relaunch happened, Tiago is coming back into the equation quite nicely, so we should get that picked up. Maybe the fade was simply too sharp on that side. Look at the EV segment, the FAME incentive-led fleet sales. I think that was beyond, it's just a nature of the market. Our market structures was like that because the Tigor EV did not work at all last year because of the fleet segment sales. There is quite a substantial portion of it. But the rest of it have done well for us. And I think with the stabilization of the battery prices and the put-down prices therefore stabilizing, we should expect to see a more sensible portfolio. If I have a one product launch, then the pricing I can do whatever I want. If I have a full range of products that are already in the market, for me to intervene in one price also means that I have to take the full piano has to be worked with. That took us a little bit more, it was more challenging than what we thought it would be. But as we get into this year, battery prices having stabilized, we are on a good wicket on that side. And we've also now got flex in terms of the range of battery packs that we can put onto it. So all this is going to give us the benefit as we go forward. Add on top of it the PLI benefits that are coming in. That gives us ammunition to actually play this much better than what we could last year, because the PLI benefits came in only by Q3. So Q4 has been a decent play, but the losses that we suffered in Q1 and Q2 took us a while for us to recover from. But that I'm confident from here on we should get that right. And internally also, we had such a rollicking growth for the last 4 years. Your systems, processes, business planning, everything also works in one direction. You needed to correct a few things. We've used this time, that's the reason the year of consolidation, we've used that to fix some of the internal processes that were a bit off kilter in this kind of a growth environment.
Would you also say that last year you mentioned 3 to 5% growth for the industry? Is that analysis again for FY26? And do you expect Tata Motors to outperform comparatively? I know you can't quantify, but significantly anything that you can share?
We are absolutely clear that this is a year where we'll go significantly higher than the market. And it is backed by product launches and the fact that the service network has been fixed. Those were the bleeders for me last year. So having fixed that, I should get the kicker this year, with competition also now more or less finishing off their product launches the way their plans are.
You know, FY25 at 13.2% market share. So do you see that market share going up in FY26?
Absolutely. It's a growth plan, share growth plan is what we are currently working with.
So with new launches, the marketing cost also would be something to look at. How would that, because in this year we've seen the margins also drop a bit, and I'm sure that your expectations would also be to grow that substantially from...
See, more than the FME that was the product, the costs came down because of pricing actions that we had to do and correct for inventories that were already there in the market. I think that is now behind us now, and whatever FME you will get, if your contribution margins are strong, FME can be funded, and those corrections have also been done. So I'm confident we'll get the share increase and the double-digit EBITDA that we have been guiding for. That should be very much the plan for the current year.
How do you look at the JLR as a operation? Because you said that it's now cash. You're going to fund everything from the cash flows for JLR. What is the kind of pipeline that you have for JLR, and what is the capex plan that you have for that JLR?
See, the main launches that are coming up are the Range Rover Electric. Then you have the Range Rover Sport Electric coming through. Then we have the full Jaguar, the new world of electric Jaguar starting to come through. So next 3 years is a super intense launch phase for JLR. And we start with the Defender Octa that is just about getting launched at this point in time. So for that, the capex plan is about 3.8 billion is what we have guided the business. Last year we did about 3.8 billion of investment. That will be broadly in the same ballpark range this year as well. And that should be funded by the operating cash flows of JLR, even in the worst of times.
Two key markets that you have, one is China and one is US. 34% coming from US for you, and I think Defender is coming out of Slovakia, where the rates are much higher. How do you plan to manage that kind of, and is there a way you can shift production to UK or any other market?
No, in the short term, we'll not be able to shift production from there to here. So we'll have to deal with it as one of the cost elevators that's going up, for which the source of funds will need to come out of warranties, out of material costs, out of how we sell better mix. And that's the whole transformation program that has been drawn up, which we shared briefly yesterday. And we will talk about it in greater detail on 16th. The intention is to create a kitty of costs and cash, which will help us offset these numbers that are coming through. The question is, how fast can we execute them? How much of it will land in year, in quarter, and how much of it is going to spill over into next year? So obviously the teams are on message to say that we do it as fast as possible.
The expectation was that maybe at the end of FY25 you will show us a pro forma P&L of how CV is going to look and how PV is going to look. Will that be also something which you will be showcasing?
CVP, we already guided the CVP, no changes as far.
The P&L point is for the markets to understand how both business individually looking in terms of.
See, what the P&L side we already guided for. We have said CV is going to be a double-digit EBITDA business, growing share, and the implication, and it will continue to be a very strong ROCE business. So that has been guided. We stick to that. No change in that. PV business, you said the first port of call is to hit the 10% EBITDA margin, and that is something we fell short of this year. We should have hit it this year, but we are down from that perspective. We want to get back to the 10% EBITDA and grow share in that business. The most important thing metric market is looking for in PV will be continued share growth and continuing to drive EV penetration in our portfolio and delivering a 10% EBITDA on the PV side. PLI benefits are a given, so that will continue to play out. You put this together, the PV business is cash positive despite investments in the EV side. That is how we want to play this part of the portfolio. JLR, we are not in a position to put a EBIT number there simply because too confusing, as we just said. But we are clear whatever capex they require, no pullback of capex, that will get funded by operating cash flows. So that gives you the framework on which to hold the business responsibly. And then everything else that we are able to deliver flawlessly is upside to this case. So we are at least drawing the line in terms of where this business can't go below. And now the question is, what do we do on the upside?
You mentioned that last year was a very good year for you in the US, like roughly about 1.2 lakh units sold. That might be a little bit under pressure this year. I think if anything that you can talk about that. And second was in terms of JLR, because your Defender is a very strong brand and that's been growing very well in India as well, in the US as well. So the other regions which you have, because UK and Europe, you spoke about a little bit that the growth has been slower and you are expecting that to come back in next year. But the other regions, if you can talk a little bit about that, is that where do you target that? Because essentially the growth has to come. I think that would be something to watch out for, right?
See, the markets that are starting to do well for us is now UK is coming back very strong. The reason it's coming back was that last year was impacted by the insurance issues that we had, the theft issues that we had. That's all now completely cleaned out. So the cancellations are collapsing there. So we are in a good place on the order pickup on the UK side. So UK will be the top performer that we would want to focus on, where any volume risk coming out of US, we will want to pick up there. We will want to hold China steady because I think China, we have done very well compared to competition in that market, and that's the reason that we are amongst the only few OEMs which delivered on our guidance and did not drop our guidance at all this year. We held it, and despite market disbelief, we have delivered on that. That is because China is an area that we have played our cards very well, learning from our experience in 2019. That was a challenge there. If I hold China and whatever US volume pressure comes in, I first want to absorb it in the UK. Europe is starting to grow back again. It's starting to gradually come back for us again. And that is something we'll want to incubate and do it carefully. The upsides are all sitting in the rest of the world, where Middle East is doing well for us. India is doing well for us. We'll want to see how much we can pick up on the slack that's coming from the UK, from the US onto these markets. So a little bit of remix of demand, strong focus on cost and cash, then the full portfolio will be able to hold it together and say that how do you grow from here on, both on the profit side as well as on the growth side. But that will require us a little bit more time for us to work the whole problem out.
Balaji, we are running out of time, but we haven't spoken of one segment, which is electric vehicles. You're ending the year with 55% market share, but that segment saw hyper competition in the 12 to 20 lakh mark, where your market share is around 30 to 35%. How do you plan to revive that, and are there enough products coming in your portfolio in this year to plug those gaps?
Sorry, what's the consumer like there as well? Is there a second car that people are purchasing as an electric? Because that's something that we've seen in electric scooters as well, not comparable. But the 12 to 20 lakh range has gotten hyper competitive, but based on India's
so I think it's a mix of play. Let me answer both the questions together. Let's start with the customer. It's always a better place to start. I think we are finding first purchase coming into the EVs directly, but that has slowed down compared to what it was in the past. At the same time, second car is now becoming very much a par for the course in terms of people picking up the second EVs there. But if you look at tier 1, tier 2 cities, it's becoming the first car itself. But park that point. I think it goes back to the other point that is there, which is how do you step up penetration of EVs in the overall port? That's a big question to answer. I am absolutely relaxed as far as competition is concerned, because more competitive is good for the market in terms of, the game is not about market share. I kept seeing it from day one, even when we are 85% share. The issue is about how do you drive penetration of EVs. And today the market is only 2.3%. If that has to go to 30%, you will soon find people have no choice but to push EVs onto, just from a Cafe 3 perspective. Park that also aside. We have a full range of portfolio coming in. And we are the only player who start from an 8-9 lakh car all the way up to a 25 odd lakh car. Then that will go with Avinya coming in, it will go even higher. So we have enough product introductions coming through there. In the segment that you referred to, I think Nexon itself is now starting to go very strong post the relaunch. Then on top of it, you have the Harrier EV coming in. The Curve has just been launched in that same price segment. Then you have the Sierra coming in. And then the Harrier EV is there. So there's enough and more products available for us to play the game. I think our job as a market leader is to continue to drive mainstreaming of EVs, for which focus on chargers, focus on range, focus on put on price. This combination will then get cracked. So, and with the fall in battery prices, one of the things that really confused the market last year, and normally it happens in markets when price corrections happen sharply, is people just wait. I think now prices have stabilized, the confusion of hybrids is gone, and then suddenly you realize that the market is starting to come back again. And more competition means that the conversation also starts moving into EVs, then may the best player win.
Last time when we spoke to you, you spoke about the fact that the differential is going to come down and going to, are you seeing that?
Already Curve is matched, right? The Curve ICE and EV prices are matched. So the matching of it particularly happens in the higher end segment, because then the GST difference is also substantial. So we are able to pull it off even easier on the higher segment. But even in the lower segment, if you look at the TCO perspective, EVs are comfortable in that respect.
Because maximum volume comes in that segment, 12 to 20. So you're seeing that happening there also, right? Balaji, it was a pleasure talking to you today. Thank you very much for joining us on NDTV Profit.
My pleasure. Thanks for having me on the show. Take care.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know?
Broader markets outperformed the benchmark Nifty 50 with strong gains across small and mid-cap indices. Nifty Metal emerges as the top gaining sector, driven by SAIL and National Aluminium. Nifty Bank struggled, making its worst sectoral performance, weighed down by private banks. The Union Cabinet approves a semiconductor manufacturing project by HCL and Foxconn under the India Semiconductor Mission, marking a key step in the country's efforts to build a self-reliant chip ecosystem. According to top sources, the government will intensify scrutiny of at least 7 major China-backed FDI proposals and joint ventures with a fresh and tighter review. This comes amid rising tensions, including China's recent support for Pakistan during the conflict with India. Hundreds of Indian travelers cancelled plans to visit Turkey and Azerbaijan following their support for Pakistan in its conflict with India. Over 50% of bookings to these countries combined have been cancelled in just 6 days amid mounting boycott calls. India withholds the X-handles of 3 state-run accounts for spreading misinformation in the wake of India-Pakistan tensions. The first account to be withheld was media outlet Global Times, followed by Turkish public broadcaster TRT World and China's Xinhua News. Sources say the RBI is considering stricter norms for unsecured personal loans, urging banks to strengthen internal lending thresholds. Justice Bhushan Ramakrishna Gavai, sworn in as the Chief Justice of India, President Draupadi Murmu administered the oath of office to him at a ceremony held at the Rashtrapati Bhavan. Good evening, you're watching Profit 360 on NDTV Profit and I'm Sanjana. Along the next half an hour, we're going to bring you the latest on markets as well as national and international news. So let's dive right into it, shall we? Broader markets outperformed the benchmark Nifty 50 with strong gains across small and mid-cap indices. The sectoral indices mostly ended higher, led by metal and realty stocks. Nifty PSU Bank posted 4th straight session of gains with Union Bank of India and Bank of India leading the charge. Nifty Bank, however, struggled, marking its worst sectoral performance, weighed down by private banks. Let me quickly go over to Mahima for more on this. Mahima?
Right, so in terms of the benchmark indices today, they closed around 0.3 and 0.26% higher. So both Sensex and Nifty closed around 0.3% higher. But broader markets did outperform the overall benchmark indices. The mid-cap 150 closed around 1.3% higher and the small-cap 250 closed around 1.4% higher. In terms of the sectoral picture, in terms of the indices, gains were led by metal and realty. Nifty Metal top gaining sectoral index led by SAIL, National Aluminium Co. Nifty Bank ended lower, worst performing sectoral index as private banks lagged. In terms of the broader markets, the Nifty Mid-Cap 150 gains 3rd day in a row and the Small Cap 250 gained 4th day in a row. In terms of the PSU banks, gains were led by 4th day in a row and gains were led by Union Bank of India, Bank of India, as well as in terms of the Nifty FinServ and Nifty Bank, decline was seen 2nd day in a row. In terms of stock specific action, Tata Motors, Shriram Finance overall ended higher, top gainers of the Nifty. Garden Reach Shipbuilders, PTC Industries were the top gainers in the small cap 250 and Cochin Shipyard and AB Capital were the top gainers in the mid cap 150. So this is the overall view as to how markets have panned out today. We also spoke to Ravi Menon of Macquarie as to how IT stocks are to be seen ahead and what's the outlook like. Listen in.
The large cap companies are so big. We are not talking about 20% growth for a TCS, right? I mean, that's not what we're saying. But we think the overall industry can actually be in like a 10 to 12% sort of growth range. That's the possibility for 3 to 5 years or even more. And I think that itself, and with the mid caps, of course, growing much faster than that, and select large caps within that, like a smaller one, like an HCL Tech, probably even delivering 12-15% growth, quite possible. And that's what we think.
Let's take a look at what's happening in the cabinet briefing today. The Union Cabinet has approved the establishment of a new unit under the India Semiconductor Mission, marking the 6th facility in the initiative. Union Minister Ashwini Vaishnav shared details during the official briefing, highlighting India's continued push for semiconductor self-reliance and tech leadership.
ये प्लांट लगेगा, इसमें
20,000 वेफर पर मंथ की कैपेसिटी होगी और जो चिप्स इससे बन के निकलेगी उसकी कैपेसिटी है 36 मिलियन चिप्स पर मंथ विच इज़ 3.5 करोड़ रुपीज 3.6 करोड़ चिप्स पर मंथ। ये रहेगा इसका 36 करोड़, आई एम सॉरी 3.6 करोड़ 36 मिलियन चिप्स पर मंथ का इसका रहेगा। और अच्छा प्लांट है, बहुत ही एडवांस टेक्नोलॉजी। इसमें वेफर लेवल पैकेजिंग का एक टेक्नोलॉजी होता है वो इसमें लगेगा, विच मीन्स एंटायर वेफर के साथ सबस्ट्रेट को जोड़कर कंप्लीट उसकी एडवांस्ड पैकेजिंग।
Right, as you heard Union Minister Ashwini Vaishnav there specifying details about this joint venture between Foxconn and HCL. This is the 6th unit as part of the India Semiconductor Mission. What's important to note here is two things. Firstly, NDTV Profit caught a wind of this way back in January 2024. This was due to an exchange filing that Foxconn had made in Taiwan. And we got a hold of that. We reported that as well. Secondly, this is also Foxconn's second attempt to set up a chip plant here in India. The first one was with Vedanta, the steel major, the mining major Vedanta. That joint venture fell through because Foxconn felt that Vedanta wasn't experienced enough. But it has finally now been approved alongside in a joint venture alongside HCL. A few details about the project itself. It will attract an investment of about 3,700 crores. About 2,000 jobs are expected to be generated. This will be located very close to the Jewar International Airport that is coming up, which will act as sort of the secondary Delhi NCR airport as well. So strategically important location as well. We're hearing that production of chips will start in 2027. So the groundbreaking and the construction of this plant will be very, very soon.
Right, Rishabh, thanks so much for that update. We'll continue tracking the latest, but this is in fact another feather in India's cap when it comes to semiconductor manufacturing and of course tech leadership. Now let's take a look at India's new stance. It's New India stance. Now India is asserting its firmer stance on global matters, signaling clear strategic priorities. Indian tourists are cancelling trips en masse in response to Turkey's support for Pakistan during the recent conflicts, while India is also closely scrutinizing Chinese investments, ensuring they align with national security and economic interests. On the social media front, accounts linked to state-backed propaganda have been restricted, countering misinformation efforts. A decisive shift in policy, with India setting new boundaries whether it comes to diplomacy, trade, and information control. Let's take a look. First, according to top sources, the government will intensify scrutiny of at least 7 major China-backed FDI proposals and joint ventures. This with a fresh and tighter review now underway. Several JVs often proposed as workarounds to direct investments may also be subject to delays and tougher compliance measures. Now, this move comes amid rising tensions, including China's recent support for Pakistan during the conflict with India. Since April 2020, under a press note, India has mandated prior government approval for FDI from countries sharing land borders, with each proposal assessed on a case-by-case basis.
Yes, clearly after China opened support to Pakistan in a recent military standoff, India is tightening its grip on the foreign direct investment involving Chinese entities, signaling a toughened stance in terms of economic engagement, and FDI plays a huge role there. What we've been given to understand that at least 6 to 7 major deals which has been in the pipeline could face greater scrutiny. In fact, Indian authorities will have a fresh look on those deals under press note 3. Some of the JVs, joint venture, could be also worked out under the same regulation, but clearly the approval could take some time, and that could, delay the entire process and the deal as well, is what indication we are getting at this point. Sources also tells us that, the joint venture could be worked out in space like auto and consumer durable, which has been in talks and are in advanced stage, but that also require a monitoring and closer scrutiny. Press Note 3, as you remember, was introduced in April 2020 to sort of have a curb on the hostile takeover and requires multi-departmental and multi-ministry approval for any such investment coming from land border which India shares with, including China. And since then, we have seen decline in the FDI inflows from China, but there is a clear uptick in the import from China, especially the mercantile import are concerned. So there has been some discussion in past whether to ease the restriction under Press Note 3, but at the given evolving situation, it's clear that India may further tighten the current regime. That could be considered, but as long as easing the restriction is concerned is completely ruled out, and in fact we would see some stricter compliance is coming in place as far as China-backed deal is concerned.
Let's take a look what's happening in the tourism industry, with Indian travelers now cancelling trips to Turkey and Azerbaijan in large numbers following these countries' support for Islamabad during the recent India-Pakistan tension. Notably, Turkish-made drones were shot down by Indian forces during the conflict, further fueling public outrage. My colleague Sesa Sen now reporting on this growing wave of cancellations and its impact on tourism in both countries.
Tour operators and online travel agents are seeing mass cancellations of tours to Turkey and Azerbaijan after these countries publicly supported Pakistan in its conflict with India. In just 6 days, over 50% of the bookings to these destinations have been cancelled, with IsMyTrip reporting 22% cancellations for Turkey and over 30% for Azerbaijan. Now, these cancellations follow a travel advisory issued by the platform on May 9th, urging travelers to avoid non-essential travel to these countries. Other agencies like Ixigo, Cox & Kings and Pick Your Trail have also suspended new bookings, and smaller operators are also seeing significant decline in bookings as well as cancellations. Now, despite the political tensions, India remains a key source market for both these countries. In 2024, around 3.3 lakh tourists visited Turkey and 2.4 lakh visited Azerbaijan, spending over 3,000 crore, which the industry now suggests should be redirected to India-friendly destinations.
That's right. So the question resurfaces whether travelers should engage in geopolitics through their tourism choices. Former Union Minister Rajiv Chandrasekhar weighs in on this trend, exploring whether tourism can actually serve as a tool for diplomatic expression or whether it should remain independent of global politics. More on the big question on this evening at 6 o'clock.
Believe that the boycott Turkey movement is a real one, and it is a very legitimate expression of by the people of India on what Turkey has done in support of a terrorist state like Pakistan. Look, every rupee spent by an Indian adds value to the economy that he or she is spending it in. And certainly we don't want our hard-earned rupees and hard-earned incomes to be spent in a nation that is a proxy supporter of a country that is clearly aiding, abetting and encouraging terrorism against India and Indians. The 26 people who were brutally killed in Pahalgam are not some academic, intellectual debating issue. These are real people whose families have been really harmed and hit. And therefore, any country today, any institution, anybody who today comes out in support, albeit subtle, albeit indirect, of a nation state like Pakistan that is, taking innocent lives, really brutally killing innocent Indians, I think should be boycotted.
Meanwhile, India has restricted access to several X accounts affiliated with Chinese and Turkey state-run media outlets, citing concerns over misinformation and propaganda that threaten India's national interests. Among the affected outlets are TRT World, a Turkish government-funded international news outlet, along with Chinese state-controlled news agencies like Global Times and Xinhua News. Joining us live from the newsroom is my colleague Himangshi, who will provide in-depth coverage into the latest developments. Himangshi, if you could take us through the key factors behind India's decision to withhold these state-run media accounts and the background of all of this actually?
Absolutely, Sanjana. Let me just take you through how things unfolded after the tragic Pahalgam attack. So on May 7th, India hit back with Operation Sindoor, and Prime Minister Modi made it loud and clear that, terrorists and those who support them, there will be no differentiation between them. So the government actually ordered to remove Pakistan-linked content from the digital platforms. Meanwhile, the Indian embassy in Beijing warned the Global Times to, stop spreading disinformation regarding the operation. Then on May 8th, X announced that it received orders from India to block over 8,000 accounts, including some international news platforms and some high-profile accounts. And meanwhile, the Pakistani celebrity handles were also taken down as part of that crackdown. So that takes us to May 9th, where independent media actually felt the heat. The Wire says that its site is blocked across India, and Maktub Media's X handle was also withheld. And finally today, that is May 14th, India has withheld X accounts of China's Global Times, Xinhua and Turkey's TRT World, so accusing them of pushing Pakistani propaganda. So yes, it is not just a military response, but India is also fighting a parallel digital battle. And like PM Modi has time and again asserted that, this is India's new policy against terrorism, and that the world needs to get used to it. Back to you, Sanjana.
It's new India, new playbook, something that the Prime Minister has reiterated in both of his addresses, whether it was the one after Operation Sindoor or even the one that we saw yesterday to the Indian Armed Forces. India now taking this very firm new stance, especially against the countries that continue to support Islamabad. Moving on, all eyes on Washington as Commerce Minister Piyush Goyal begins a high-stakes visit aimed at advancing a strategic bilateral trade agreement with the United States. With global trade dynamics rapidly evolving, the outcome of these discussions could have far-reaching implications for India's economic trajectory, setting the stage for stronger commercial ties between the two nations. For more on the significance of this landmark trade agreement and what it means for India's future on the global economic stage, let's take a look.
Commerce Minister Piyush Goyal is all set to meet US Trade Representative Jameson Greer and Commerce Secretary Howard Lutnick in Washington. The stakes are high as India pushes for early wins in a bilateral trade deal aimed at boosting two-way commerce to $500 billion by 2030. This visit, scheduled from May 17th to 20th, builds on talks held in Delhi in March and Washington in April. The terms of reference for the Bilateral Trade Agreement, or BTA, are now finalized, covering 19 chapters on goods, services, tariffs, and customs. The backdrop is challenging. The US and China have slashed tariffs on each other by 115%, renewing their trade engagement. This shift threatens India's pitch as a manufacturing hub, making robust US-India trade pact more critical than ever. Following the ministers' meetings in person, sectoral negotiations are set to begin, building on the progress made in April's dialogue. The goal is clear: create a framework that drives economic growth while navigating global trade headwinds.
With the US-India trade talks gaining steam, all eyes are on Washington this week. The outcomes could shape India's economic strategy for years to come.
Right, Rishabh, thanks so much for that update. All eyes indeed on Washington as the Commerce Minister embarks on this 4-day visit. Moving on, the RBI is considering stricter norms for unsecured personal loans, urging banks to strengthen internal lending thresholds. It has advised capping loan limits based on borrower credit scores and ratings, citing concerns over the sector's vulnerability to financial shocks. Now, this follows the November 2023 move to hike risk weights on such loans from 100% to 125%, signaling continued regulatory caution. Shubhana joining in with more on this.
the RBI is actually planning to bring in tighter norms for unsecured loans as it is still concerned with the growth in this segment and the potential vulnerability that it brings in. Sources are actually telling us that RBI is actually nudging select banks to strengthen their internal policies and to bring in stricter threshold limits for such unsecured loans. What sources are also telling us that the RBI could ask banks to cap the limit on these unsecured personal loan borrowers, and what they're also saying is that these would be based on their ratings and credit score. So for example, if a borrower has a personal home vehicle, a home loan and a vehicle loan, then in that case banks would have to exercise caution and assess whether they want to give out a personal loan, and if they are, then how to. What sources are also telling us that right now the RBI is suggesting this to banks, and they would formalize this into a draft notification, and this could come out as soon as within the next fortnight. While banks already have their internal limits, but RBI wants banks to actually document this clearly and closely monitor the development so that it helps the central bank also to inspect on this, and it will ensure robust risk management.
Right, Shobhana, thanks for that. Let's look forward to the actions that the RBI actually takes with regards to capping these limits. Moving on, an important update coming in. Bharti Airtel, that posted a strong growth last evening of 432% in its net profit on a year-on-year basis, also commented on its partnership with Elon Musk's Starlink during its earnings call, saying that Starlink's service is meant to complement Airtel's existing portfolio, not replace it. The management further added that Starlink will serve areas not covered by terrestrial networks, filing connectivity gaps, and that the goal is to provide ubiquitous connectivity. Now, another update that came in on the call is that entry-level plan prices may stay the same or rise only modestly. Higher tier plans could also see reduced data allowances to encourage upgrade. And what is really crucial is that the tariff structure should move from small to extra large plans with value incentives. India's pricing gap between lowest and highest plans is smaller compared to markets like Indonesia, with Airtel now seeing scope to rebalance tariffs with more price stratification. So a crucial update coming in with this earnings call, very, very clearly laying it down that Starlink is clearly looking at, with Starlink will complement Airtel's efforts, and Bharti Electronics also took to social media to celebrate the success of its indigenously developed Akash Tir air defense system. But we'll get more on that story. But before that, let me quickly go back to what was discussed on the earnings call with Bharti Airtel. There was a strong growth of 432% in its net profit, but there were also a couple of key pricing updates that are just coming in. Entry-level plans may remain unchanged, or then we're going to see modest price increases. Higher tier plans could reduce data allowances, encouraging users to upgrade. Also very crucial because that will signal a change in the consumer pattern and the behavior. Tariffs may shift towards extra large plans with added value incentives. So India's pricing gap between low and higher tier plans is smaller than in markets like Indonesia, and this is particularly crucial coming in at a time where tariff hike on the cards is significant, as that will mean that more users will end up paying more. All of this, please remember, also coming in at a time that Starlink will be actually coming in to India and tying up with Airtel. Let me quickly go over to my colleague Aishwarya, who covers the sector very closely. Aishwarya, we're seeing a lot of developments coming in. We saw the TRI's recommendations, which we saw might be a little bit problematic to Starlink. Now Bharti Airtel on its call saying very, very clearly that Starlink's service is meant to complement Airtel's existing portfolio, not replace it. But also crucially are these pricing updates that we're seeing. Take us through it all.
Right. So ARPU is going up and tariff hike. As far as the industry on the whole is concerned, the telecom industry was being talked about. In fact, there were a couple of reports, and we did speak to some experts from the industry who covered telecom very closely. EY, ICRA, so on and so forth, have been saying that there could be at least 15 to 25% kind of an uptick. That's the bandwidth that they have been working with, and have said that this year we could see some sort of tariff hike. So an increase in price in your data plans as well. So what Bharti Airtel in its con call has said that although that could be on the cards, the entry-level plan prices may stay at the same or rise only modestly as far as the entry-level 100 rupee kind of plans are concerned. The higher tier plans also could see a reduced data allowance to encourage more upgrades is what they're saying. Apart from that, the CEOs also mentioned that tariff structure should move from small to extra large plans with value incentives. So what they are hinting here is that there is a pricing gap between the lowest and the highest plans, and as compared to other markets like Indonesia in India, and they will be looking at rebalancing tariffs in the near future is what they have hinted in the con call and after one of the questions that came from the investors. So far, there is a hint of tariff hike. We could see that across the industry as well. As I mentioned earlier, experts from the telecom space have also hinted that across the board, Airtel, Jio, as well as Vodafone Idea, we could see some sort of tariff hike coming in very, very soon.
Right, Aishwarya, thank you so much for that update. Crucial and key developments coming out of that earnings call, and it remains to be seen how that actually impacts Starlink and Airtel and the tariff prices. Moving on, Bharat Electronics took to social media to celebrate the success of its indigenously developed Akash Tir air defense system, which has proven highly effective in recent conflicts with Pakistan. Integrated with ground-based defense system, Akash Tir neutralized numerous Pakistani drones and missile attacks during Operation Sindoor, ensuring zero casualties. This AI-driven mobile system enhances situational awareness by fusing data from radars and sensors, enabling rapid automated responses to aerial threats. With 107 of 455 units delivered by November 2024, Bharat Electronics reckons that Akash Tir strengthens India's self-reliant defense strategy under the Atmanirbhar Bharat initiative. And Purnam Kumar Shaw, a border security force personnel detained by the Pakistan Rangers after he inadvertently crossed the international border last month, was handed over to Indian authorities at the checkpost in Atari today. The 40-year-old BSF man posted in Punjab's Firozpur crossed the border unintentionally on April 23rd, a day after the heinous terror attack in Jammu and Kashmir's Pahalgam that left 26 innocents dead. The terror attack led to heightened tensions on the border, and his return was delayed. And that's all the time we had on this edition of Profit 360. Stay tuned to NDTV Profit for more news and updates.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the Hello and welcome to KYC. Today we're going to talk about Borosil Renewables. Interesting company in the renewable energy space, not so much talked about, and that some flavor of that you'll get when we talk what exactly the company does. First off, I want to try and iron out as to what is it that interests me in this company. One, do things change substantially? There's now an anti-dumping duty by India with regard to glass. Does this change things substantially for the company? That's the first thing I want to understand. The other piece, there's been a drag over the last couple of years with regard to both top line as well as margins. That's because of pricing. Pricing in India, of course, also under pressure, but now with this anti-dumping duty, India is taken care of. But Borosil Renewables has a global presence. It has a presence in Germany. So I want to understand whether the global presence really, whether the global business actually also changes in any fashion, or whether we are seeing any of those trends play out, because China had cut pricing by 32%, global pricing, last year. Now, with that, you will see pressure on something like a Borosil Renewables. You want to know whether there's been a bit of a pullback from a China pricing standpoint, and therefore will Borosil benefit from this global outlook. The third piece is with regard to growth and margins. Therefore, with all of this playing out on the domestic front as well as on the international front, I want to understand whether anything changes with regard to the growth outlook as well as the margin outlook. Expansion, they are looking to add another 500 tons per day of capacity. They currently have 1,350, so the 500 tons is substantial in that sense. How quickly does that come on stream? How quickly do they set it up? And what are the capex plans like? Last off, I want to understand the domestic industry outlook. There's a large opportunity available domestically. Does that opportunity remain? What is the likelihood of that opportunity remaining? And will they continue to maintain leadership within that space? Now, let's start off by understanding what the company is about. It is the first and the largest solar glass manufacturer in India. We're talking about this big shift towards renewables. Borosil does not manufacture power. It does not generate power. What it does is it manufactures glass, solar glass, which basically is the key ingredient to generating power. And it is the largest of those, and therefore it becomes a very important cog in that entire value chain. Look at the manufacturing capacity it has. It has around 1,350 tons per day of manufacturing capacity. This ensures roughly 8.5 gigawatts of solar power generation for each year of production that they do. They are likely to add another 500 gigawatts. I'll come to that. But before that, out of this 8.5 gigawatts, they have a 2 gigawatt odd presence coming from Germany. So that is the global exposure that the company has. 6.5 gigawatts is the domestic exposure. Of course, outside of that, exports also is a relevant factor. But in Europe, in Germany in particular, this 2 gigawatt capacity is substantial because it could drag the overall balance sheet and the overall numbers for Borosil despite the domestic numbers looking good. So that's something I want to quickly highlight. The last piece is with regard to expansion plans. So they're considering another 500 tons per day of expansion that they are looking for. They've been looking for this since a while now, but in December 2024 was when the Indian government came out with an anti-dumping duty